again, it's a pretty lovely chilly evening from here in Delhi, and hope as always that each one of you are absolutely fine, happy, and of course in fine spirits. So till after 6.2 we have already finished, and the last question was from your module, and I did talk about this particular fact that as far as intrinsic value method is concerned, it is pretty important from the examination point of view, and that is the reason actually from this particular topic we find lots of question actually starting up in the examination, correct? So now we pick up question number 6.3 to begin the session. Those who have already connected with us, it's a very lovely good evening once again to each one of them. And now today we are going to start with 6.3, correct? This is the question which we are picking up. Green signal is also on. So let's start the what we call proceedings of the day. 6.3, once again, it has been picked up from your module. And this question was also from the past examination paper. Little bit modification we have done with respect to only names and the dates, nothing else. The summarized balance sheet of W1 and W2 is given to you. First, pay attention to, please, you are requested to, because it's a pretty strong question, correct? And in between some boxes pop up, so that's a big problem. Anyway, W2 Limited was merged with W1 Limited with effect from 1/4/2022. This time W1 and W2's balance sheet is given to you, and further it is given W2 Limited was merged with W1 Limited. Indirectly it means W1 Limited is the purchasing unit and W2 happens to be the what we call entity which is selling its business or acquiring entity. Now, if we look into the balance sheet, we find actually that there are equity share capital. Besides that, under the category of reserves and surplus, we have been given general reserve and profit and loss account. As far as your non-current liabilities are concerned, debentures are also there, 12% debentures. And besides that, we have two more liability in the form of current liabilities, sundry creditors, and provision for taxation. After that, we have non-current asset, that is property, plant and equipment, 10 lakh and 4 lakh 50, non-trade investment. Non-trade investment is equal to 150 and 50,000. Besides that, then we have got current asset in the form of stock, debtors, advance tax, and bank. Also, preliminary expenses are given in the balance sheet, although nowadays rule as per existing accounting standard AS-26, preliminary expenses should not be reflected in the balance sheet, rather should be set off against the what we call reserves and surplus. But anyway, in this question it is given, so we will consider it, and we know that it is a valueless item, correct? All items appearing towards the asset side are basically asset except preliminary expenses. Then further it is given W1 Limited, which is the entity which is taking over the business, that is acquirer entity. W1 Limited would issue 12% debenture to discharge the claims of the debenture holders of W2 Limited at par. Here it is written that W1 Limited is going to issue 12% debenture to discharge the claims of the debenture holders of W2 Limited at par. Further, it is given that non-trade investment of W1 Limited fetched 20%, while those of W2 Limited fetched 12%. Now, whatever trade investments which we are having, as we saw in the balance sheet, there are actually investment. It is given that investments of W1 Limited fetches a return of 20%, while investments of W2 Limited fetches a return of only 12%, correct? Now, further it is given that profits, pre-tax profit, that means profits before tax, are given to you of W1 and W2 Limited during 1920, 2021 and 21-22. So profits of last 3 years are also given to you. And these are the profits, these are before tax profits of the respective entities, correct? Further, it is given that goodwill may be calculated on the basis of capitalization method. On the basis of capitalization method, taking 20% as the pre-tax normal rate of return. And normal rate of return is also given to you. Further, it is given that purchase consideration is discharged by W1 Limited on the basis of intrinsic value per share. Purchase consideration is discharged by W1 Limited on the basis of intrinsic value per share. And in this question, as I told you even in the last question, that generally when the question gets tossed up from this particular topic, generally we are asked to prepare the what we call balance sheet. In this question, balance sheet is asked in the books of W1 Limited after the merger as per Schedule 3 Division 2. Of course, we always prepare, and we are preparing balance sheet as per what we call Schedule 3 Division 2 only. So this is the question which we have seen. In this particular question, you must have noticed one important line here is that goodwill may be calculated on the basis of capitalization method. Goodwill may be computed on the basis of capitalization method, taking 20% as the pre-tax normal, what we call rate of return. This is the point why this point is important, because ultimately we have to compute what? Intrinsic value of shares. When we compute intrinsic value of share, we need to have all the assets. So that is why valuation of goodwill is also needed in this particular question. That's a different matter that you have a separate chapter, valuation of goodwill, and over there we are going to explain all the intricacies of the goodwill, no doubt about that. But here, in order to solve this particular question, let's come and start the proceedings as I told you. So under this particular question, first of all, what we are supposed to do, see here, and please open down your pen, pencil notes, whatever it is, correct? And it is always better. I keep on telling, please listen to me carefully. The more you are going to write, the more you are going to get what we call more out of the class. So it is better. Anyway, this is my advice. It is up to you whether you want to follow it or not. 6.3 is the question which we are picking up. Under this particular question, because ultimately here it is written that goodwill is to be valued on the basis of capitalization method, so we may require the capital employed. For the purpose of capital employed, first of all, you must know what is the meaning of capital employed for the purpose of goodwill. Although we are going to discuss all these concepts when we are going to pick up the chapter, valuation of goodwill. At this moment, it is suffice to say that assets minus liability is nothing but capital employed. However, in the context of goodwill, when we compute capital employed, we always compute operating capital employed. There is a difference between capital employed and what we call operating capital employed. What I am saying, please mind these words carefully. Assets minus liability is always equal to capital. Generally, when we compute capital employed in accounts, from all the assets, we subtract what we call all the liability. However, in the context of goodwill, the capital employed need to be computed with little bit of caution. When we will compute the capital employed, remember one thing, we will not take into account non-trade investment. If there will be any non-trade investment, we will never ever take what we call non-trade investment for computing capital employed for the purpose of goodwill. Correct? Similarly, if there will be what we call assets, which generally are known as non-operating asset. For example, work in progress. For example, asset which are still under construction, because these assets are still under construction and not yet completed. So we presume that they are not helping in the operating activities. So even such assets will not be taken into account. Similarly, if I have kept an asset for the purpose of sale, let us say I am holding upon a plot of land, and my intention is to sell it in future, even such what we call assets will also not be taken into account. That means whenever we compute the good capital employed in the context of goodwill, non-trading investments are never ever taken into account. Work in progress will never be taken into account. Capital work in progress will never be taken into account. Similarly, assets held for sale will also be not taken into account. Anyway, all these points, as I told you, we are going to actually discuss a lot when we are going to pick up the chapter later on, valuation of goodwill. At this moment, because here we require in this particular question to compute the amount of goodwill, I am discussing this point. So here in this particular chapter, my first target or my first step should be to compute the capital employed. And for that, I will write under step number A, I am writing operating capital employed. I hope you got this meaning. Whenever we compute capital employed for the purpose of goodwill, it always means operating capital employed. Operating capital employed. My first target is to somehow compute the operating capital employed of both these entities. Correct? Because intrinsic value we will have to find later on, and for that purpose we need to have the goodwill of both these entities. Is it clear? Now, in this particular question, if you will look into the question, first you simply take into account the figures of total. Correct? Total of asset side is given to you. You simply write total of asset side to save the time. Total of asset side. If you will look into the question, you will find total of asset side of W1 Limited is actually equal to 17 lakh. I am simply writing the total of asset side. Instead of writing the items separately, property, plant and equipment, etc., I have simply taken the total of asset side. Similarly, total of asset side of W2 Limited is also given, which is 7,80,000. As we know, correct, we need to consider first of all assets. And we also are well aware of this particular fact that preliminary expenses does not fall in the category of asset because it is a valueless asset. So first of all, I am going to subtract the preliminary expenses. Because preliminary expense is valueless asset, preliminary expense, discount on issue of share, all these are considered as valueless asset, as you know. Preliminary expenses of W1 Limited is given in the question, so I have subtracted it. After subtracting the preliminary expenses, now we are left up with assets. However, in the context of goodwill, I just told you, if there will be any non-trading investment, we will not consider the same. So I will subtract the non-trading investment. So non-trading investments, which is given in the question, non-trading investments given in the question, 1,50,000 of W1 Limited. So 1,50,000 I will subtract, and 50,000 of W2 Limited I will subtract the same. So that means now I am having the assets, correct? Preliminary expenses we have already subtracted. So now we have also subtracted what we call non-trading investment. As I told you, if there would have been any non-trading asset, like work in progress, I would have subtracted it also. If there would have been any capital work in progress, capital work in progress means big, huge property, plant and equipment which are still under construction stages, I would have subtracted the same also. Similarly, if there would have been what we call any asset held for sale, asset held for sale, AHFS, even such asset I would have had subtracted for the computation of capital employed in the context of the goodwill. Is it clear to you? So after subtracting the preliminary expenses and non-trading investments, correct? So now what we get 170 minus 17 lakh, that is equal to 15,30,000. And in this case, I will get that is equal to 7,30,000. 7,80,000 minus 50,000. So now I have got the operating capital employed, not exactly operating capital employed. In fact, we are computing operating capital employed. Now we may say that these are the assets which we are going to pick up. From the total of the asset, now I am going to subtract the liabilities. In this question, as far as liabilities are concerned, there are three liabilities. One, creditors, that is 60,000. I will subtract 60,000 and 50,000. Besides that, in this particular question, we are also having provision for tax. It is also a liability. I am going to subtract provision for tax also. And provision for tax given in the question is 90,000. So I will subtract 90,000. I will also subtract 50,000 worth of provision of this particular company. Besides that, we are also having 12% debenture in the form of non-current liability. Debenture is also a liability. So 2 lakh I will subtract. And 1 lakh here I am going to subtract. So by subtracting the liability from the assets, correct, we get operating capital employed. If I am going to subtract 350 from 1530, I am going to get 11,80,000. I will write here 11,80,000. From 730, if I am going to subtract 2 lakh, I am going to get 5,30,000. So this 5,30,000 and 11,80,000 is my capital employed, and it is better known as operating capital employed because all the non-operating assets like non-trade investment, capital work in progress, assets held for sale have been already subtracted or excluded. Is it clear to you or not? After this, your next step should be calculation of calculation of average adjusted profit. Calculation of average adjusted profit. Why we are computing average adjusted profit? Because we have to compute the goodwill. Now, profits of last 3 years of W1 and W2 is given to us. First of all, what I am going to do, I am simply going to add the 3 years profit of W1 which is given to us, total profits. Total profits, if I am going to add the 3 years profit which are given to us in the question, is it clear to you? That will be equal to 18 lakh. And if I am going to add the profits of last 3 years of W1 Limited, I will get near about 6 lakhs. So I am simply adding all the profits which are given to us. These are the profits of last 3 years. Obviously, because profits are of 3 years, I will divide it by 3. After dividing it by 3, I will get the average profit. So I may say average profits of last 3 years is equal to this much. So average profit signifies that per year profits, correct, in the last 3 years on an average was this much. So W1 Limited was earning on an average a profit of 6 lakh per year, while this entity is earning a profit of 2 lakh per year in the last 3 years on an average. However, we have to be careful because we haven't considered non-trade investment as part of capital employed. Is it clear to you? We haven't considered it. So quite obviously, the income which we were receiving through our investment will also not be considered for the purpose of computing the profit. So that is why after having computed average profit, I am going to subtract income from investments. Income from investment. I am going to subtract income from investment. Now, look carefully. As far as in the balance sheet, we know that investments of this entity is equal to 1,50,000 non-trading investment. And every year I must be earning at the rate of 20% because it was given in the question that investment of this entity W1 fetches a return of 20%. So that is why, that means every year I was including near about 30,000 rupees. So because it will be considered as non-trading income, so that is why it will be subtracted from the profits. So any income from non-trading investment will be excluded from the profits. Similarly, this entity is having investment of 50,000, but in the question it was given that investment of W2 Limited is fetching a return at the rate of 12%. So 6,000 I am going to subtract. Is it clear to you? After subtracting the non-trading incomes, now I get the average adjusted profit. So average adjusted profit now we may say is equal to 5,70,000, and 1,94,000. How much? 1,94,000. So we have arrived over the average adjusted profit. I hope till up to this particular point everything is clear to everyone. Is it clear? Right, sir. After having computed the average adjusted profit, now we are in a position to compute the amount of goodwill, because in this particular question it was written that we have to compute the goodwill through capitalization method. So now under the next step, I will write capitalized value of profits. Capitalized value of profits. What we mean by capitalized value of profits? First of all, capitalized value of profits. In order to compute the capitalized value of profits, what we are supposed to do? In fact, whatever profits which we are having, average adjusted profit, AAP, we are going to simply divide it by normal rate of return. Is it clear to you or not? Now see here. Here I am writing W1. Here I am writing W2. We have computed the average adjusted profit, and average adjusted profits were 5,70,000 of this particular entity and 1,94,000 of this particular entity. Remember, these profits are before tax profits. And normal rate of return is also before tax. So we will divide it by 20%. normal rate of return, and this will deliver the capitalized value. It is known as capitalized value. So capitalized value will be equal to 5 lakh 70 into 5, that is equal to 28 lakh 50,000, and 1 lakh 94,000 into 5 will be equal to 9 lakh 70,000. So this is the capitalized value of profits. Capitalized value of profits. Capitalized value of profits simply signifies that on the basis of our profit earning capacity, on the basis of our profit earning capacity, what exactly is the value of our capital? Is it clear to you? That is what we mean by capitalized value of profits. Capitalized value of profits signifies that on the basis of my profit earning capacity, my capital logically is equal to 28 lakh 50,000, although actually I might be having a different capital. Likewise, this company on the basis of profit earning capacity should have a capital of 9 lakh 70,000. Is it clear to you? And that's a different matter, that actually they might be having a different sort of capital. After having computed the capitalized value of profit, now what we are going to do, I am going to subtract the actual capital. Actual capital. Now we just computed actual capital in the first step. So you can see my actual capital is just about 11 lakh 80,000. Whereas because of my profit earning capacity, my capital is equal to 28 lakh 50,000. Is it clear to you? Likewise, this entity is having a capital on the basis of profit earning capacity 9 lakh 70,000. However, its actual capital was 5 lakh 30,000. So the difference of these two capital will deliver the amount of goodwill. That is how we are going to compute the amount of goodwill through capitalization method. Is it clear to you? So 16 lakh 70,000 will be considered as the goodwill of W1 Limited, while 4 lakh 40,000 will be considered as goodwill of this particular entity. Is it clear to you or not? Absolutely clear? Fine. Now we move over to the next step. Under the next step, obviously whatever we have done, the basic purpose was to actually find out intrinsic value of share. So now we will write here calculation of IVS, intrinsic value of share. In order to compute the intrinsic value of share, W1, W2 Limited. First of all, I am going to write goodwill which we just computed. Now goodwill of this particular entity is 16 lakh 70,000. And goodwill of this particular entity which we just computed is equal to 4 lakh 40,000. Is it clear to you or not? Yes, sir, it is absolutely clear. If it is clear to you, then look into your balance sheet. In the balance sheet, we find property, plant and equipment. Property, plant and equipment is equal to 10 lakh and then 4 lakh 50,000. 4 lakh 50,000. After that, we have non-trade investment. But now, we are not computing assets for the purpose of goodwill. We are computing now assets for the purpose of valuation of shares. I've already told you, only for the purpose of computation of capital employed, or for that instance total assets, we never take non-trade investment, but only with respect to what we call goodwill. Here we are taking all the assets for the purpose of computation of share. Here we are going to take even non-trading investments. So investments, that is why I am considering now investments also. So investment of this particular entity, as we saw, was equal to 1 lakh 50,000, and investment of this particular entity is equal to 50,000. Is it clear to you or not? Because now we are doing valuation of share. And for the purpose of valuation of share, we are going to take over all the assets, correct? Similarly, your next items are in the form of current asset, that is equal to stock, 1 lakh 60,000 and 50,000. 1 lakh 60,000 and 50,000. No revised values are given. Similarly, debtors. If revised values would have been given, I would have considered the same. Then debtors is equal to 80,000. I will write here 80,000. And debtors of this particular entity is equal to 90,000. So I am going to write 90,000. Is it clear to you? After debtors, we are also given in this particular question advance tax. Some taxes we might have paid in advance, considered as current assets. So 60,000 and 30,000. Then I am going to write here bank balance, which is given in the question. The bank balance is 2,30,000 and 1,10,000. So bank balance is equal to this much. So now we have arrived over the total assets. From the total assets, I am going to now subtract all the liabilities. In this question, we have already seen there are three liabilities. One in the form of debentures, 2 lakh and 1 lakh. 2 lakh and 1 lakh. Besides that, we are having two more liabilities, creditors. These are in the form of current liability, 60,000 and 50,000. And we are also having in this particular case provision for taxation. So I am going to subtract provision for taxation also. Provision for tax, 90,000 and 50,000. So kindly let me know the net amount. It is not possible for me to... Yes, let me see actually who gives the answer. SAS guys are connected with us. Kindly give me the answer quickly. So now we shall get net assets. And as you know, net assets means assets available for shareholders. Net assets means assets for shareholders. From Mumbai city, Paresh says it is 30 lakhs. So let me write here 30 lakhs. And name, actually those who are connected with us with SAS, it becomes sometimes a little bit difficult to read their names actually. It is VG Gopalan from Vishakhapatnam. Correct. 10,20,000. Thank you. 10,20,000. So nice of you. Otherwise, it was hell of a job for me to compute all these things. So net assets we have got. Now, after having got the net assets, if there would have been any preference share capital, I would have subtracted the same. There is no preference share capital. So assets available for equity shares will be equal to 30 lakhs and 10,20,000. 10,20,000. Correct? I will write here assets for equity shares, equity shareholders. Now, in order to compute the intrinsic value of share, all we need to do is to divide it by the number of shares. So, number of equity shares, as we can see, is equal to 80,000 and in this case 30,000. Now, do me a favor to find out the intrinsic value. Okay, you let me know what is the intrinsic value. From Palwal, it is Vikas Beniwal. It states that 37.50, sir. Thank you. And from Uttamnagar, Shreya says, Uttamnagar Delhi actually, Shreya says 34. Okay. So we have computed the intrinsic value of the shares of the respective companies, correct? Now, under the next step, this is our step number E, I think so. Anyway, next thing is consideration. And we know that under intrinsic value of shares, consideration gets automatically arrived at. Consideration basically means net assets of W2 Limited. In this question, we have already computed the net assets of W2 Limited, isn't it or not? That is equal to 10,20,000. So 10,20,000 is the consideration. And if I am going to divide it by the intrinsic value of share of W1 Limited, the acquirer entity, 37.50. What I will get? I will get the number of shares which the W2 Limited would issue to W1 Limited on the basis of intrinsic value of share, isn't it or not? So, it will deliver me number of shares to be issued. So, how many number of shares W1 Limited shall issue? Thank you very much. 27,200. This reply came from Ambala, Kent, Maheshnagar. Name is Simranjit Singh says that 27,200. Thank you. So number of share to be issued is equal to 27,200, which means actually in this particular case, this entity W1 Limited shall issue 27,200 shares of 10 each at the rate of 37.50. Is it clear to you? Now, after this particular step, we move over to the books of acquirer. Books of acquirer. Books of acquirer. As far as acquirer books are concerned, books of acquirer. As far as books of acquirer are concerned, now you let me know what entries W1 Limited shall pass. Correct all the assets which we have taken over. Logically, I should write all the asset in a segregated form, but just to actually save the time, I am simply writing identifiable asset. You can write them in a segregated form, but just to save the time, I am writing identifiable asset. In fact, let me tell you how I arrived over this figure. Here, see here, if I am going to tally all these assets, because we are taking over goodwill at 440, we are taking over 450 worth of property, plant and equipment, we are taking over investment, stock, debtors, advance tax and bank. You can write it in this manner in a segregated form. Their total will be equal to 7,80,000. So that is why I am writing here identifiable asset account debit 7,80,000. Correct? 7,80,000. And then we are going to write the liabilities, and liabilities will be equal to, just wait, this total I think should be more. Let me tell you, just let me check it out. 440 plus 450 plus 100 plus 120 plus 110. It should be more. 12,20,000, not 780. Actually, I subtracted instead of adding. So identifiable asset account should be equal to 12,20,000. Is it clear to you or not? In your class, this pen starts creating problem. I do not know what is the problem with this pen. It is not rubbing on. Okay, the total is actually 12,20,000. Correct? Total is 12,20,000. 12,20,000. Now, as far as liabilities are concerned, we have taken over 3 liabilities: debentures, creditors, provision for taxation. Their total is equal to 2 lakh. So I will write here 2 liabilities. So we have taken over liabilities also worth rupees 2 lakh. Correct? Of course, if I am going to subtract 2 lakh from 12,20,000, it will be equal to net assets, that is 10,20,000. Now, we are going to write here 2 consideration. So consideration payable is equal to 10,20,000. So in this question, I should not say that there is no goodwill. Of course, there is no balance. But remember one thing, in this 12,20,000, you have already included a goodwill of 4,40,000. Is it clear to you or not? In this figure, 12,20,000 goodwill is already included. Anyway, so no balancing figure is there. And now we are going to discharge the consideration. In order to discharge the consideration, what I am supposed to do? Consideration is 10,20,000. How many shares we are offering? I'm going to write here 2 share capital. As far as share capital is concerned, 27,200 share as you computed. 27,200 shares of 10 each. First of all, I am going to write 2,72,000. 2,72,000. Then I am going to write here 2 share capital. As far as share capital is concerned, 27,200 share at a premium of 27.50 because intrinsic value was 37.50. So that means we are issuing share at a premium of 27.50. It will be equal to 7,48,000. Somebody already flashed the answer. Correct? Sometimes it becomes difficult to read the names, those who are connected with us in through what we call SAS system, because the names are very small and some in small letters, sometimes becomes very difficult to read them. Anyway, thank you very much. 7,48,000. In this question, we are also supposed to prepare the balance sheet. And in order to prepare the balance sheet, pay attention. As per division 2, we always write the assets first, as you know, assets. Under the asset, I will write first of all non-current asset. Now, under the non-current asset, first of all, I am going to begin with property, plant and equipment. Now, first of all, you take the figure of W1 Limited. Now, property, plant and equipment of acquirer entity is 10 lakh. Of acquirer entity is 10 lakh. Now, you add the property, plant and equipment which you have taken over. You have taken over property, plant and equipment of W2 Limited, 4 lakh 50. So, total will be equal to 14 lakh 50,000 in the outer column. Is it clear to you? So that is how you are going to proceed to prepare the balance sheet. Not a very difficult task. Now, under step number B, I am going to write goodwill. Very important to understand. Whenever we prepare the balance sheet, whenever we are going to prepare the balance sheet of the acquirer entity, please pay attention what I am trying to tell you. Whenever we are going to prepare the balance sheet of the acquirer entity, the items which are appearing in the balance sheet of the acquirer entity will be displayed in the balance sheet as it is. Is it clear to you or not? For example, I am looking into the balance sheet of W1 Limited. Over there, I did not find any goodwill. That's a different matter. We computed the amount of goodwill, but we did not notice any goodwill in the balance sheet. So that is why here I am not adding any goodwill of W1 Limited. Whenever we are going to prepare the balance sheet, the items which are appearing in the books of the W1 Limited only will be reflected in the new balance sheet. Besides that, now, whatever items which you have taken over, because you have taken over W1 Limited and you have taken all these assets, correct? Obviously, you are taking over their goodwill also. So that is the reason goodwill of W2 Limited will find place in the balance sheet. Is it clear to you or not? This is very important step which you need to keep in your mind. So that is why in the balance sheet, only goodwill of 4,40,000 will appear. Items of acquirer company will appear as it is, as they are appearing in the balance sheet. Is it clear to you? And items of the acquiring entity, you are going to reflect them in the new balance sheet at a value at which you are taking them over. Is it clear? Then in the next step, I am going to write investment. Nowadays, investment are written under the heading non-current asset, but under the subheading financial asset, just for knowledge sake. Investments. As far as investments are concerned, of acquirer entity, investment is 1,50,000 and you have taken over the investment of the acquiring entity at 50,000. So you are going to write at 2 lakh. Is it clear? Besides that, after the current asset, there was some current asset in the question. Current asset. Under the current asset, first of all, let me write stock. Now, W1 Limited's stock was 1,60,000 and stock of acquiring entity you took over at 50,000. So 2,10,000 I am going to simply put in the outer column. Besides the stock, in this particular question, we are having debtors. As far as debtors are concerned, 80,000 worth of debtors of acquirer entity given in the balance sheet, and acquiring company's debtors we have taken over at 90,000. So I am going to add 90, and in the outer column I am going to write 1,70,000. This is how we are going to actually proceed. Correct? Not a very tough task, but a little bit boring task. Advance tax. Advance tax of acquirer entity is 60. Acquiring entity's advance tax is 30. Total in the outer column, I am going to write 90,000. Further, we have got bank balance. Bank balance 2,30,000 of acquirer entity. And acquiring entity's bank balance is equal to 1,10,000. In the outer column, I am going to write now 3,40,000. Kindly total it up and let me know. Once again, answers are getting flashed, but the point is that how quickly you are able to do it. I am not able to understand. Somebody is telling me 29 lakh. I hope you are not looking at the solution straight away and delivering the answer. Kindly do the calculation. But anyway, but still I am thankful to you. Second, equity and liability. Equity and liability. Under the equity and liability, first of all, we write equity, as you know. Under the equity, we write A, share capital. Make it a habit of presenting the balance sheet in this manner. The more you practice, the more you would write, the more perfect you would become. Now here, you will have to be careful. Why? First of all, here, only acquirer company share capital will appear, because acquiring company share capital will get closed when acquiring company will prepare its account. As we know, their share capital is posted to their share capital account. So first of all, I look into the fact total number of share of acquirer entity is 80,000. Total number of share I am talking about. That means total share capital of acquirer entity will come into play. But you have just passed an entry in the books of acquirer entity to share capital 2,72,000. That means we have issued 27,200 share. So 27,200 shares we have issued to discharge the purchase consideration. So total number of shares now will be equal to 1,07,200, isn't it or not? And one share is of 10 each. So I will multiply it with 10. And in the outer column, I will write 10,72,000. And if you want to be a little bit more stylish, you can also write in bracket 27,200 shares. 27, that means out of 1,07,200 shares, 27,200 shares have been issued. Shares have been issued. To discharge consideration. To discharge consideration. So you can mention it also. Is it clear? In case if you wish. Then, besides share capital, we write other equity item. As far as other equity item is concerned, in this particular case, first of all, we must understand when we wrote this particular entry, when we issued 27,200 share, besides that, there is, I have written here share capital, write it share premium. 27,200 into 27.5, that is actually your share premium. So 7,48,000 worth of premium now will also appear in the balance sheet, isn't it or not? So 7,48,000 worth of premium will also appear. Now general reserve of acquirer company only will be written because acquiring company's general reserve must have got closed, correct? Similarly, profit and loss account of only acquirer company will find place in the balance sheet because acquiring company's profit and loss account must have been close to what we call share capital account, isn't it or not? Now in this question, on the asset side of the acquirer entity, we have preliminary expenses. So it is better to set off preliminary expenses against the other equity items. So 20,000 worth of preliminary expenses, because nowadays, as I told you, it is not the practice of reflecting the preliminary expenses. So it is better if you have any preliminary expenses to set it off against the reserves and surplus. So in the outer column, I will be writing 12,78,000. So 12,78,000. I think some guys are giving me answers by simply looking at the answers. Otherwise, it is not possible within a flick of a second and within a flicking of a what we call eye, you are delivering the answer so fast. If you are doing so, you are deceiving yourself. I must say, make it a habit of doing the calculation, write everything. I could have also what we call simply went through the solved answers and made you understand that way. This is not the way, correct? And here we are not offering any prizes for what we call to those who are giving us what we call answers in a quick fire manner. You are in a professional level, so be careful. That doesn't look nice when you are violating the terms, correct? Anyway, next point is Now we come over to liabilities. As far as liabilities are concerned, there is non-current liability. So I will write non-current liability in the form of 12% debentures. Now, see here in this particular question. If you will look carefully, we wrote the debenture amount. Just wait. Where is the solution? Right here. Sometime when you need something, anyway, you can see debentures of this entity is actually 2 lakh. And debentures of this entity is actually 1 lakh. And if you are going to write in the balance sheet 2 lakh plus 1 lakh, perhaps you may lose 1 or 2 marks unnecessarily. Why? Because in this particular question, when we were going through the question, just below the balance sheet, it was given that debentures of W2 Limited were discharged by issuing debentures. That means these debentures have been discharged by W1 Limited, and for the same they have issued their own debentures. So indirectly what I want to say is that, please pay attention here, instead of writing 2 lakh plus 1 lakh, you simply write 12% debentures of acquirer company 3 lakh. Because now acquirer entity is not having any debentures because you have discharged those debenture holder by issuing your own debentures. So your debentures have moved up from 2 lakh to 3 lakh. If you are going to do the answer in this manner, then only you are going to get full out of full. So 3 lakh worth of debenture will appear in the balance sheet. Is it clear to you or not? Clear? Any doubt over here? Please let me know in case if some of you are having doubt over this particular point. No doubt, it is nice to hear that. Now, next item, current liability. First of all, let me write here, as far as current liabilities are concerned, I will write here creditors. Now, creditors of acquirer entity is 90,000. Of acquiree entity, it is 50,000. In the outer column, I am going to write 1,40,000. 1,40,000. After that, provision for tax. Provision for tax, which is given 90,000 and 50. Provision for tax is, I think I have committed a mistake. Creditors were 60,000. Right. Creditors were 60,000, not 90,000. Figures are generally memorized, but it is 60,000, not 90,000. So 60 plus 50 will be equal to 1,10,000. So I will write here 1,10,000. And provision for tax was 90, and even this figure is 50,000. So 1,40,000 as far as provision for tax is concerned. Kindly, for God's sake, do the computation, correct? Don't jump over the solutions, correct? Simply, your answer should be equal to 29 lakh. That's a different matter because earlier you told me that asset side total is 29 lakh. So check it and find out whether what we call solution is correct or not. After having done this particular part, with that we have come to the end of section 6, correct? An interesting section it was, and because 2 questions of the module straightway we picked up, and pretty long and strong question. After having done this one, now we move over to the next part. I told you in the earlier stages that, first let me move over to section 7. This is section 7. That there are 3 methods of computing the purchase consideration. We talked about, first of all, when purchase consideration is not given, then we have the luxury of what we call to use any out of these 3 methods, but depending upon the what we call information contained in the question, to use a particular method to find out purchase consideration. 3 methods were, as you know, net assets method, first we did, then variation of it, intrinsic value of share, that was the second method, pretty important one. And I also told you in practical life, companies, whenever they do mergers, acquisitions, they generally use intrinsic value of share method. Besides that, now we have got another method. This is known as net payment method. Net payment method, correct? Under the net payment method, how purchase consideration is found out. Now, this is the issue and this is the theme of this particular topic. Now, just pay attention. As far as net payment method is concerned, what we are supposed to do, how under it we are going to compute the purchase consideration, and when we have to use this particular method. I have already told you net assets method is used when the question says balance of the purchase consideration is to be paid in so and so portion. As far as intrinsic value of shares is considered, it is always given in the question itself, no problem with respect to IVS. But now net payment method. So you are going to apply net payment method when we are not in a position to use net asset method, or when the question is silent whether to use what we call intrinsic value of shares method. So quite obviously in that case we are left up with only one alternative, and in that case we are going to use the net payment method of computing the purchase consideration. Under the net payment method we will see actually here we are simply going to take into account all the payments which are being given by purchasing company to the different parties of the vendor company. What I mean to say, just pay attention here. In this particular case, I will pick up 7.1. In this particular case, we will see that purchasing company and vendor company comes into an agreement, whereby purchasing company will say, or the acquirer entity will say to the vendor company means acquiring company, to the vendor company, that we are going to pay to your shareholders this much amount, we are going to pay your debenture holders, let us say this much amount, we are going to pay your creditors, let us say this much of amount. So whatever payments purchasing company will deliver to the vendor company, we are simply not going to total them up. We are not going to simply total them up. Only payments given to the shareholders of the vendor company. Please pay attention. These are very important points. Only payments delivered by the purchasing company to the shareholders of vendor company will be considered for the computation of the purchase consideration. Under net payment method, payments given by purchasing company to the shareholders of the vendor company will constitute the amount of purchase consideration. Is it clear to you? And if purchasing company will deliver any payment to the debenture holders and creditors, what will be the treatment of that? That means any payment given by purchasing company to the parties other than the shareholder, number one, shall not be considered as part of purchase consideration. And number two, now we will consider as if those parties have been taken over by the purchasing company. Now we will presume that these parties to whom the payments have been delivered but not made part of purchase consideration, now we shall presume as if those liabilities have been taken over by the purchasing company. I will address all these issues, don't worry about that. So let me pick up a particular question first and then I will explain the things. Okay, first we begin up with this particular question, 7.1. So 7.1 we start. Following is the summarized balance sheet of X9 Limited as on 31st of 3, 2019. And here it is given that equity share capital is 15 lakh. Equity share capital is 15 lakh and we have preference share capital also. Besides that, in this question there is general reserve. Besides the general reserve, we have one liability in the form of trade payables. As far as assets are concerned, we have land and building, plant and machinery, furniture and fittings, then inventory, trade receivable and cash at bank. Further, it is given below that Y100 Limited agreed to acquire X9 Limited. So there is a company by the name of Y100 and Y100 Limited has agreed to take over this entity X9 Limited, and as per the terms, each equity share in X9 Limited, correct, shall be valued at rupees 80. Each equity share in X9 Limited shall be valued at 80. First of all, it means actually equity share capital given in the balance sheet of X9 Limited when one share is of 100 each. But as per the terms means when we are going to give you the purchase consideration, we are going to consider as if your equity share is commanding a value of 80 only. Is it clear to you? That is what we mean by that. Further, it is given that equity share will be issued by Y100 Limited by valuing its own equity shares of 100 each at rupees 120 per share. That means there are two things involved here. First of all, purchasing company is telling to the vendor company that your equity share means your total number of equity share is equal to, that is 15 lakh divided by 100. Your total number of equity share is equal to 15,000. Now we will consider your each share as equal to 80. So whatever amount will be there, for that we are going to issue you equity share. But how many equity share we are going to issue? Our equity share is having a face value of 120. This is what purchasing company is telling. Purchasing company is Y Limited. Y Limited is telling that face value of our share is 100. But to make the payment, to make this much of payment, we will issue our share at the rate of 120. This is the point which you need to understand. Is it clear to you? Equity share will be issued by Y100 Limited by valuing its each equity shares of 100 each at rupees 120. At rupees 120. Further here it is given 11% preference shares of X9 Limited will be given debentures of 100 Limited at equivalent value. Now in this case, there are preference shares of X9 Limited and they will be given debenture holders of Y Limited at equivalent value. At equivalent value means, for example, our preference share capital, 11% preference share capital is having a value of 5 lakh. So of equivalent value, that means 5 lakh worth of debenture we will issue you. Is it clear to you or not? In this question, we are supposed to compute the purchase consideration. Now you can see in this particular question, of obviously purchase consideration is not given. At the same time, nowhere it is given that balance is to be paid in so and so manner. Nowhere it is written. So we cannot use net asset method. Number one. Number two, intrinsic value of method application is also not given. So we will have to use net payment method. Moreover, when you are going to do one or two questions of net payment method, immediately you will be able to get an idea actually that this question is of net payment method, because here the language is entirely different. And here it will be given that a particular party is being what we call given so much of payment. So it is quite easy, not very difficult. But 2-3 points in this regard one need to take care of. We will come over to that. But first of all, let me solve this particular question. No space. Anyway, I will solve this question here itself. This is 7.1. Isn't it or not? 7.1. In 7.1, we have to compute only the purchase consideration. First, I am orienting you only with respect to computation of purchase consideration. Remember one thing. In order to compute the purchase consideration, under net payment method, calculation of purchase consideration. First of all, let me write here. In order to compute the purchase consideration, under net payment method, what we are supposed to do? First of all, I am going to take into account the party. Whenever I say party, it means party of the acquiring entity to whom payment is being made. There may be different parties, for example, equity shareholder, for example, preference shareholder, for example, even debenture holder can receive some payment, even creditors, bills payable, etc. Any party can receive the payment. So party. Then I will take into account the amount which they are receiving. Which party of the acquiring entity is receiving the payment? How much payment they are receiving, and in what form they are going to receive the payment. These three questions I am going to toss. Is it clear to you? For example, when I went through the first line, immediately it should click to me that payment is being received by equity shareholders of the acquiring entity. So equity shareholders are receiving the payment. First of all, we must also know how many number of shares they are having. As per the balance sheet given to us of X9 Limited, that is acquiring company, they are having 15 lakh worth of share capital, as I also told you, and one share is of 100 each. That means they are having 15,000 shares of 100 each. However, how much amount they are going to receive? They are going to receive, it is given in the question that for the purpose, their share has been valued at 80. That means they are going to receive how much? 15,000 into 80 will be equal to 12 lakh. So they are going to receive 12 lakh worth of payment. And it is given in the question that in order to make a payment of 12 lakh, the purchasing company is going to issue its own equity shares. That means this payment is being received in the form of equity shares. In the form of equity share. And just to elaborate the point, in order to pay 12 lakh, it was given in the question that purchasing company will issue its own share of 100 each, but at the rate of 120. But at the rate of 120. That means in order to discharge 12 lakh, we may say that purchasing company will offer, because it will be equal to 10,000. So purchasing company will offer 10,000 shares of rupees 100 each, at the rate of 120. We may say so in this manner. Is it clear to you? So purchasing company is going to actually issue 10,000 shares of rupees 100 each at the rate of 120 to discharge the what we call claims of the equity shareholder. That is 12 lakh. So equity shareholder are being given a payment of 12 lakh, and the payment is being given in the form of what we call equity share. Is it clear to you? Under the third point in this question, because first 2 point was related to this, and under the second point, it was given that payment is being given to preference shareholder, 11% preference shareholder. If you will look into the balance sheet, you will find that there are 5,000 preference shares of rupees 100 each, and their amount is 5 lakh. Their amount is 5 lakh. And it was given in the question that preference shareholders of the acquiring entity will be discharged by issue of debenture for equivalent amount. That means these 11% preference shareholder will be given same amount, 5 lakh, but they will be given this by way of issuance of debentures. So you can see that under this particular method, all we have to do is to simply take into account the payment received by the shareholder. So in this case only this much is given. So I would say that purchase consideration is equal to 17 lakh. In this case, I would say purchase consideration is equal to 17 lakh. In this question, we are supposed to compute only the amount of purchase consideration. Remember one thing. Is it clear to you or not? Yes, sir, absolutely clear. Now, if it is clear to you, then we can actually move a bit further. Now we can move over to question number 7.2 to understand the greater intricacies which are involved with this particular method. Correct? So, now we move over to question number 7.2. Where is 7.2? Here it is 7.2, and now you will get a better idea regarding the entire comprehensiveness of this particular method. In this question, please pay attention. First of all, we are given equity share capital, 5,000 equity share. This is balance sheet of Early Limited given. Balance sheet of Early Limited as on 31st of 3 so and so is given to you. And in this case, we have equity shares and preference shares. Besides that, we have got 3 liabilities in this particular case, and these 3 liabilities have been written in bold format. 10% debenture, creditor, staff provident fund. Is it clear to you or not? Yes, sir. Further, we are being given what we call 3 asset, fixed asset, current asset, and cash. 3 liabilities are also there. Correct? Further, it is given Late Limited agrees to take over all the asset excluding cash. Late Limited is taking over all the asset, but Late Limited is not taking over the cash. So in this case, cash is not taken over and rest of the assets have been taken over. Further, it is given and all liabilities. So purchasing company is taking over all liability except debentures. As per the direction of the question, Staff Provident Fund is not a free reserve or not any particular reserve. Rather, it is a liability. Is this clear to you? So, Staff Provident Fund and creditors have been taken over. However, question is very clear that debentures of this particular entity haven't been taken over. Further, it is given as per the terms of the agreement, acquirer company shall discharge the amount of purchase consideration through. Now, see here. Through issue of 15 equity shares of 10 each at par for each equity shareholders of acquiring entity. Purchasing company will issue 15 equity shares of rupees 10 each, at par for each equity shareholder of acquiring entity. What does it mean? Later on, when I am going to compute the amount of purchase consideration, how I am going to compute the amount of purchase consideration? I will simply tell you, first of all, write the equity shareholder, because this payment is being received by the equity shareholders, correct? And we can see in the balance sheet that equity shares is equal to 5,000. First of all, you write the number of equity share 5,000. Now go through this line. Issue of 15 equity shares of 10 each at par for each equity shareholder of acquiring company. That means purchasing company this time is issuing 15 equity shares of rupees 10 each, for each shareholder. This is very important. For each shareholder. That means if you are equity shareholder of acquiring entity and you are having one share, then we are offering you 15 share. Do you remember how this ratio 1:15 would have been arrived at? Through calculation of intrinsic value of shares. Is it clear to you? So anyway, so for one share you are getting 15 share. That means there are total 5,000 share. Each share is getting 15 share. If I am going to divide 5,000 by 1 and multiply it with 15, it will tell me how many shares actually we are going to offer you. So 15 into 5 is 75. That means 75,000 shares are going to be issued by the purchasing company to the equity shareholder at par. So amount is equal to 7,50,000. So this is the amount which equity shareholder will receive, and this amount is being received by way of equity shares. Is that clear to you? Now second point says that issue of 30 equity shares of 10 each. Purchasing company is going to issue 30 equity shares of 10 each at 20% premium. For every 4 preference shareholders. At least after having gone through this particular line, you should now get a clue actually that payment is being received by the preference shareholder. So what I will do now, I will note down the number of preference share as I told you first of all. So 4,000 is the total number of preference shares. And now it is given in the question that preference shareholders are being given 30 equity share. They are being given 30 share of rupees 10 each at 20% premium. In this case, the equity shares are being given to the preference share, but one share of 10 each is being issued at the rate of 12, that is 10 plus 20% at 20% premium. One share of 10 each at 20% premium. Correct? So there are 4,000 shareholders, and in this question it is given they are getting 30 shares for every 4 preference share. For every 4 share means every 4 preference shareholder will receive 30 equity share. If you are one of the preference shareholder of the acquiring entity and you are having 4 preference share, you will receive what we call 30 equity share. So in this case, I may say that for 4 share, you are getting 30 shares. So all in all, it will be equal to 1,000 into 30. So that means 30,000 equity share we are offering to the preference shareholder, but at the rate of 12. So purchase consideration will be equal to 3,60,000. Purchase consideration will be equal to 3,60,000. And this time, this payment, even though this payment is being received by the preference shareholder, but this payment is also in the form of equity share. I have already told you, payment received by shareholders only will constitute the amount of purchase consideration under net payment method. So 11,10,000 will become your purchase consideration without an iota of doubt. However, in this particular question, some more information is given. Just to confuse you, here it is given that issue of such an amount of 15% debenture at par. Issue of such an amount of 15% debenture at par, so that 10% debentures of acquiring company could be discharged at 20% premium. Now this is a little bit tough. I will make it a little bit simple. I will simplify it. However, I have come to the conclusion that at least this much I can derive that this payment is being received by the debenture holder. Now, in this case, there are 10% debenture holder to the extent of 2 lakh in the balance sheet. So, this payment is being received by the debenture holder. I will write here debenture holder. What is the meaning of this particular line here actually? In fact, what is the implication of this information? Total worth of debentures of vendor entity is, when I say vendor, it means acquiring entity, is 2 lakh. Correct? Issue of such an amount of debenture, 15% debenture, so that 10% debenture, these are 10% debenture, so that 10% debenture of acquiring company could be discharged at 20% premium. Suppose if I add 20% premium to it, it will become 2,40,000. 2,40,000. It means debentures of vendor company are being paid rupees 2,40,000, no doubt about that. In order to discharge the debentures of the acquiring entity at 20% premium, purchasing company is issuing 15% debenture. 15% debenture, and purchasing company is issuing the debenture at par. At par. If suppose I am going to divide 2,40,000 by 100, that means purchasing company will issue 2,400 debentures of 100 each to discharge the debenture holder. But this is a party other than the shareholder. I have already told you, if a party other than shareholder will receive the payment, we are not going to make it a part of purchase consideration, number one. Number two, now we will presume that even debenture holders have been taken over. Now, what is the replication of this line that we shall presume the debenture holder have been taken over? Pay attention. For example, later on when I am going to draw the realization account, I have already told you that all the liabilities, whether taken over or not, will be posted to the credit side of realization account. So many times I have already told you. So when we will prepare the realization account, I will transfer all the liabilities, debenture, creditor and staff provident fund to the credit side. This I have already told you. Correct? However, I have also told you, if a particular liability hasn't been taken over, then it is the duty of the acquiring entity to pay off that particular liability. Logically, in this particular case, debentures haven't been taken over. So later on, I would have had paid the debenture holders. But now, because debenture holders are receiving some payment, pay attention. Now debenture holders are receiving some payment and debentures are not being made part of purchase consideration. So if a party which is receiving the payment but not made part of the purchase consideration, then it will be presumed that that particular liability has been taken over irrespective of any contrary information given in the question. For example, in the question it is given debentures not taken over. But in spite of that, now we will be forced to think that these debentures have been taken over and now we need not require to pay them off. That is the replication of this particular line, that now you are going to presume that this particular liability has been taken over. Is it clear to you or not? So we shall presume now debentures have been taken over. Number one. And now because these debentures have been taken over and they are being made payment also, so later on in the books of acquirer entity, after having taken over, we will also make a payment for the same. Now I will explain all these points to you. So this is the what we call question. Let me have a good look over the question so that I should not forget any figure. In case if I will forget, I will look into the question. So I have already computed the purchase consideration. I will simply tell you now how I am going to do the accounting in the books of acquiring entity. Correct? So books of acquiring entity, for that I write here books of acquiring entity. And then I will do the accounting in the books of acquirer also. Is it clear to you? We know that in the books of acquiring entity, generally we have to prepare these accounts. One is realization account, isn't it or not? So I will prepare realization account 1. Besides realization account, we prepare cash account. We prepare cash account also. And besides that, we also prepare equity shareholder account. So I'm writing here equity shareholder account. But in this particular question, anyway, first let me write. These are the accounts which we normally prepare. Equity shareholders. Generally, we prepare these accounts. Besides that, we also prepare acquirer companies account, isn't it or not? Acquirer companies account. Acquirer companies account. But because in this particular question, leave that. Acquirer companies account, actually there was Korea guy, that's the reason. Acquirer company account, and by this time when I hold your class, actually the staff generally moves out, so sometimes it becomes difficult to handle both the things. Leave it. I will do it. Acquirer companies account, and then I will have to prepare the preference shareholders account also. Preference shareholders account. Preference shareholders account. Is it clear to you or not? So first of all, because very small balance sheet was given to us, we look into the balance sheet, look into the item and try to post them. Is it clear to you? Books of acquiry company I am talking about, we are now doing the things. In order to do the things in the books of acquiry company, first of all, what I am going to do, I am going to transfer all the asset to the debit side of the realization account. In this question, I have kept only 3 assets. Fixed asset, that is 3 lakh, I think so. See, even though if I will commit any mistake in writing a particular figure, you do it automatically, because my point here is to quick fire. I want to actually explain the concept. Current asset were also there 4 lakh. All the assets are transferred to the debit side of realization account, irrespective of the fact whether taken over or not. There is cash balance also. In this particular question, cash hasn't been taken over, as you know, isn't it or not? Now, what is the balance as far as cash is concerned? I think it was 3 lakh, so I am going to write here 3 lakh. Now we move over to the liability side. In the liability side, we have got in this particular case equity share capital. As you know, equity share capital will be posted to the credit side of equity shareholders account. So I am going to write here by equity share capital. Amount is equal to 5 lakh. Amount is equal to 5 lakh. Besides that, in this particular question, in the balance sheet of acquiring entity, we are having preference share also. So I will be writing here preference share capital. Preference share capital is equal to 4 lakhs. So I am going to present here 4 lakhs. Is it clear to you? Then in the balance sheet, there is reserve fund also. So reserve fund, I am going to transfer to the credit side of equity shareholder account. Because equity shareholder are the real owners, so all the reserves and surplus will be transferred to them. Besides that, there are 3 liabilities in this particular question. So 3 liabilities in this particular question. I have already told you and told you several times now, all the liabilities will be posted to the credit side irrespective of the fact whether taken over or not. So 2 lakh worth of debenture will be posted here. Even though debentures haven't been taken over, creditors have been taken over, we are posting here. And staff provident fund. The staff provident fund is equal to 1 lakh. So after finishing down the closure of what we call assets and liability side, first of all, I am going to pass the entry for the purchase consideration due. The entry will be acquired company account debit to realization account. On the credit side of realization account, I will be writing by acquirer entity. By acquirer company. PC, purchase consideration. We computed purchase consideration, it was 11,10,000. When we computed purchase consideration, here we computed, yes, it is 11,10,000, isn't it or not? So 11,10,000 is the amount of the purchase consideration. The total of payment received by the shareholders, equity and preference. Then we are going to take it to the debit side of acquirer company account. Over there, I am going to write here to realization 11,10,000. Now we are going to receive the amount of the purchase consideration. as we know, this 11,10,000, even though this payment has been given to equity shareholder and preference shareholder, but as far as form of payment is concerned, we have received the entire payment by way of equity shares only. So on the credit side of acquirer company account, I am going to write, first of all, buy equity shares in acquirer company account. Equity share in acquirer company account. Entire payment is being received by way of equity shares. 11,10,000. Now here, please don't commit this mistake. Of course, this account will get closed now. First of all, we will close this account. This account is closed. Now, I have told you several times that if you receive any portion in cash, you will transfer it to the cash account, although in this particular question, no cash is being received. I have also told you that besides cash, if you are going to receive in any mode, then you must transfer it to shareholders. And here you have to be careful, because this time, this payment 11,12,000 is not in its entirety received by the equity shareholder. Some portion of 11,10,000 has been received by the equity shareholder and some has been received by the preference shareholder. So out of 11,10,000, how much has been received by equity shareholder? Only that portion you are going to transfer here. So I will write here equity shares in acquirer company account. Equity shares in acquirer company account. Equity shares in acquirer company account. How many or what portion of 11,10,000 we have received? 7,50,000. Out of 11,10,000, 7,50,000 worth of consideration was flowing towards the equity shareholder. So we have transferred it to the debit side of equity shareholder. And likewise, out of 11,10,000, some portion is going towards the preference shareholder. So I am going to write here equity shares in purchasing company account or in acquirer company account. We'll write acquirer only. In acquirer company account. And 3,60,000 worth of payment. 3,60,000 worth of payment. Correct? In the form of equity shares is being given to the preference shareholders. Is it clear to you or not? Right, sir? It is absolutely clear. If it is absolutely clear, again, a great amount of caution you need to know. You need to exercise, and which you need to know which sort of caution it is. If you are preparing the preference shareholder account, please pay attention. All these things which I am talking about, I have already written in the notes. In your solution, you have that, but please pay attention. If preference shareholder are going to receive any payment, or should I say, if any portion of the total purchase consideration is flowing towards the preference shareholder, and if you have posted it, which we have done, then immediately after that you close down this particular account. You close down this particular account. That is important point. So I will close it, and whatever balance will be there, that will be posted to realization account. Actually, what happens? Purchasing company gave 3,60,000 for payment of preference shareholder to the acquiring entity. Now, acquiring entity will discharge what we call its purchase consideration. Now, logically, preference shareholders of acquiring company were supposed to be paid 4 lakh, but now actually acquiring company is giving them only 3,60,000 in full settlement. Technically, it is a gain to the acquiring entity. Is it clear to you? So, whatever balancing figure will be there, that balancing figure, because you have written here to realization, you are going to write it over here to preference shareholders. This preference shareholder, how you actually found out this figure, that is through preference shareholder, and it is considered as a sort of gain to the acquiring entity. Because liability of the acquiring entity was 4 lakh, and technically now acquiring entity is discharging this consideration because they have received the consideration from the purchasing company, and now they are discharging their preference shareholder at 360, so it is a gain to them. That is why I am telling that whenever in the question there will be preference shareholder of acquiring entity, number one, acquirer company account will get closed, and you will have to close this account. The moment you are going to post the portion of the purchase consideration received by preference shareholder, correct? The moment you are going to post it in the preference shareholder account, immediately you have to close it down. Is it clear to you? And whatever balance will be there, that will be posted to the realization account. In this case, actually, it is again, I have written it towards debit side. I'm sorry. While talking, I did not notice that credit side is here. So by preference shareholder 40,000, I am going to write here, not towards the debit side. So this is the point which you need to understand. Is it clear to you or not? Now, after the purchase consideration in this particular question, all the assets, these two assets which we have posted here have been taken over. So we need not require to sell any assets. Out of these three liabilities, it is clearly given in the question that these two liabilities have been taken over. It is clearly given in the question. And because debentures are now being given some payment by the purchasing company, we are presuming that even debentures have been also taken over. So in this question, I need not require to pay off what we call debentures. Is it clear to you or not? And in this question, there are no expenses. So now I will simply tally this account to get what we call my loss or profit. In order to tally it, so credit side seems to be bigger by 4,50,000. So 4,50,000 will be your profit. Obviously, this profit will be transferred to equity shareholders account. Profit transferred to equity shareholder. We are going to transfer this profit to the equity shareholder account. Is it clear to you or not? Now in the equity shareholder account, I am going to write by realization account. 4,50,000. 4,50,000. Now we are going to prepare the cash account also. Because in this question there is no other information with respect to cash, I am going to tally this. So whatever balance is there in the cash account, that is always transferred. So on third account, we close down realization account. After that, I will close the cash account in this particular question. And whatever balance will be there in the cash, that will be taken towards equity shareholder account, isn't it or not? And then on the debit side of the equity shareholder account, obviously I'm going to write here I have written buy, so I will write here to cash 3 lakh. An equity shareholder account will now get tallied of its own, 10,50,000 and 10,50,000. Is it clear to you or not? So after this, we can also prepare or do the accounting in the books of acquirer entity to make you understand a little bit better. Acquirer entity. Now, as far as acquirer entity is concerned, as usual, acquirer entity has taken over fixed asset. So asset taken over. It has taken over fixed asset. Of course, no revised values are given. We are presuming that whatever values given in the balance sheet itself is what we call fair value. And then I am going to write the current asset. Current asset in this case is equal to 4 lakh. I am going to write here 4 lakh. Besides that, we have taken over this time 3 liabilities, not 1 liability. It was given in the question that 10% debenture were not taken over. But now we are presuming that debenture holders have been taken over. Number 1. And here extreme amount of caution you need to apply. Because the value of the debenture given in the balance sheet is 2 lakh. But how much payment you are making to the debenture holder, which we computed 2 lakh plus 20% premium. It was near about 2,40,000, isn't it or not? So at what value you are taking over this liability, that is of paramount importance, and this is the value at what you are going to reflect 10% debenture. Debentures, now you have presumed that you have taken over because you have now committed to the debenture holder that we are going to pay you 2,40,000. So you will reflect the debenture at 2,40,000. Is it clear to you? Now, next point is creditors. Creditors in the question were 1 lakh. Creditors in the question were 1 lakh. You are going to write here 1 lakh. Besides that, there is staff provident fund. These are the three liabilities. Staff provident fund amount, I have forgotten. I think it was equal to 1 lakh. And then I am going to write here to consideration. The amount of consideration was 11,10,000. In this question, if I am going to balance it out, there will be what we call goodwill. There will be goodwill balancing figure. 4 lakh worth of goodwill. You are going to write here. 4 lakh goodwill. Is it clear? After this, what you are supposed to do now, after this, you will pay the consideration. Obviously, when you will pay the consideration, you are supposed to pay 11,10,000. You are supposed to pay 11,10,000. Then you are going to write here 2. Equity share capital. Some portion, in fact, you are issuing only equity shares. No doubt about that. I have already told you, let me come over to that particular solution. Right. I already told you in the initial stages itself, if you remember, in the initial stages itself, I told you, see here, purchasing company is issuing for 1 share 15 share. That means total number of equity share issued is 75,000. And 2 preference shareholder, every 4 preference shareholder received 30 share. That means 4,000 divided by 4 is 1,000, 1,000 into 30, 30. That means total number of share which we have issued is 75,000 plus 30,000. That is equal to 1,05,000. Is it clear to you? Total number of equity share issued 1,05,000. Face value of share of equity is 10. So 10,50,000 I am going to write here. However, out of this 1,50,000 share, 30,000 share which we issued to preference shareholder were at the rate of 12. So that means there is some security premium, and security premium is not on 1,05,000 share. It is only on 30,000 share. Out of 1,05,000 share, 30,000 shares which were issued to the preference shareholder were at the rate of 12. So you are going to write 30,000 into 2, that is equal to 60,000. This is the entry you are going to write. And the point which I was trying to tell you, if a party other than shareholder would receive any payment, if a party other than shareholder would receive any payment, number 1, we are not going to make it a part of purchase consideration. However, number 2, we shall presume that this liability has been taken over. So at whatever value you have taken over, you have already recorded it in your first entry. Now, it is also your bounded duty to pay it off. And when you will pay it off, you will write it in this manner. 10% debenture account debit, because you have taken over the debentures. And debentures you have taken over at 2,40,000, correct? So you will write same value here, 2,40,000. 2,40,000. And you have discharged these debenture by issue of your own 15% debenture account. So you will write 15% debenture account, 2,40,000, because you are issuing your own debenture at par. So you will simply write this entry. This is the point I just wanted to bring to your notice, because so often during the what we call next level of questions, lots of questions from this particular topic have also struck up in the examination, which we are going to discuss in the next session. Quite last time we had finished till up to 7.2, and we were discussing the net payment method, if you remember, correct? And while leaving the last session, I did tell that we are going to pick up question number 7.3 to begin the session for the day. So here we go and start this particular session, and just waiting for the green signal for those who are connected with us from what we call sales system. So in the meanwhile, we will mark out 7.3. So 7.3, net payment method we were discussing, if I remember. Well then, we have the green signal. Lovely good evening once again to those who have just connected with us now. And 7.3 is the question which we are picking up to begin the proceedings of the day. So kindly actually open down your 7.3 question so that we can begin the, as I said, session. So here in this particular question, it's a strong question. Z Limited took over the business of X Limited and Y Limited. So very first line states that this time there is Z Limited, and Z Limited is picking up the business of X Limited and Y Limited. So Z Limited is the acquirer entity, and both these entities will be considered as acquiree entity. Now, the balance sheet of all these three entities is also given to us, and wherein we find that figures are in lakhs, and you can see their share capital is 1000 lakhs, 800 lakhs and 750 lakhs. Further, we are given preference share capital. No preference share capital of Z Limited. Preference share capital of X Limited is 300 and of Y Limited is 200. Then we have reserve and surplus. However, no revaluation reserve for Z Limited, but X Limited and Y Limited are having a revaluation reserve. General reserve 600, 170 and 150. Coming over to profit and loss account, again Z Limited is not having any profit and loss account, but both these companies are also having profit and loss account. Coming over to 10% debenture, 10% debentures of 100 each. Z Limited, the purchasing entity right is Z Limited, is not having any debentures, while the debentures of both these companies are 60 lakhs and 30 lakhs. Correct figures are in lakhs. Then current liabilities, sundry creditors 400, 270 and 120. And bills payable, no bills payable for Z Limited, but bills payable for X Limited and Y Limited given to you. Now, coming over to the asset side, land and building we are given. Besides that, we are given plant and machinery 400, 350, 250. As far as investment are concerned, no investment for purchasing unit, acquirer entity, but investments of acquiring entities are given. Then stock, then we have sundry debtors, and then finally, bills receivable, no bills receivable for Z Limited. X and Y Limited are having 50-50 worth of bills receivable. Cash at bank 200, 300 and 200. So this is the information furnished to us. Now we move a bit further. Here in the very first line, which needs a little bit of explanation also, it is given that 10% debentures of X Limited and Y Limited. We just saw 10% debentures of X Limited and Y Limited as 60 lakhs and 30 lakhs. 60 lakhs and 30 lakhs are 10% debentures of X and Y Limited. Now question below states that debenture holders of X Limited and Y Limited are discharged by Z Limited, issuing such number of its 15% debentures. So in order to discharge the 10% debentures of the respective entities, Z Limited, the purchasing unit, as you can see, is actually issuing 15% of its debenture, and it is issuing the debenture in such a manner so as to maintain the same amount of interest. What exactly the replication of this particular line, in order to make you understand that, let me create a bit of a space for me so that I can look into the question simultaneously. Well then, so here we go and start the explanations for all these points. This is your 7.3 question, as I just told. In order to solve 7.3 question, first of all, we are trying to find out what worth of debenture purchasing company Z Limited is going to issue to X Limited and Y Limited. So the first point deals with issue of debentures, issue of 15% debentures. What worth of 15% debenture purchasing unit should actually issue to the acquiring entity X Limited and Y Limited so as to maintain the same amount of interest? So what does it mean and how we are going to compute it all? Just pay attention over here. Suppose if I am going to ask you, first of all, let me know the 10% debentures which are given in the balance sheet of the respective entities. Obviously, you are going to tell me, sir, 60 lakh is the amount of debentures of X Limited, and 30 lakh is the amount of debentures of Y Limited. Now, my second question is, if you are the debenture holder of X Limited, at what percentage you are earning the income or interest? So their present interest or present income, we may say, of the 60 lakh worth of debenture at the rate of 10% must be equal to 6 lakh, isn't it or not? So in total, X Limited was paying 6 lakh worth of interest to its debenture holders. So the debenture holders are having an income of 6 lakh on 60 lakh worth of debenture. And likewise on 30 lakh worth of debenture, the debenture holders of Y Limited must be earning presently 3 lakh worth of what we call interest. Now the question states that in order to pay the debenture holders of X and Y Limited, purchasing company is issuing 15% debenture. And purchasing company is issuing 15% debenture in such a manner so as to maintain the same amount of interest. 15% debenture to maintain same amount of interest, or same interest. Now the major question is, what worth of debenture should I issue so that still the income or interest is equal to 6 lakh and 3 lakh? This is the actually issue. Now, in order to calculate the same, what we do, just pay attention. We know that your present income is 6 lakhs. The debenture holders of X Limited presently are earning an income of 6 lakh rupees. At the rate of 10%, their income is 6 lakh, which we have already seen. Just wait. Now we are issuing, the purchasing company is going to issue 15% debenture. 10% of 60 lakh is equal to 6 lakh. So 15% of what? What means the debenture? What worth of 15% debenture we should issue so that income is still equal to 6 lakh? That is the point is. So what worth of debenture we should issue so that still the debenture holder get what we call 6 lakh worth of interest. So this is how you can find out the figure of debenture. For example, the figure of debenture will be equal to 6 lakhs into 100 divided by 15, and that comes to 40 lakh. That means purchasing company is going to issue 40 lakh worth of debentures, 15% 40 lakh worth of debenture, so that the debenture holders of X Limited still get what we call 6 lakh worth of interest. This is the point. So in this question, we may say that purchasing company is issuing 15% debenture worth rupees 40 lakh to the 60 lakh worth of debenture holders of X Limited. Indirectly, it also means that purchasing company is taking over the debentures of X Limited worth 60 lakh only at 40 lakh because we are issuing 15% debenture. And if I am going to compute 15% of 40 lakh, that will be equal to interest. So interest will still remain the same. Is it clear to you? Similarly, we can compute the number of, worth of debenture which the purchasing unit is going to issue to the debenture holders of Y Limited. So presently the income of Y Limited, as we saw earlier, is 3 lakhs. So 15% of what worth of debenture should I issue so that interest income remains 3 lakh? So I can compute again. So that is 3 lakh into 100, divided by 15, and that will be equal to 20 lakh. So that means to the debenture holders of Y Limited, purchasing company is going to issue 15% rupees 20 lakh worth of debentures. Rupees 20 lakh worth of debenture. If you remember the discussion which we had in the last session, over there I stressed upon this particular fact that if a party other than the shareholder would receive any payment, that party will not be made as part of purchase consideration. However, you will have to presume as if now you are taking over that particular liability. So in this particular question, now you have to be careful that you are taking over the debenture of X Limited at rupees 40 lakh. It means now. Similarly, Y Limited's 30 lakh worth of debentures are being taken over only at rupees 20 lakh. And in order to pay them, you are issuing, as I told you, 15% debentures of this particular amount. Is it clear to you or not? So this is the point in this particular point. That is first point I mean to say. What about the second point? Let's move over to the second point. As far as second point is concerned, here it is given that preference shareholder of the two companies are issued equivalent number of 15% preference shares. Equivalent number of 15% preference share of Z Limited at a price of 150 per share, and face value is 100. First of all, let's have a look over the preference share capital. Preference share capital of X Limited is 300 lakhs and preference share capital of Y Limited is 200 lakhs. So after having noticed down the amount of preference share capital 300 lakhs and 2 lakh. Now and of course you will have to note down the face value of the respective companies, that is 100. So now we come over to the what we call explanation of this particular point. In order to explain this particular point, what I am supposed to do, this is point number 2 or point number B, whatever it is. Point number B. So here, given in the question that preference shareholder of the two companies will be given equivalent number of 15% preference shares. So 15% preference share we are going to issue to discharge the preference shareholder, 15% preference share. Again, in the one column I write X limited, and again I write Y limited. Now we have to compute what worth of 15% preference share capital we should issue to discharge the claims of what we call preference shareholders of X limited and Y limited. This time the calculation is not tough in comparison to the last one. First of all, I note down the present preference share capital as per the balance sheet. As we just saw, the present preference share capital is equal to 300 lakhs and of course 200 lakhs. Isn't it or not? This is exactly what we saw in the question. We also saw that they are having a face value of 100. If I am going to divide it by 100, it will give me the number of preference share. So number of preference share of X limited at this particular moment, we may say is equal to 3 lakh. And likewise, number of preference shareholders of Y limited at this particular moment, we may say is equal to 2 lakh. Now given in the question that preference shareholder of the two companies are being given equivalent number of, that means same number of preference share. So worth of 15% preference share which will be issued by acquirer entity to discharge the claims of the preference shareholder will be equal to, say here, because it is given that equivalent number of preference shares are being given, that means purchasing company is going to provide 3 lakh worth of 15% preference share capital to the preference shareholders of X limited, equivalent number. However, it is stated in the question that purchasing company is making the payment at the rate of 150. Face value of preference share of purchasing company is 100, but it is issuing its preference share at the rate of 150. So that is how I am going to compute, and it will be equal to 450 lakhs. So 450 lakh worth of preference shares we are going to issue to the preference shareholders of X limited. Similarly, equivalent number of preference share for Y limited will be equal to 2 lakh, and because preference shares are being issued at the rate of 150, I am going to multiply it with 150. That will deliver me the amount of 15% preference share which would be issued by purchasing unit to Y limited. That will be equal to 300 lakhs. I think so. So 300 lakhs. So this is how we have computed the amount which will be given to the preference shareholder, 450 lakhs and what we call 30 lakhs. Is it clear to you or not? Now we can come over to the next point as far as this particular question is concerned. As far as next point is concerned, that is related to payment to equity shareholders. Now we can see here, it is given in the question that Z Limited will issue 5 equity shares for each equity share of X Limited. As per this particular information, it is given that as far as X Limited is concerned, purchasing company is going to issue for one equity shareholder, purchasing company will issue 5 equity shares. Jet Limited will issue 5 equity share for each equity share of X Limited, that is given to us. Further, it is given to us as far as Y Limited is concerned, 4 equity shares for each equity share of Y Limited. As far as Y Limited is concerned, for one share, purchasing company is issuing 4 equity shares. And the issue price of the share will be, the shares are to be issued at rupees 30 each, having a face value of 10. However, purchasing company will issue its equity share carrying a face value of 10 at the rate of 30. So point is this, that as far as X Limited is concerned, for one share we are issuing 5 share at the rate of 30, and for Z Limited we are issuing 4 equity share at the rate of 30. So now we can compute the what we call amount of equity share which will be issued by purchasing company. Is it clear to you or not? This is our point number C. So in order to understand this particular point, so this is equity shareholders. This is payment to equity shareholders. Isn't it or not? Equity shareholders. Issue of equity share, in fact. Let me write. Issue of equity share. So what worth of equity share we should issue? Issue of equity share. In order to compute the same, once again I write X Limited and Y Limited. So first of all, let us have a look over the what we call equity share capital of the respective companies. So as far as equity share capital is concerned, in the question we saw that equity share capital of these two companies is equal to 800 lakhs and 750 lakhs, correct? Now, first of all, I write equity share capital equal to 800 lakhs. And then I write 750 lakhs, 800 lakhs and 750 lakhs. One equity share is of rupees 100 each as it is given in the balance sheet. So we may say that number of equity shares of the respective companies is equal to 8 lakhs and 7,50,000. So we have computed the number of equity shares. So now the next point is Z Limited shall issue equity shares. Z Limited shall issue equity share. Now see here, total number of shares of X Limited is 8 lakh. And it is given in the question that for one equity share, purchasing company is issuing 5 shares. So all in all, we may say that purchasing company is issuing 40 lakh equity shares, and shares are being issued at the rate of 30. So 40 lakh into 30 will be equal to 1,200 lakhs. Is it clear to you or not? So I will write here 1,200 lakhs. If I am not wrong, 1,200 lakhs. So in order to pay the equity shareholders of X Limited, purchasing company will issue equity shares but 1,200 lakhs. And in order to issue equity shares, as far as number is concerned, every equity shareholder of X Limited will get 5 shares. That comes to 40 lakh. 40 lakh into 30 is equal to this much. Similarly, number of share of Y Limited is equal to 7,50,000. It was given in the question that each shareholder will get 4 equity share. I will write here 4. And if each shareholder is going to get 4 share, indirectly it also means 750 into 4, 30 lakh worth of shares we are going to issue. And we are going to issue the shares at the rate of 30. So that will be equal to 900 lakhs. So we have computed the payment which is being given to the preference shareholder and equity shares. Is it clear to you or not? What else is given in the question? Let's have a look over here. Now, prepare the balance sheet of Z Limited on 1st of April in the Schedule 3 of Division 2. Only rest of the things as far as is concerned we are supposed to do is to prepare the balance sheet. But in order to prepare the balance sheet, obviously we will have to do something else also. For instance, now in the next step, I am going to compute the purchase consideration because we haven't computed the purchase consideration still. So I am going to compute the purchase consideration. In order to compute the purchase consideration, see here what I am going to do. Step number D, calculation of purchase consideration. It is a pretty strong question, long question, no doubt about that. But now because this time Z Limited is acquiring 2 entities, One is X Limited, another one is Y Limited. So first I am going to compute purchase consideration with respect to X Limited. First I am going to compute the purchase consideration with respect to X Limited, correct? Okay. Now in order to compute we have already computed the purchase consideration. Now we are just simply summarizing the same. We know that purchase consideration means the payment given to preference shareholder and equity shares only. Payment given to preference shareholders and equity shares only. Because the payment which is being given to the debenture holder will not be what we call considered for the computation of the purchase consideration. So as far as equity shareholders of X Limited are concerned, we just computed that we are making a payment of 1,200 lakhs. Now I am writing here in lakhs figure because otherwise it will consume lots of space. So rupees in lakhs. We just computed here, see, 1,200 lakhs worth of equity shares we are issuing to X Limited. So payment to equity shareholders of X Limited is equal to 1,200 lakhs. And this payment is being given by way of issue of equity share. So form of payment is equity share. Second point is with respect to preference shareholders. Now I write here preference shareholders. As far as preference shareholders of X Limited are concerned, we made them a payment of 4,50,000. If you remember here, I have written, correct? 4,50,000 worth of payment. We have issued 15% preference share to make the payment. So 450 lakh worth of payment is being given to the preference shareholder of X Limited. And this payment was made by way of issue of 15% preference shares. So if I am going to total it up, it will let me know the amount of purchase consideration with respect to X Limited. So it is equal to 1650. So 1650 lakhs, of course, is the purchase consideration for X Limited. Likewise, under step number D itself, now we are going to take into account Y Limited. We will consider the equity shareholders of Y Limited. As far as equity shareholders of Y Limited are concerned, we made them a payment of 900 lakh. Here I have written, correct, 900 lakh. So 900 lakh I am going to write 900 lakhs. And this payment was by way of issue of equity shares. Then second, to the preference shareholders. As far as preference shareholders of Y Limited are concerned, we made them a payment of 300 lakh. We issued equivalent number of 2 lakh share at the rate of 150, that is 300 lakhs, sorry. So I'm going to write here 300 lakhs. And again, this payment is by way of issue of 15% preference shares. Now I'm going to total them up to get 1,200. 1,200 lakhs will become the purchase consideration as far as Y Limited is concerned. Is it clear to you or not? Right, sir, till up to this particular point, everything is clear. Once this particular point is clear, the next step is that we are supposed to, in fact, question has simply asked you to prepare the balance sheet of the what we call acquirer entity. In fact, you are supposed to prepare the balance sheet. Now, the next step is, but just to make you understand a little bit better, after this particular step, instead of moving over to the preparation of the balance sheet, what I did, see here, under the next step is step number E. Instead of, as I told you, instead of going for the balance sheet, I simply went for the journal, just to make you understand better. Correct? So journal of acquirer entity. Acquirer entity, that is Z Limited. Acquirer entity. Now, under entry number 1, first of all, let me write here entry number 1. Under entry number 1, as you know, we are the acquirer entity, but before we start writing the entity, because we are dealing with 2 entities, let me write here, it is our transaction with respect to X Limited. That means, first of all, we will take into account all the assets and liability of X Limited, which we have taken over. So, as far as X Limited is concerned, we took over their land and building, and land and building given in the question was 550 lakhs. All the figures are in lakhs. So I will write here 550 and so on. All the assets which we have taken over. In fact, we have taken over all the assets. Then I am going to write plant and machinery. Plant and machinery is equal to 350 lakh. I am going to write 350 lakh. After the plant and machinery, we took over the investment of X Limited. There is no investment of Jet Limited, but we took over the investment of X Limited. And investment of X Limited is 150. Besides that, there are list of current asset, stock. As far as stock is concerned, stock is appearing at 350. I will write 350. Besides that, debtors are also appearing. So I will write debtors. Debtors is equal to 250. Then I will write bills receivable. Bills receivable of X Limited is equal to 50. I am going to write 50. Then I am going to write cash. As far as cash is concerned, that is equal to 300. So all these assets have been taken over by us. Now I am going to write the liabilities. When I am going to write the liabilities, obviously I am going to write 10% debentures. 10% debentures of X Limited were appearing in the balance sheet at 60 lakh. But at the same time, we made them a payment of only 40 lakhs. That means 60 lakh worth of debentures have been taken over at 40 lakh. This is the point which you need to take care of. Is it clear to you or not? At what value you are taking over the liability? Similarly, there are creditors, so you are going to write the creditors. Amount of creditor is equal to 270. Then I am going to write there is another liability in the form of bills payable, which is equal to 150 lakh. I will write to bills payable. Then I am going to write consideration. Consideration, as we just computed with respect to X Limited, is equal to 1650. 1650. Obviously, after this, you are supposed to compute the amount of goodwill or gain on bargain purchase. Now, somebody among you should let me know what is the amount of goodwill or what we call gain on bargain purchase. It is pretty difficult for me to do the calculation. Let me see who does the quickest. Yeah, first reply I got from what we call Ghatkopar, Mumbai. This is Hari Krishna Hegde. Thank you so much. And he says it is goodwill, and amount of goodwill is equal to 110 lakhs. So we presume that calculation is correct, and on the basis of reply provided to us by Hari Krishna Hegde, correct, we are picking up this figure as goodwill. So goodwill we have got equal to 110 lakhs. Now we are going to pass the second entry. As far as second entry is concerned, this entry is related to what we call this entry is related to consideration, no doubt about that. Now I am supposed to pay the consideration. Consideration is 1650 lakhs. When I will pay the consideration to X Limited, I know that I am paying equity share capital and preference share capital. We have seen that we are making a payment of 1,200 lakhs to the equity shareholders. Do you remember here, just to make the point a little bit clear? See here, to X Limited, we are making a payment of 1,200 lakhs. I also told you for each shareholder, we are issuing 5 shares. That means purchasing company is giving 40 lakh worth of shares. Isn't it or not? 40 lakh worth of shares. But 40 lakh worth of shares were having a face value of what? Having an issue price of 30 and having a face value of 10. Face value of 10 of purchasing unit I am talking about. So I will have to mention here, we are issuing 40 lakh share, and the face value of share is 10. So that means 400 is the what we call nominal value of the equity share capital. And equity share capital we issued at a premium. So I am going to write to security premium. Because share was issued at the share of rupees 10 each was issued at the rate of 30. So premium will be equal to 40 lakh shares into 20. That is equal to 800 lakhs. This will be the premium. Similarly, we issued 15% preference share capital. As far as 15% preference share capital is concerned, as far as X Limited is concerned, equivalent number of share we issued. Now, preference share capital, 3 lakh shares we issued at the rate of 150. So here I am going to write 3 lakh into 100. 3 lakh into 100, that will be equal to 300 lakhs. And then I am going to again write security premium, and security premium amount will be equal to 3 lakh shares into 50, because preference share was issued at the rate of 150. So 150 lakhs. So this is how I am going to pass the entry for discharge of purchase consideration. Another entry you will have to pass, and that entry for taking over debenture, because you took over the debenture but you made them the payment. You are also taking over the rest of the liability, but you are not making them the payment. But it is given that you made payment to 10% debenture holders. So you will have to write another entry, 10% debentures. 10% debentures. You took them over at 40 lakhs. So you will write here 40 lakhs, first of all. Correct? And then you are going to discharge the same by issue of your 15% debenture. You issued 15% debenture to discharge the claims of the 40 lakh worth of debenture. Is it clear to you or not? So this is how you are going to pass the entry. But don't commit this mistake of writing here 60 lakh and writing here 60 lakh. Is it clear to you? This is important. At what value you are taking over, at that value you are going to present them, and then at the same value you are going to discharge the same. So these are the entries with respect to X Limited. And then we are going to pass the entries with respect to Y Limited, because we are taking over Y Limited also. That is why I told you this happens to be pretty strong question. Correct? Now, similar procedure we are going to apply. Our first entry will be with respect to the several assets which we have taken over. Land and building we took over at 400 lakhs. Similarly, we took over plant and machinery of Y Limited. Plant and machinery of Y Limited is equal to 250 lakh. We took over investments, and investments of Y Limited is equal to 50 lakhs. So I'm going to write here 50 lakhs. Besides that, we took over all the current asset stock appearing in the balance sheet at 250. I'm going to write 250. Besides that, we are taking over debtors also. So I'm going to write debtors. Debtors is equal to 300. So I'm going to write 300. And then bills receivable. Bills receivable of Y Limited is equal to 50. So I'm going to write 50, and cash balance is equal to 200. I am going to write 200. Correct? Now, I will write here to 10% debenture. We are taking over 10% debentures. Debentures of Y Limited are appearing in the balance sheet at 30 lakh. But we made them a payment of only 20 lakhs. So that means debentures, 30 lakhs worth of debentures have been taken over at 20 lakh. Correct? Then I am going to write two sundry creditors. Sundry creditor we are taking over at 120. So this is the point which you need to take care of. And then bills payable. As far as bills payable are concerned, 70 lakh. And consideration which we computed in respect of Y Limited. If you remember, 1,200 it was. Here we did the computation. 900 equity shares, 900 worth of equity share we are making a payment, and preference shareholders are being made payment worth rupees 300 lakhs. Total is equal to 1,200 lakhs. So I'm going to write here 1,200. So 1,200 lakhs worth of payment. Now again, in this question, somebody among you should let me know the amount of goodwill or gain on bargain purchase. It seems that there is gain on bargain purchase, but please let me know the figure. I'm not able to recapitulate it. Gain on bargain purchase. S. Ravi G from Chennai tells me, sir, it is 90 lakh. Should I take it as 90? Well, it is substantiated by another answer from Palwal. So 90 lakh is the gain on bargain purchase. Correct? Thank you so much. And now we are going to discharge the consideration. Consideration as far as 1,200 lakhs worth of payment is concerned. In order to make this payment, obviously we have issued equity shares and we have issued preference share. But we have issued equity share at a premium at the rate of 30. there are 7,50,000 worth of equity shares of X Limited, and for every share we issued 4 shares. And at that time also I told you it means we are offering 30 lakh share, 7,50,000 into 4. So here I am going to write into 10 at face value, that comes to 300. And security premium will be equal to 30 lakh into 20. 30 lakhs into 20. That will be equal to 600 lakhs. So I am going to write 600 lakhs. Is it clear to you? Then we issued 15% preference share capital. Equivalent number of preference shares of Y Limited were 2 lakh. So for 2 lakh preference shares, purchasing company issued 15% preference share but at the rate of 150. So I will write here into 100. So 2 lakh into 100, 200 lakhs. And again I will write security premium 2 lakh into 50 because preference share of 100 was issued at the rate of 150. Is it clear to you? So 100. So this is how I am going to pass the entry. And again, 10% debentures which you have taken over, and you have taken over them at rupees 20 lakh. And to discharge, you have issued 15% debentures. So this is the entry which you are going to actually write down in the books of the acquirer entity. After having what we call written the entries, then it becomes a little bit easier. Even without entries, you could have prepared the balance sheet, but just to actually make the point a little bit more clear, I thought this is the better way of making you understand. Correct? So now, in this particular question, I will prepare the balance sheet also. In order to prepare the balance sheet, for balance sheet, I will require a bit of a space. So I will create the space. And I will prepare the balance sheet somewhere here. Okay, I will prepare the balance sheet now. In order to prepare the balance sheet, first of all, I write assets. Under the asset, we always write first non-current asset. Now we will look into the column of Z Limited. I have already told you earlier that whenever we prepare the balance sheet, items of acquirer company would always appear as it is. So, as far as non-current assets are concerned, under the non-current asset, first I write property, plant and equipment. Under the property, plant and equipment, it is given land and building. Now, as far as land and building of acquirer entity is concerned, which is given to you as 600, then you took over, because we have just passed the entry, then you took over the what we call land and building of X Limited at 550 and of Y Limited at 400. So simply you will have to add them and present in the outer column, that is 1,550. And so on. So now balance sheet preparation should not pose you any sort of what we call jitters. Plant and machinery of acquirer entity is 400. And we took over the plant and machinery of X Limited at 350 lakhs and of Y Limited at 250. So in the outer column, I am going to write 1000 lakhs. Is it clear to you? Further, after these two, we are also being given investments. As far as investments are concerned, acquirer entity is not having any investments. Acquirer entity is not having any investment. However, we took over the investment of X Limited, and the investment of X Limited is 150, investment of Y Limited is 50. In the outer column, I am going to write 200. Is it clear to you? Besides investment, we are having, in this case, goodwill. Actually, we are having goodwill and gain on bargain purchase both. But still, I am going to write goodwill only because the amount of goodwill is 110 lakh, which we computed with respect to X Limited. And we also computed gain on bargain purchase. Gain on bargain purchase is 90. Because the amount of goodwill is more than the what we call gain on bargain purchase, it is better to set off gain on bargain purchase against goodwill. So net goodwill which would appear in the balance sheet will be equal to 20. Is it clear to you? Then we move over to current asset. As far as current assets are concerned, there is a long list. First item is stock. And as far as Z Limited is concerned, you must remember that its stock is, you should look into the balance sheet. Stock of Z Limited is 500. Then as per the entries which we just passed in the books of the acquirer, we took over stock at 350. We took over the stock of Y Limited at 250. And in the outer column, I will write 1100. Similarly, debtors. As far as debtors are concerned, debtors. 300 lakhs worth of debtors are appearing in the books of acquirer entity. Now we will have to look into the entries. In the entry with respect to X Limited, in the first entry, we can see that we took over the debtors at 250 and debtors of Y Limited at 300. So this is the way to prepare the balance sheet. After debtors, we are having bills receivable. Acquirer entity is not having any bills receivable. Bills receivable of X Limited 50 and even Y Limited is having 50. So I will write here 100 lakhs. Then we have in this case cash balance. Cash balance of acquirer entity is 200 and X Limited 300. Y Limited is 200. So that comes to 700. Somebody among you should actually total it also. Vikas Koyande from Nasik says that 5520. 5520, well, okay, we take your words and your calculations. But anyway, the point is that we should understand the things. 5520 provided to us by Vikas, if I'm able to read the name correctly, Vikas Koyande from Nasik. Correct? Then we come over to the next point, equity and liability. Equity and liability. As far as equity and liability are concerned, equity and liability, the first item is important. Of course, first of all, we will have to write the equity, and under equity, we will have to write share capital. As far as share capital is concerned, share capital. You have to be careful that share capital and reserves of acquiring company cannot be collaborated, cannot be combined. Is it clear to you? So only the share capital of acquirer entity will come into play. We know that share capital of acquirer entity is given in the question as 1000 lakhs. 1000 lakhs, rupees 1000 lakhs. However, we have issued 400 lakhs worth of equity share capital at nominal value. Correct? 400 lakhs worth of equity share capital to what we call X Limited, and we have also issued 300 lakhs worth of equity share capital to the shareholders of Y Limited. You can see in the entries, in order to discharge the consideration, we have written to equity share capital 400 lakhs with respect to X Limited and Y Limited 300 lakhs. So that means my total share capital now will be equal to 1700 lakhs. Is it clear to you or not? Similarly, then I am going to write here B, other equity. Actually, before I write other equity in this question, I will have to write, this is the actually equity share capital. I will have to write preference share capital also, because we are issuing preference share capital. Of course, in the balance sheet, we know that preference share capital of acquirer company is not existing, but we made payment to discharge the consideration. As far as payment to X Limited was concerned, we made a payment of 300 lakhs worth of preference share capital nominal value, and we made a payment of 200 lakhs worth of preference share capital. You can look into the entry and see this figure. Just to collaborate my point, let me actually take you. For that, actually, I will have to skip through. Just pay attention here. See here, this is preference share capital 300 lakhs, which we are paying to Y Limited. Similarly, when you will look over the entries in connection with X Limited, you can find out that particular figure. So here preference share capital 200 lakhs. So 300 lakhs worth of preference share capital to X Limited and to Y Limited 200 lakhs. So total comes to 500 lakhs. So 500 lakhs I am going to write in the outer column. Is it clear to you or not? Further, we are being given in this particular question, before what is given, we come over to the other equity item. Now, as far as other equity item is concerned, you have to be careful that General reserve is existing in the balance sheet of acquirer entity. We are not going to collaborate the general reserves of the other entity. Similarly, there is no revaluation reserve of acquirer entity, and even profit and loss account is not existing as far as acquirer entity is concerned. We cannot take over the what we call reserves and profit and loss account of the other entity. Now here I will have to write security premium. Security premium on equity share capital. And you have to be careful here, because you are issuing equity share 1 to X Limited and to Y Limited. So for that you will have to check the entry. For example, security premium in connection with Y Limited with respect to equity share is equal to 600. And similarly, if I will check the entry with respect to X Limited, security premium is equal to 800. We issued 400 lakhs worth of what we call 40 lakh worth of equity shares, correct? 40 lakh worth of equity share at a premium of 20 lakh to X Limited. So 800 lakh is the premium on equity with respect to X Limited, and with respect to Y Limited, premium on equity share is 600. So security premium on equity share will be equal to 800 plus 600. That is equal to 1400. So I can write here 1400. You can straight away write, there is no need to show in this manner. Similarly, security premium on preference share capital. Because you are issuing preference share capital, and there is what we call premium also. For example, premium on preference share is 100 with respect to Y Limited, and with respect to X Limited, premium is equal to 150. That comes to 250. So I am going to write here 250. Correct? 250. Now I will total it up. That is 1,800. That is 2,250. 2,250. Please verify the calculation. Sometime we may also commit what we call some mistake inadvertently. After this, we will have to write second, non-current liability. Actually, in the question, Z Limited is not having any debenture. Z Limited is not having any debenture. Just pay attention. In this question, X Limited and Y Limited are having 10% debenture of 60 lakhs and actually 30 lakhs, I think so. Correct? But we took over these debenture. First of all, we took over these debentures and we made them a payment of 40 lakh and 40 lakh. Is it clear to you? So that means debentures of X Limited and Y Limited have been discharged. You are not going to add them. But whatever debentures which you have issued 15% of debenture, 40 lakhs to X Limited, 20 lakhs to Y Limited. Those debenture will appear in the balance sheet. So in the balance sheet, you will write 15% debentures. That is 40 lakhs plus 20 lakhs. 40 lakhs debenture you issued to X Limited, 20 lakh to Y Limited. Total worth of debenture issued by you 60 lakh. Now the debentures of X and Y Limited will not appear. Correct? These are debentures of now acquirer entity. Similarly, after that, I am going to write the current liability. As far as current liability is concerned, creditors of acquirer entity given in the question as 270, acquiree entity 120, 400 is the sundry creditor of what we call Y Limited. We will add all these things to get 790. And then there are besides sundry creditor, there was one more item, bills payable. If I am not wrong, bills payable of Z Limited 0. And we took over the bills payable of X Limited 150, 70, 220. Because earlier somebody told me 5520, I presume that we are getting this answer. 5520. So this is how we are supposed to do this particular question. I told you, it's a pretty long question. It's a pretty strong question. And it is a little bit tough to handle. But I have on my side done my level best to see to it that it is almost like a stroll in the park for you. Now, we come over to the next section, and the next section deals with what we call intercompany holdings. Intercompany holding. It's a pretty vital section, and many among us tend to ignore this section because it's a pretty complicated, and your module hasn't given it what we call much coverage, to be very honest with you. But surprisingly, in the recent examination, we had a question from this particular topic. So that is why I always stress upon this particular fact that you must do 100%. You must do 100%. Then only you'll feel on the safer side and on a what we call comfortable zone. Now, what we mean by intercompany holding? First of all, there is a difference between intercompany transactions and intercompany holdings. Intercompany transactions is generally with respect to debtors, creditor, bills receivable, etc. This is a case of intercompany holdings. It means, for example, there is an entity by the name of X Limited and there is another entity by the name of Y Limited. We further presume that this entity has already invested in this particular entity. That means, let us say X Limited has purchased 30,000 shares of rupees 10 each of Y Limited. X Limited is already having some investment in Y Limited, correct? And let us say after 4 or 5 years, X Limited is now taking over Y Limited. X Limited decided to take over Y Limited. So in this case, I may say that X Limited, which is the acquirer entity, and of course it is the acquiree entity Y Limited, X Limited is taking over Y Limited, but at the same time, X Limited is already having some investment in Y Limited. Is it clear to you? That means when we are taking over the other entity, we are already having some investment or some shares of that particular entity. This is known as case of intercompany holding. Under intercompany holding, we may confront actually 3 types of situation. And one among them just I mentioned, when acquirer company holds share in the acquirer entity. In this case, acquirer entity is already having some shares in what we call Y Limited, that is acquiree entity. We can reverse this situation. For example, X and Y Limited are 2 companies, and let us say Y company is having investment of 10,000 shares in X Limited. Y company has made some investment in X Limited. After, let us say 4 or 5 years, X Limited takes over Y Limited. X Limited is taking over Y Limited. But in this case, when this business combination is coming into play, that means acquirer X Limited is taking over Y Limited. So when this business combination is coming into play, at that time, Y Limited is already having some investment in this entity. So this is the second scenario where we are going to face a situation where acquiree entity is already having some investment in the acquirer entity. This is the second situation. There could be a third situation. The third situation is like that. For example, there are 2 entities, X and Y Limited. Let us say due to some market conditions, X Limited has invested in Y Limited, perhaps causing that it is profitable to invest in Y Limited. So we have invested in Y Limited. Likewise, after 2-3 years, we find that Y Limited has also invested in X Limited. So this time both the companies have invested in each other's shares, correct? And let us say after 4 or 5 years, a business combination takes place wherein X Limited takes over the Y Limited. X Limited is taking over the Y Limited. Is it clear to you? So when this business combination is coming into play, we find that on that particular date, both the companies are having investment in each other. This case is known as a case of cross-holding. This is known as cross-holding. Honestly speaking, I have already told you your module hasn't given it much coverage, but never neglect all these points. It is important, although they are complicated, and sometimes we simply cannot bank upon the what we call module also, because we are watching this particular scene that lots of questions which were asked in the examinations, questions of such facets and intensity weren't there in the module. So that is the reason. So you have to be careful in this regard. So I hope you got a bit of idea regarding the what we call intercompany holdings. Now what we are supposed to do under intercompany holdings, now I am going to explain that. As far as intercompany holdings are concerned, I told you there are 3 situations which we may have to confront under this particular topic, correct? Under this particular topic. And the first situation we are picking up. That is why under this particular section, we have divided this section into 3 parts. 8A, section 8A, section 8B, and section 8C. So we are picking up now. In fact, this question you are going to do it of your own, 8A1, because I am going to do 8A2. Both these questions are absolutely same. So 8A2, we are beginning this particular what we call concept now with this particular question, and I will explain each and every point, but just have a look over here first. Acquirer entity holds shares in acquiring company. I have already told you, acquirer entity is already having some shares in the acquiring entity. It is given in the question that balance sheet of X Limited and Y Limited as on 31st of 3/2023 is given to you. So this is the balance sheet. And generally when you are going to get question out of this particular topic, to be very honest with you, question is simply going to ask you the computation of purchase consideration and nothing else. Nothing else. Is it clear to you? But still, we have to do this. So equity share capital we see here is equal to, figures are in lakh, 5 lakh worth of equity share capital of X Limited, and importantly share capital of Y Limited is what we call 10 lakh. We have already seen X Limited is taking over Y Limited, correct? So 10 lakh is the share capital and one share is of 10 each. So that means the number of shares of Y Limited is equal to 1 lakh. Besides that, we are having general reserve, and then we have got in this particular case 2 liabilities. Is it clear? And then tangible fixed asset, investment and current assets are also given. I would love you to pay a little bit extra attention towards this. This is the investment given in the column of X Limited. That means X Limited has made some investment. Where it has made, so far we cannot draw it out simply by looking at the balance sheet. Below now it is explained that investment of X Limited represents 25,000 shares of Y Limited. So now we get a bit of idea that this investment which is appearing in the balance sheet of X Limited actually is with respect to 25,000 shares of rupees 10 each, of course. That means X Limited has purchased 25,000 shares of 10 each. Obviously, 2,50,000 worth of share capital we have purchased of Y Limited, and this share capital was purchased at this particular price. That is why investments are mentioned at 3.25 lakhs. Is it clear to you? So question has given information regarding 3.25. Regarding this investment, this figure is given just to confuse you. Actually, Y Limited might have invested somewhere else. So this is the investment of Y Limited. We are not much concerned with this investment. Rather, we are concerned with the intercompany holdings. Through this information, now we can conclude that X Limited, acquirer company, is already having some shares of what we call acquiring entity. Is it clear to you or not? Now further it is given investment of Y Limited are considered worth rupees 6 lakh. So Y Limited might have made some investment somewhere else, and now the value of this investment is equal to 6 lakh. It is also given in the question. So this is the question. Question is very small, and I've already told you, and you can see here, generally under such questions, we are simply asked to compute the purchase consideration. Here it is given, prepare a statement showing the number of shares to be allotted by X Limited to Y Limited. So question is simply asking you how many shares will be issued by X Limited to Y Limited. If you can recapitulate, such sort of thing we used to face under intrinsic value of shares method. So in this case, I will have to first of all compute the intrinsic value of shares of both the companies, and then I need to have the amount of consideration, and then finally I will divide the consideration by the intrinsic value of share of acquirer entity to know the answer which the question is trying to seek out of us. Is it clear to you or not? This is how we are supposed to do this particular question. That means in order to solve this particular question, we will have to compute the intrinsic value of share. And we know how to compute it, but only difference here is that we are having intercompany holding case. So under such a scenario, how we compute, that is the point is. So in order to make you understand this particular point, let me start the solution. And in order to do the solution, you also, I would love, because I think the full-fledged solution is not given. So better you write each and everything. And intentionally, I did not gave you the full-fledged solution. This is the question. So this much of space I will require. So 8A2, question number 8A2, we are picking up. In order to solve this particular question, first of all, what I am going to do, one is acquirer entity You can write the name. I have a habit of writing acquirer entity because then it becomes easier to make you understand. And then acquiree entity. Acquiree entity. We have also seen, as far as acquiree entity Y Limited is concerned, we just saw that their share capital is equal to 10 lakhs. So I write first of all their share capital rupees 10 lakhs. We also saw that one share is of rupees 10 each, so I am going to divide it by 10 to get the number of shares of Y Limited. I mentioned while going through the question that number of shares of Y Limited is equal to 1 lakh, so you are going to write here 1 lakh. Correct? I also told you, below it was given to us that out of this 1 lakh shares, 25,000 shares are in the pocket of acquirer entity. Out of what we call this 1 lakh share, 25,000 shares are held by acquirer entity. Is it clear to you? 25,000 shares are held by acquirer entity. Of course, these shares are having a face value of 10 each, but it is given that acquirer entity made a payment of 3,25,000 because their investment is appearing at 3,25,000 in the balance sheet. So in order to purchase 2,50,000 worth of share capital, acquirer company must have paid 3,25,000. Number one. So once you have deciphered it, correct, one you have diagnosed it, now we can proceed to solve the question. Under the step number 1, as I told you, we are supposed to compute the intrinsic value of share. And in order to compute the intrinsic value of share, first of all, I am going to write X Limited, then I am going to write Y Limited. A small balance sheet is given in this case, as we can see, tangible fixed asset given to us as 22 lakh. So I will write here 22 lakh and 10 lakh. 22 lakh and 10 lakh. Correct? Then we are given investments. As far as investment is concerned, pay attention. Here I haven't written anything. Now you may wonder, sir, investment of X Limited is given at 3,25,000. Why you are not writing it? If you remember, actually, while doing the intrinsic value questions and explaining the concept, I did actually talk about this particular point that whensoever we are supposed to compute the intrinsic value of share, obviously we need to take into account assets and liabilities. But if revised values are given in the question, we need to actually consider the same. So at this particular moment, I know that there is some change in the value of the investment. How did I conclude it? I will let you know in a short while, but there definitely is some change. What sort of change it is, I will let you know in a while. But at the same time, the value of the investment of Y Limited, which is appearing in the balance sheet at 5 lakh, below it was given that its value is now 6 lakhs. So I'm going to write here 6 lakhs. Is it clear to you? Sir, how we are going to find out the value of the investment? Quite obviously, I'm solving the question for you. You have to be a little bit more patient now. So I have left it blank for a while. Now I write, in fact, current asset 8,05,000 and 65,000. Because right now I am not in a position to tally the asset side of X Limited, but I am in a position to tally the assets of the Y Limited, so I will tally it out. The total is equal to, if I am not wrong, please keep an eye over the calculation, 16,65,000. Correct? Then I am going to subtract the liabilities. There are two liabilities as we saw while going through the question. One is 12% debentures. 12% debenture is equal to 2,20,000. So I will write here 2,20,000. And 12% debenture of this entity is equal to 1,10,000. And then there are sundry creditors. Sundry creditor is equal to 1,60,000 and sundry creditor is equal to 55,000. Of course, by subtracting liability, we get net assets. Correct? Right now, I am not in a position to compute the net assets of X Limited because I am not having the total of the assets of X Limited. However, I am going to subtract 1,65,000 from 16,65,000. I will get 15 lakhs. So 15 lakh are the net assets of this particular entity. Correct? As you know, if there would have been any preference share capital, I would have had subtracted the same to get assets available for equity shares. There are no preference share capital. There is no preference share capital. So we may say that assets for equity shareholders is equal to 15 lakhs as far as Y Limited, as far as this entity, acquiring entity is concerned. Now I am going to divide it by number of equity shares. Now, as far as number of equity shares are concerned, we know that their number of share is equal to 1 lakh. So by dividing it 1 lakh, what we get? We get 15 as the intrinsic value of share of this particular entity. Because now we have the intrinsic value of this entity, now we can trace out the value of the investment which have been made by X Limited in Y Limited. Are you getting my point or not? So that is the only point which you need to keep an eye for. Otherwise, it is absolutely similar to the question which we did earlier. Because we have made an investment of 25,000 shares, I am writing here 25,000 shares. And now the intrinsic value is 15. So we will consider intrinsic value because it is giving us the true value of our investment. So our investment now will be equal to 3,75,000. So investment will be written here at 3,75,000. I hope now you got the idea actually how we drove out the value of the investment. Is it clear to you or not? So now we have got the value of the investment. We are in a position to tally it up. If I am going to tally it up, it will be equal to 33,80,000. And from 33,80,000, I will subtract debentures and creditors, that is equal to 380. If 380 I am going to subtract, I will get 30 lakhs. So 30 lakhs net assets of what we call this entity. No preference share capital. Assets available for equity share will also be equal to 30 lakhs. Now I will divide it by the total number of shares. Now, if we look into the balance sheet, we saw earlier that share capital is 5 lakhs. So number of share will be equal to 50,000. So we may say in this particular case that intrinsic value is 60. So we are able to find out the intrinsic value of share of both the companies. Is it clear to you? After having found out the intrinsic value, now I will write under the second step, consideration payable. How much consideration I am supposed to pay? Consideration payable. Earlier, when we did questions related to intrinsic value of share, I told you consideration payable is nothing but the net assets of the acquiring entity. However, in case of intercompany holdings, you have to be a little bit careful. You simply cannot take it as what we call consideration payable. Why? That I will let you know. In order to know what amount you are going to pay to the shareholders of what we call acquiring entity, first of all, you write here number of shares of X Limited. Number of shares of acquiring entity. Number of shares of acquiring entity. Acquiring is Y Limited actually. Number of shares of acquiring entity. We saw that their total number of share is equal to 1 lakh. So I am going to write here 1 lakh. And you know that consideration is always payable to the owners of the business. Now, in this particular case, total number of shares of the acquiring entity happens to be 1 lakh. But we are also aware of this particular fact that out of this 1 lakh, we are already having 25,000 shares. So from our perspectives, because we cannot pay to our own shareholders, out of this 1 lakh, we are already having 25,000 shares. Try to understand this particular point. So first of all, what I am going to do, I am going to subtract less number of shares held by acquirer entity. Number of share held by acquirer entity of course, in acquiring entity. So 25,000 shares we are already having, and we cannot make the payment to our own shareholders. So that is the point. That means we are supposed to pay only to the 75,000 shareholders of acquiring entity. Point is this. That means we are paying to 70, we are supposed to pay to 70 for 75,000 shares, you can say in simple language. So logically it is known as number of shares held by outsiders. Number of shares held by outsiders. Number of shares held by outsiders. So these many shares are held by outsiders. So you are supposed to make a payment to them. Now the question is that how much payment you are going to make them. So these shareholders will tell to the acquirer entity that because intrinsic value of our company's one share is equal to 15, correct? This is our worth and pay us this much. So outside shareholders are 75,000. I am going to first of all multiply it with the intrinsic value of share of acquiring entity because they are shareholders of acquiring entity. So in order to know their worth, we will have to multiply it with 15. Now we will come to know that this comes to 11,25,000. So we are supposed to make a payment of 11,25,000. This is consideration payable. This is consideration payable. Consideration payable. This is known as consideration payable. Is it clear to you? This is consideration payable. And you know that in order to pay the consideration, how many shares you are supposed to issue now? This is the next point. So number of shares to be issued, number of shares to be issued by acquirer entity to discharge purchase consideration. So purchase consideration is equal to 11,25,000. We are going to divide it by intrinsic value of our share. Intrinsic value of our share is equal to 60. Is it clear to you? So we are supposed to issue, it means 18,750 shares of rupees 10 each at the rate of 60. At the rate of 60. Is it clear to you or not? This is how we are supposed to do this particular question. Although I have already told you, generally question in the examination will be asked only up to this particular point. Nothing more can be asked. You can actually simply bank upon this particular statement. But just to make you understand, as I always endeavor hard to give you maximum possible knowledge, but that doesn't mean we are unnecessarily giving this information. Anything can be asked in the examination. So books of acquirer also I am proceeding to. Books of acquirer. Now we move over to the books of acquirer. Books of acquirer. As far as books of acquirer are concerned, as usual, first of all, what you are supposed to do in this particular question, obviously you are going to write the entries for the assets taken over. You have taken over tangible fixed asset worth rupees 10 lakh. You have taken over investments of Y Limited also. An investment of Y Limited was equal to 6 lakhs. And then you are going to take over the current assets. Current assets were worth rupees 65,000. So these are the three assets which you have taken over. No doubt about that. Then you are going to write here two liabilities which you have taken over. One was 12% debentures, 1,10,000. 1,10,000. And then you are going to write two creditors. Two creditors. Creditors were worth rupees 55,000. Creditors 55,000. Here very interesting point is, now, after that, we have a habit of writing two consideration. Obviously, I will write here consideration payable, consideration. Consideration, actually, just think for a while. When we computed the amount of purchase consideration, I told you to take into account total number of shares, correct, of acquiring entity 1 lakh. And then we subtracted, in fact, 25,000 shares, and then we computed the outside shareholder. Just think for a while, if there would not have been any intercompany holding, how much purchase consideration you would have given? In that case, total outside shareholder would have been 1 lakh. And they would have asked you to pay at the rate of 15 because intrinsic value of share of acquiring entity is 15. So in that case, your consideration would have been 15 lakh. But now you are making a payment of only 11,25,000. You are not making a payment of 3,75,000. Why you are not making a payment of 3,75,000? Because you are already having 25,000 shares of that particular company. And we computed the value of 25,000 share. We just computed, when we computed the intrinsic value of share has gone up to 3,75,000. Is it clear to you? So point to be noted is that we are paying an amount of 11,25,000 and we are actually supposed to pay 15 lakh, but we are paying 11,25,000, but we did not pay 375 because we are already having what we call some shares in that particular entity. Now pay attention. Actually, in this particular question, in the books of acquirer, logically, you should have written this entry first. Correct? This entry you should have written first. What is this entry? Investment in Y Limited. Y Limited is the acquiring entity. Your investment as per the balance sheet is 3,25,000. But that investment has gone up to 3,75,000. So that means there is a gain of 50,000. As per Ind AS 109, that gain must be taken to P&L account. So I will take it to the profit and loss account, 50,000. Logically, I should write this entry first. Correct? But I intentionally did it in a normal way. Correct? To make you understand better. So first of all, I will have to write this entry. And now we know that our investment has gone up to 3,75,000. Pay attention. And I am paying a consideration of 11,25,000. 11,25,000. I'm paying a consideration of 11,25,000. Logically, the purchase consideration is 15 lakh. You can also see it because so often we keep on telling purchase consideration is nothing but the net assets. Logically, your purchase consideration is 15 lakh. You can also look at this value. But we are paying only 11,25,000. Why? Because out of this 15 lakh, 3,75,000 worth of asset belong to us. So that is the reason I will have to write here two investment, because my investment has gone up to now 3,75,000. Now I am crediting it because I am not paying 3,75,000. I am not paying 3,75,000. So I will cancel out that investment. However, this cancelling has given me a sort of benefit. Remember one thing. So I will write here investment in Y Limited account, 3,75,000. Is it clear to you? Logically, in this case, this will become your entry number 2, and logically, this will be your entry number 1. Is it clear to you or not? So this is the point I just wanted to, and there is no difference this time. No gain on bargain purchase, no goodwill. Now entry number 3 obviously will be to discharge the consideration. So in order to pay the consideration of 11,25,000, 11,25,000, 11,25,000. In order to pay consideration of 11,25,000, we are in this particular case delivering equity shares. So I will write here share capital. And remember one thing we computed earlier, we are discharging this consideration by issue of 18,750 shares at the rate of 60, but having a face value of 10 each. So I will write here 1,87,500. 1,87,500. Then I am going to write here 2 security premium. 2 security premium. An amount of security premium will be equal to how much? Amount of security premium will be equal to 18,750 into 50. That is equal to 9,37,500. 9,37,500. Is it clear to you? This is how you are supposed to do this particular question. And coming over to the balance sheet portion. Balance sheet. This is our step number. I have forgotten the step number anyway. Books of acquirer. In books of acquirer, this was our step number A, you can say. And now we'll do the step number B. This is balance sheet. In order to prepare the balance sheet, first of all, I write assets. As far as assets are concerned, only few items are given in the question. One, NCA, non-current asset. Under the non-current asset, we find there are tangible fixed asset. Tangible fixed asset, 22 lakh of acquirer entity. And we took over tangible fixed asset of acquiring entity at 10 lakh. So in the outer column, I am going to write 32 lakh. In the outer column, 32 lakh. After tangible asset, I am going to write the investment. Investments as per balance sheet of acquirer entity is 3,25,000. We will write it at 325. But in the books of acquirer, we have passed this entry also. Because of this entry, value of investment moved up to 50,000. Moved up by, 50,000. So went up to 375. But we credited it also, you can see 3,75,000. So this investment is cancelled. So investment in Y Limited is cancelled. As you can see, it has become 0. But we took over the investment of Y Limited at 6 lakh. So in the outer column, only 6 lakh will come. Then current asset. In this particular question, current asset. As far as current assets are concerned, 8,05,000 is given to us. I will add 65,000. 65,000. It will be equal to 8,70,000. 8,70,000. Clear? Kindly do the total by yourself. And then second, equity and liability. As far as equity and liability is concerned, first of all, we write equity. And I am tired of telling all these things. Under equity, first of all, we write share capital. As far as share capital is concerned, only acquirer company's share capital will find place in the balance sheet. As per the balance sheet, acquirer's capital is 5 lakh. But just we passed an entry to discharge the consideration, and because 18,750 shares were issued at the rate of 10 each, so 1,87,500 share capital will increase by this nominal value, and 6,87,500 will appear here. Then we write other equity items. As far as other equity items are concerned, general reserve is existing in the balance sheet. Of acquirer company, it is given 26,20,000. Correct? Besides that, security premium 9,37,000, 18,750 shares at the rate of 50. This is security premium. And remember, in the very first entry, we passed investment account debit to P&L account. So don't forget to write P&L also. So now this total you are going to present in the balance sheet. Non-current liability. As far as non-current liability are concerned, 12% debentures, 2 lakh and 1,10,000. That comes to 3,10,000. And then finally we are supposed to write current liability. As far as current liability is concerned, sundry creditors 1,60,000 plus 55,000. So 2,15,000 will be the amount which will find place in the balance sheet. Is it clear to you or not? So this is how we are supposed to do this particular question. Now, problem is that the question which was asked in the examination from this particular section, correct, which I told you, everyone never do this particular section. And many of you are not even aware of this particular section, to be very honest with you. So the important point is that when the question, when it struck in the examination, it also asked at that time only the calculation of the purchase consideration and entries in the books of acquiring entity. Entries in the books of acquiring entity. So in this case, how you are going to actually do the accounting in the books of acquiring entity, this is also another important point. Correct? So accounting in the books of acquiring. Accounting in the books of acquiring. As we know, as far as acquiring entity is concerned, acquiring entity will prepare one, acquirer company account, as we know. Correct? We also know that acquirer company prepares realization account. So I will write here realization account. After the realization account, just to make you little bit for the better understanding, I am this time preparing shares in acquirer company. Remember, this account we have never prepared earlier. Shares in acquirer company account. Shares in acquirer company account. Shares in acquirer company account. Correct? And this time I am also preparing an account which we never prepared earlier, share capital account. This is just for better facilitation of the concept. Otherwise, you can ignore these two accounts, correct, once you develop the understanding. And then as usual, we are going to prepare shareholders account. In this question, intentionally, I am not preparing cash account, because no transaction related to cash is there. When acquirer company is going to prepare the account, see here, first of all, on the liability side, if we will look into the balance sheet of acquiring company, first of all, we find there is share capital of 10 lakh. Because I am preparing share capital, I will write here balance brought down 10 lakh. Because I am preparing share capital, I will write obviously 10 lakh. Then if we look carefully, there is also general reserve. So general reserve we always transfer to shareholders account. We write here 4 lakh. Besides that, there are two more items in the form of what we call 12% debentures. They are liability. We are going to post them to the credit side of realization account. 1,10,000. And then we have sundry creditors, 55,000. That way round, liability side is now closed. Obviously, we will look into the asset side. Hardly 3 items are there. I will first of all write tangible fixed asset. That is 10 lakhs. look into the asset side only of acquiring entity. Now, acquiring entity's investment is 6 lakhs. So I will write it, sorry, 5 lakhs, not 6 lakh. Only balance sheet figure will be considered when we prepare the account. So write here 5 lakhs. And then we have in this case current assets. So current assets 65,000. Important point is that as why I prepared share capital to make you understand this particular point. Actually, out of this particular share capital, we know that 25,000 worth of share capital is held by the acquirer entity. So what I am doing now is just pay attention. Actually, out of 10 lakh rupees, 25,000 into 10, 2,50,000 worth of share capital held by acquirer entity. And our business is now closed down, acquiring entity. Its business is closed down now. So acquirer entity now need not require to pay 250 because these shares are already held by acquirer entity. So acquirer entity will cancel 2,50,000 worth of share capital and it will be taken to realization account because it is a gain. It is a gain to the acquiring entity because they are escaped of paying 2,50,000 worth of shareholders. Is it clear to you or not? So we have to cancel it out. So because we have written here realization, on the credit side of realization, I will write share capital. Cancellation of share capital, 2,50,000. Now, share capital account will be closed. How it will be closed? We will transfer the balance to the shareholders account. Whatever balance is there, now it will be posted to the shareholders account. Actually, there was no need to prepare share capital account. You could have simply written out of 10 lakh, 2,50,000 straight away here share capital and rest of the amount here. But just to give you a better idea of understanding, so I am now writing here by share capital 7,50,000. 7,50,000. Is it clear to you or not? Now after this, we are going to write the purchase consideration. So I am going to write by acquirer entity. By acquirer company. Purchase consideration. We computed purchase consideration as 11,25,000. So I am going to write 11,25,000. And this will be posted to the debit side of acquirer entity. And over there I am going to write here to realization account 11,25,000. And now we are going to receive the shares against the same. So I will write here shares in acquirer entity, shares in acquirer company. So 11,25,000 worth of share we are going to receive. Obviously, this account will also get closed. Because although it is not needed, shares in acquirer company account is not needed, but just for better understanding, these shares, because we have written here buy shares in acquirer company, logically I should first of all write on the debit side of shares in acquirer company account. On the debit side, I should write to acquirer company 11,25,000. And this 11,25,000, this account now will be closed by transferring the amount to the shareholders account. Balancing figure 11,25,000. Is it clear to you? And on the debit side of the shareholders account, I am going to write here 2 shares in acquirer entity. 2 shares in acquirer entity. That is equal to 11,25,000. Is it clear to you or not? This is how we are supposed to do this particular question. Because in this particular question, we are not supposed to pay any liability, number one. We are not supposed to pay any expenses. So now I will tally it. In this particular question, there is a loss of 25,000. So I will write loss transfer to shareholders. So this loss will be transferred to shareholder. On the debit side of the shareholder, I will write here to realization account. Loss 25,000. Obviously, now shareholder account must get tally of its own. 11 lakh 50, 11 lakh 50. So this is how we are supposed to proceed in this particular question. I hope the question on the cards to begin the proceedings of the day. And in the meantime, we are having the green signal on, and lovely good evening once again to all those who have just connected with us now. And 8A.3. So this is the question which we are about to actually take up. So in the meantime, you kindly open down your notes and also register pen, pencils, etc. So till up to 8A.2 we have already completed, and we are doing right now the concept of when acquirer company holds share in the acquiring company, correct? So this topic falls under intercompany holding. So we begin the session now, correct? So in this particular case, this is what happened. The moment I was about to start, pen is saying I'm having cold. Okay, this question 8A.1.3 has again been taken from your module and adapted from the past examination paper. Modified in the sense means only dates. Just to give it a fresh look, actually, we have provided here date 2023, correct? So now we can begin. Actually, in the meantime, I was noticing that everyone is connected with us now, and everyone is connected with us now. The following are the balance sheet of Good and Bad Limited. So this is the balance sheet of Good and Bad Limited. Correct? Interesting question. And this sort of question is struck in the recently held examination. Let me tell you also. Equity and liability. You can see equity share capital. This is the authorized share capital. We are not concerned with that. Issued and subscribed capital. One share is of rupees 10 each. Share capital is 12 crores. See, figures are in crores. Sometimes we tend to skip. And 5 crores of Bad Limited. Other equity item as far as is concerned, 88 and 10. Further, we are given unsecured loan from Good Limited and unsecured loan nil for Good Limited and 10 for Bad Limited. Besides that, we are having property, plant and equipment at cost 80 and 40, and then depreciation is also given. So important point is that written down value of property, plant and equipment happens to be actually 20 and 6. Correct? Now the interesting point is investment at cost. So this investment is written in the column of acquirer entity, correct? Even in the last question, we saw that they held 25,000 share, if you remember, at a cost of 3,25,000. So similarly, in this particular question, what is the situation? Acquirer company is holding upon 30 lakh equity shares of rupees 10 each. 30 lakh shares of rupees 10 each. And they must have actually paid rupees 3 crores to acquire 30 lakh shares of rupees 10 each. This is the point. And the important point is that acquirer company hold already some shares in the acquiring company. Then we have in this particular case long-term loan to Bad Limited. See here, this entity has given some loan to Bad Limited. Acquirer entity has given some loan to Bad Limited. That is why it is appearing towards the asset side. On the contrary, we just saw here unsecured loan from Good Limited, and this company, because has taken loan from what we call Good Limited, that is why they have written 10 lakh worth of loan towards their liability side. So we can say that it is a case of intercompany transaction. This 10 lakh is a case of intercompany transaction. Technically, it will be eliminated later on in the books of acquirer company. Then we are being given in this particular question current assets. Current assets are 200 lakhs. And besides that, current liabilities have been given as an item of deduction. But important point is that you should consider current assets separately, current liabilities separately. Then working capital is given. We are not concerned with the working capital. We will simply take into account current asset and current liability, and then total is also given to us. Further, it is stated that on that date, Good Limited absorbed Bad Limited. So Good Limited has taken over the Bad Limited. The members of Bad Limited are to get one equity share of Good Limited, and which will be issued at a premium of rupees 2 per share for every 5 equity share. So Good Limited is taking over Bad Limited, and now it is stated that every shareholder, correct, for one equity share, purchasing company is going to issue 5 equity share. And importantly, The equity share will be issued at an issue price of rupees 12 because face value of the share happens to be 10, and it is clearly given in the question over here that shares are going to be issued at a premium of rupees 12 per share. So these are the things which you note down very carefully. Again, logically, we may say that this question is of net payment method, correct? Anyway, further it is given that necessary approvals are obtained and you are asked to pass, see here what is written, you are asked to pass journal entries in the books of 2 companies to give effect to the above. Only the journal entries have been passed. That is the reason why even in the last session, I did what we call accounting in the books of acquiring entity. But here they are asking what we call entries in the books of acquiring entity and acquirer entity. And of course, it is a case when acquirer company holds what we call some shares in the acquiring entity. So in order to solve this particular question, let me have a quick look over the question once again. And now I will create the space to solve this particular question for me. This space need to be created to solve the question. This is question number 8A3. Let me position myself a way bit. So 8A3, 8A3. This is the question which we are beginning up with as far as today's particular session is concerned. Now, suppose, first of all, you tell me, I just want to know actually how much you have retained from the last session. As a first step, what you would do in this particular case. See here, logically, under the first step, you need to have the consideration, especially to pass the entries. Quite obviously, we may go for computation of purchase consideration first. In order to compute the purchase consideration, under the first step, what you should do, simply take into account the total number of shares of BAT Limited, total number of shares. It is very cold out here, I have already told you, very difficult to hold the pen, and through this electronic pen, it is very difficult to actually put up your original handwriting. Actually, I was very famous for my handwriting, but I do not know how you are perceiving it. Total number of shares of BAT Limited. BAT Limited is your acquiring entity, correct? Total number of shares of BAT Limited. We have just gone through the balance sheet, correct? In the balance sheet, we saw that share capital of BAT Limited was presented at 5 crores. Now, if I am going to write 5 crores, how many zero are there? I think 7 zero are there. So I will write here 5 crores or 500 lakhs. And this is the total share capital. And if I am going to divide it by 10, I will get the what we call number of share. This figure I must have. So 50 lakh worth of shares, we may say acquiring entity is having. Further, in the question, it was given that as far as exchange ratio is concerned, it was given in the question that purchasing company will issue 5 shares, isn't it or not? Exchange ratio. So we may say exchange ratio is 1 equity share for every 5. 1 equity share for 5 shares. So if you are having 5 shares as a shareholder in what we call acquiring company, then you are going to get only 1 share. So if 1 equity share for 5 shares. Further, it was given in the question also that purchasing company is going to issue the shares at a price of 12. Issue price, face value is actually 10, no doubt about that, but shares are being issued at a premium of rupees 2 per share. So we may say that issue price happens to be 12, isn't it? Now, we are in a position to compute the consideration. The amount of consideration will be equal to this much. Amount of consideration after taking into account this information or these informations, we may say that total number of share is equal to 50 lakhs. We just computed, and now it is given that for 5 shares, purchasing company is issuing only 1 share. Purchasing company is issuing only 1 share in this particular question. And further it was given that 1 share will be issued at the rate of rupees 12 each, So all in all, we may say 50 lakh divided by 5, that is 10 lakh shares have been issued at the rate of rupees 12. That comes to actually 1200. How many 0? Again 0. I think it is equal to 120 lakhs. Correct? 120 lakhs, if I am not wrong. So 120 lakhs is your purchase consideration. Once you have determined the purchase consideration, you must not forget that as an acquirer company, you are already having 30 lakh worth of share in the acquiring entity. So 30 lakh shares are already held by purchasing company, that is Good Limited. So Good Limited is already having what we call 30 lakh shares as far as this particular entity is concerned. Now, it means out of 50 lakh shares right now, which is the what we call number of shares of acquiring entity, out of 50 lakh, we are having actually 30 lakh worth of share. So basically, we want to know what should be the consideration for the outside shareholders. So outside shareholder will be equal to 20 lakh because out of 50 lakh, 30 lakh shares are in our hand already, as we saw. Is it clear to you? So in this case, what I am going to do, for 50 lakh as we compute it, for 50 lakh shares, consideration we computed equal to 120 lakhs. Consideration is equal to 120 lakhs. And if I want to know what will be the consideration for the outside shareholder, I can find it out in this manner. So for 20 lakhs shareholders, outside shareholders, for 20 lakh shareholder, consideration will be equal to 120 lakhs into 20 lakhs divided by 50 lakhs. Divided by 50 lakhs. Is it clear to you? So this way around, we have been able to derive out that how much consideration we should pay. So consideration payable becomes in this particular case 48 lakhs. That means 72 lakh out of 120. If I am going to subtract 48 lakh, 72 lakh worth of consideration I need not require to pay. At the same time, it means. So now the next part of the question is, how many number of shares we are going to issue? Number of shares to be issued, number of shares to be issued by purchasing company, number of shares to be issued by Good Limited. Good Limited is acquirer entity. Good Limited to discharge purchase consideration. So in order to discharge rupees 48 lakh worth of purchase consideration, since in this case purchasing company is issuing its share at the rate of rupees 12, so we may say that we shall issue 4 lakh shares. 4 lakh shares of rupees 10 each at the rate of 12 each. At the rate of rupees 12 each. At the rate of rupees 12 each. This is how actually we are going to find out. This should be our first step. Now, if you remember, in the books of the acquiring entity, we had a little bit of discussion last time, correct? So under step number 2, I am going to write here books of BAT Limited. In fact, Journal of BAT Limited. BAT Limited is your acquiring entity, BAT Limited. But this time we are not being asked to prepare the ledger accounts. So what I am going to do in this time, so this time you will have to pass the entries. Obviously, nice answer. But the point here is that what should be my first entry? If you remember, when we do the accounting in the books of the acquiring entity, under the first step, we close the asset side. And in order to close the asset side, first of all, we transfer all the assets to the debit side of realization account. So my entry will be realization account debit, because I am going to transfer all the asset to the debit side of realization account. First of all, let me write here rupees in crores. Otherwise, it will consume lot of time to write the full-fledged figures. Now, realization account debit to property, plant and equipment. Given in the question, property, plant and equipment, actually their gross value is given 40 and their depreciation is given as 34 and 6 was their written down value. So we have transferred it at written down value, correct? To current asset. Current asset in the question of BAT Limited were 134. Only 2 assets were there, so 140. This is the amount of assets which I am going to transfer to the debit side of realization account. After having transferred the asset, now I am going to transfer the liability. As far as liabilities are concerned, in this question when we were going through, we found that there were 2 liabilities. One in the form of unsecured loan. If you remember, on the liability side, unsecured loan was written and this loan was taken from Good Limited by BAT Limited. So unsecured loan, which is appearing on the liability side, is 10 lakhs. And besides that, there were current liability. I told you, you have to treat current asset and current liability separately. And current liability was 115. So these 2 liabilities of BAT Limited are there. We are going to transfer it to the credit side of realization account. So I will write this particular entry, 125. So after having transferred assets and liability, now next thing is with respect to share capital. Now share capital we just saw of BAT Limited is existing in the balance sheet to the tune of 5 crores. Isn't it or not? Share capital. If you remember, in the last time when we did accounting in the books of acquiring entity, what I talked about share capital. Out of total share capital of 5 crores, 3 crores worth of, because 30 lakh share of rupees 10 each is equal to 3 crores, correct? So 3 crore worth of share capital is in the hands of the acquirer entity. So now this entity, acquiring entity, will cancel it out because now they are escaped of paying to what we call these shareholders, because they are now shareholders of what we call acquirer entity. So they will cancel out share capital held by acquirer entity. So and yesterday, if you remember, we talked about this particular fact that it is a sort of gain to the acquiring entity because acquiring company is now escaped of what we call paying to these shareholders. So to realization account I will write here, and when I write here to realization account, indirectly it means I'm writing share capital held by Good Limited. Share capital held by Good Limited. Held by Good Limited. Share capital held by Good Limited. And this is equal to 3 crores. Is it clear to you? And if you remember, rest of the share capital, because at that time we prepared the ledger account, and rest of the share capital was transferred to shareholders account. So now rest of the share capital will be transferred to shareholders account. That is equal to 2 lakhs. So in the shareholders account, now we have 2 lakh. We may say in this manner. Further, as far as other equity is concerned, in this question there is other equity to the extent of 10 crores. Other equity of, I'm talking about BAT Limited. Other equity items of BAT Limited given in the question is 10. So other equity will always be transferred to shareholders account. So we will transfer it to shareholders account. Correct? Only thing is that so far we were simply preparing the ledger account, and now we are doing the same thing but by way of entries. Now after having taken care of all the items of assets and liability side, correct? All the items of assets and liability side have been taken care of. Now the next step is related to what we call purchase consideration. So we will write acquirer entity, and the name of the acquirer entity is Good Limited. And Good Limited account debit. First we'll pass the entry, due entry to realization account. You are supposed to receive 48 lakhs. So because we are writing the figures in crores, so I will write 0.48. So 0.48 worth of what we call purchase consideration we are supposed to receive. After having passed the due entry, obviously now we are going to receive the consideration. And now when we are going to receive the consideration, I will write shares in good limited account, shares in good limited account debit. We shall receive 0.48 crore worth of shares and we are going to transfer the same. In fact, first I will write here to good limited, because we are going to receive these shares from good limited. After having passed this entry, your good limited account will get closed. Now whatever shares which you have received will be transferred to the shareholders account. Correct? So I will write now shareholders account debit, 0.48 shareholders account debit to what we call shares in good limited, shares in good limited. So this is how we are going to solve it out. Further, you will have to actually, if you can do that, otherwise this much is enough. Otherwise, you will have to compute your loss or profit also, and then pass, that will be your last entry. Whatever loss or profit will be there, you are going to transfer it to the what we call debit or credit side of shareholders. How will you find the what we call profit? The point is this. See here, in this case, if suppose I will ask you to prepare the realization account, how you are going to prepare the realization account? Just pay attention here. I'm doing it for you here itself. Just see here, suppose if I am going to prepare the realization account in order to know or trace out the profit, although it is not needed in the question, but still, just to make the point a little bit more clearer. See here, first entry realization account debit to property, plant and equipment. So I am going to write here 6 lakh. Next entry is current asset account debit. So we have debited all the assets to the debit side of this account. Now next entry which we pass is with respect to unsecured loan. We transferred unsecured loan worth rupees 10 lakh and current liability worth rupees 115 lakh to the credit side of realization account. After that, we passed another entry, share capital account debit to realization account. Now here, realization account is getting credited, and it is getting credited by 3 lakhs. It is getting credited by rupees 3 lakhs. So I will credit it. Then in this entry, there is no realization. In this entry, there is realization. Realization account is getting credited because of purchase consideration due. So I will write here acquirer entity, that is good limited, and purchase consideration is 0.48. Purchase consideration is 0.48, and after that, there is no other entry. So now we are in a position to tally it out to find out our loss or what we call gain. Let's say 140 is the total of the debit side. As you can see, only two items are there, 6 and 134. So 140 minus 125, that is 10 and 115, minus 3 and minus 0.48. So we may say in this case 11.52 is loss. 11.52. And this loss will be transferred to shareholders account. Is it clear to you? This is how you are going to actually find out the realization loss in this particular question. And this loss ultimately will be transferred to the debit side of shareholders. So last entry which you are going to write is with respect to this only, shareholders account debit. Because this time there is a loss, and loss is equal to 11.52 shareholders account debit to realization loss account. Realization loss account. That is 11.52. This is how you are going to pass the entry in the books of acquiring entities. So entities can be passed very easily once we know actually the art of preparation of ledger account. Now the next thing in this particular question, and the last thing, is with respect to what we call entries in the books of acquirer entity. So books of good limited. Books of good limited. Now we will take care of this part. Books of good limited. Correct. As far as books of good limited are concerned, in this particular case, please pay attention. In this particular case, my first entry will be, in fact, intentionally I have left this particular space. My first entry will be assets which we have taken over. In this case, property, plant and equipment of acquiring entity we took over at a written down value of 6 crores. Then we took over current asset 134 crores, 134. Correct? Besides that, we took over two liabilities. So I'm going to write those two liabilities in the form of unsecured loan. Unsecured loan is 10, and we also took over current liability to the extent of 115. Then I am going to write here two consideration. How much consideration I am supposed to pay? Sir, I am supposed to pay 0.48 worth of consideration. 0.48 worth of consideration. Now, if you remember in the last session, we talked about the investments. We have to cancel out the investments in the BAT Limited. Investments in BAT Limited. But point is that what is the value of your investment in BAT Limited presently? What is the value of your investment in BAT Limited presently? You can find it out very easily. See here, total purchase consideration was 120 lakhs. Total purchase consideration is 120 lakhs. For 50 lakhs worth of share, total purchase consideration was 120 lakhs. Out of 50 lakhs, 30 lakhs worth of share already belonged to us and 20 lakhs were outsiders. And we computed that out of 20 lakh, 48 lakh worth of purchase consideration belongs to outsider. That is why we have written here 0.48. If I am going to subtract 48 from 120, automatically it means out of 120, 72 lakh worth of purchase consideration belongs to 30 lakh worth of shareholders. So when I say that out of 120, 48 belongs to outsiders and 30 lakh worth of shareholders, 72 lakh belong, indirectly it means value of my investment in BAT Limited is equal to now 72 lakh. Is it clear to you or not? So that is the reason I am going to write here 72 lakh, that is 0.72. But if you remember in the balance sheet, we have shown our investment at 3 crores. Our investments in the balance sheet is 3 crores. But their value has now fallen down to 0.72. Is it clear to you? So that means this time there is a fall in value. And that is why I left out this particular entry earlier. And yesterday also I talked about this particular fact. It is better to take into account the loss or profit on account of fluctuations in the value of the investment made by the acquirer entity in the books of the acquiring entity. So in this case, because there is a loss, I am going to debit profit and loss account or simply other equity. And the difference will be equal to 2.28. So we may say that in this case, we have suffered a loss equal to 2.28. Correct? And now I will write two investments in BAT Limited. Two investment in BAT Limited. We made an investment of 3 crores, but their value is just about 0.72 now. So that is the reason there is a loss equal to 2.28. We may say in this manner. Is it clear to you? So because our investment has now slided down from 3 crores to 0.72, it has slided down by 2.28. So our investment is now 0.72 and we have cancelled it out. Is it clear to you or not? Now we will also compute, in this case, to gain on bargain purchase, that is the balancing figure, and gain on bargain purchase is equal to 13.80. Gain on bargain purchase is 13.80. Correct? So this is how you are supposed to pass the entry in this particular case. Obviously, your next entry will be to discharge the consideration. Now, consideration account debit. Consideration account debit. You are supposed to pay 0.48 crores, that is 48 lakhs. In order to pay 0.48 crores, we computed earlier 48 lakh divided by 12, if you remember, 4 lakh worth of shares. So we are supposed to issue 4 lakh worth of share. So I will write here 2 share capital, 4 lakh shares into 10. That is equal to 0.40 and 2 security premium. 2 security premium. Security premium will be equal to 4 lakh into 2. 0.08, because we have to write the figures in crores, correct? This is how you are going to pass the entry. And last entry, if you can pass this one, it would be almost icing on the cake. Because as you know, we did earlier some questions, correct? Intercompany transactions must be eliminated. As far as unsecured loan is concerned, it is a transaction between these two parties. One company has given loan to other company, another company has taken loan from us. So it is better to actually eliminate this transaction. And in order to eliminate this transaction, I will write it in this manner: unsecured loan account debit, which is appearing on the liability side, correct? It is being now eliminated, so it will be debited. So unsecured loan, of course, of BAT Limited it was, correct? So unsecured loan from Good Limited, this loan has been taken by BAT Limited from Good Limited, and the amount of loan is 10. And similarly, on the asset side of the acquirer company, unsecured loan is also appearing. Unsecured loan to BAT Limited. Unsecured loan to BAT Limited. This is unsecured loan from Good Limited. So it will be cancelled out. It is known as cancellation or elimination of intercompany transaction. Cancellation or elimination of intercompany transaction. This is how you are supposed to do. Is it clear to you? So after having done this particular part, now we are in a position to stretch our discussion to a little bit higher limits. So we have covered the first part of intercompany holdings, correct? Under the intercompany holdings, we have seen actually that 3 sort of situation may arise, and we have covered the first one when acquirer entity holds shares in the acquiring entity. Now we move over to this particular part. Of course, now we are dealing up with the second part, where we are going to see that acquiring company is already having some shares in the acquired company. This is the title I have written here: when acquiring company holds shares in the acquired company, correct? So in order to understand the replication of this one, let's have a look over here. However, this one you will find a little bit easier in comparison to the earlier one. Acquiring company holds share in acquirer entity. The question goes like this: following are the balances of the two companies Y Limited and Z Limited as at 31st of December 2023. So this time the balances have been given to us, and share capital of the respective company, first of all, you must pay attention to, and besides that you must also take into account the face value. And then we have a small balance sheet is given, reserves and creditors. On the asset side, sundry assets, and now the important point is 1000 shares in Y Limited. 1000 shares in Y Limited. And this is written in the what we call column of Z Limited. So this item, 1000 shares in Y Limited, that means Z Limited has already invested in 1000 shares of Y Limited. And we will see later on that in this particular question, W Limited is taking over. W Limited is the acquirer entity, and it is taking over Z Limited. We will see right now till up to this particular point, it is not given which company is taking over the other one. However, we will see later on that W Limited is taking over Z Limited, and as you can see that Z Limited this time, the acquiring entity this time, is already holding upon 1000 shares of what we call W Limited. Of course, 1000 share and 1 share is of ₹100 each. This is the face value. However, they have acquired 1 lakh worth of share at ₹1 lakh. This is also given in the question. Is it clear to you or not? Fine, sir. So if it is fine, now we move over to the next part of the question. Further, it is given now, it is clarified that Y Limited was to absorb the Z Limited. So Y Limited is taking over Z Limited. Now it is clarified. And further, it is given on the basis of the intrinsic value of the share. So on the basis of intrinsic value of the share, we are taking over the purchase consideration was to be discharged in the form of fully paid share. Purchase consideration will be discharged in the form of fully paid share, and further it is given that entries is to be made at par value only. Entries is to be made at par value only. What implication it will have later on while writing the entry, I will let you know. Further, it is given a sum of 20,000 is owed by W Limited to Z Limited. So this is a case of intercompany transaction. That means Y Limited might have taken some what we call amount or credit, 20,000 worth of credit from Z Limited. So it is a transaction between these two companies, correct? So this will be eliminated later on in the books of acquirer entity. All the intercompany transactions are eliminated. Intercompany transactions are also known as mutual transactions, contra transactions, correct, or intercompany debts. Further, it is also given, also included in the stock of Y Limited. Also included in the stock of Y Limited, 30,000 worth of goods supplied by Z Limited at a cost of 20%. What does it mean? Actually, in this question, stock is not given separately. So in this sundry asset, we may say that whatever sundry assets of W Limited are given, whatever sundry assets of W Limited are given, whatever sundry asset, actually 750 are given. In these sundry assets, it is given that stock they might have purchased some stock from what we call Z Limited. So W Limited might have purchased some stock, and out of that stock, 30,000 worth of stock right now is what we call appearing under the sundry assets. That means in the balance sheet of W Limited, there is an item worth rupees 30,000 in the form of stock which they have purchased from Z Limited, and it is appearing in the balance sheet. Is it clear to you? Number one. Further, it is given that when Z Limited sold this stock to Z Limited, they sold it at a margin of cost plus 20%. Cost plus 20%. What we mean by cost plus 20%? Because rate is given on cost. So cost will be 100 and margin will be equal to 20. And of course, selling price will be equal to 120. So rate of profit on selling price will be 20 by 120 or 1 by 6. Because in this case, W Limited has purchased the stock from Z Limited. So when Z Limited earlier must have sold the stock to W Limited, because Z Limited knows that in this 30,000 worth of stocks, there is a profit margin of this much, that is equal to 5,000. So when Z Limited might have earlier sold the stock, they must have sold it at a profit of 5,000. And they must have included that profit in their own profit and loss account. Is it clear to you or not? Quite obviously, if I am going to sell somebody 30,000 worth of stock at a margin of 5,000, obviously I am going to include immediately 5,000 worth of profit in my books. So they must have recorded 5,000 worth of profit in their books. But now, because Y Limited is taking over the Z Limited, now W Limited is taking over the Z Limited, and W Limited will tell to Z Limited, we have purchased this stock from you, and this stock is still lying. That means it is unutilized. It was not used. So 30,000 worth of stock which is lying with us, actually we have purchased it from you. So now Z Limited will reveal the point that actually this is not the cost price, because under this 5,000 worth of margin is there. Actually their cost price is 25,000. So this 5,000 worth of profit which is included under 30,000 will be known as now unrealized profit, because this profit is not realized, because stock are still what we call lying. They are still lying unutilized. So it is known as unrealized profit, and unrealized profit will also be eliminated. How it will be eliminated, that I will let you know in a short while. But point is that first of all, you need to understand that last two transactions will not have any bearing in the ultimate solution of the question. But only thing is that in the books of the acquirer, you will have to wipe out, as I told you, intercompany transactions, and also it is known as transaction related to unrealized profit. Transaction related to unrealized profit could arise only if one company might have purchased some stock from the other company and some portion of the stock is still lying at the time of combination. Is it clear to you or not? So now we can proceed to solve this particular question. Before we start, we must also keep in our mind that total number of shares of Z Limited is equal to 3 lakh, while total share capital of Y Limited is 5 lakh, total share of Z Limited is this much, and besides that, one share is of 100. We must not also let it escape out of our memory that we have purchased, in fact, Z Limited has purchased 1000 shares of Y Limited of rupees 100, but they have paid 1 lakh only to purchase 1 lakh worth of share. So this is the point. And on the basis of this point, now we can start what we call solving down this particular question. In order to solve this particular question, space, I will require space, lots of space. Anyway, so this is this is the second case, and under this is 8B1, I think so. Just let me check it up. 8B1, right. So this is section 8B, and we are picking up the only question, that is question number 1. Because there is no variety involved in it, so that is the reason actually only one question is given. I also told you, as far as this particular section, intercompany holding, is concerned, in the examination you won't be asked a very lengthy sort of solution. You will be generally asked the computation of purchase consideration. This is my personal opinion, and I think that will be the case in the examination. Anyway, now we start solving this particular question. In order to solve this particular question, quite obviously, I need to compute the intrinsic value of share under the first step. So, under the first step, I will write here intrinsic value of shares. Because purchase consideration shall be discharged on the basis of intrinsic value of shares. There is a company by the name of W Limited or Y Limited, whatever it is, and another company by the name of Z Limited. Correct? So first of all, we will take into account their sundry assets. Sundry assets given in the question, as we can see, 7,50,000, isn't it or not? And 3,50,000. After noting down sundry assets, now I will write here investments. In this case, there are no investments of W Limited. There are no investments of W Limited. However, investment of Z Limited is given, but we have to make sure what is the present value right now of the investment. And that value we are going to put up over here. So that is the reason right now I am stopping myself from writing any figure in what we call column of this Z Limited. There are two assets only, and then we are going to subtract less only liability, that is in the form of creditors. Now creditors in this question of Y Limited is equal to 1,50,000. And creditors of this entity is equal to 95,000. 95,000. Is it clear to you? Because as far as W Limited is concerned, now we have their total assets 750 and total liability 1,50,000. We are in a position to find out the net assets of W Limited. So I am going to write here net assets. Net assets, that is equal to 6 lakh. Because in this question there is no preference share capital, so net assets also means assets for equity shareholders. Correct? Assets for equity shareholders. So we have found out the assets available for equity shares as far as this particular entity is concerned. Correct? Now we are going to divide it by the number of shares. If I am going to divide it by number of shares, total share capital is 5 lakh. And one share is of 100 each. So we may say that in this particular case, number of equity share is equal to 5,000, isn't it? Now 6 lakh divided by 5,000, it will deliver me 120, I think so. So I am going to write 120. So now in here, we have got the what we call intrinsic value of share of W Limited. So that means in this question, first we computed the W Limited's intrinsic value. And now we are in a position to find out the investment value of this entity. So in this particular case, now I may say that the value of the investment will be equal to, because we have invested in 1000 shares of rupees 100 each, but their value is equal to 120. So this is the value I am going to write now. Is it clear to you or not? So in this particular question, value of the investment will become this much, 1,20,000. Is it clear to you or not? Absolutely clear. So if it is clear to you, now we may say that 4,70 minus 95,000 is equal to 3,75,000. So 3,75,000 will be the assets available for equity shares. Now, as far as share capital is concerned, their share capital given in the question was 3 lakh. So number of share will be equal to 3,000. After dividing it by 3,000, we get 125. So 125 will become the intrinsic value of the share. So we have now at our disposal intrinsic value of share of both the entities. Once we have the intrinsic value of both the entities, the next step is obviously now consideration payable. What consideration should I pay now? That is the point is, this is the first step. Under the second step, consideration payable. Now I want to know actually how much consideration I am supposed to pay. Consideration payable. As far as consideration payable is concerned, in this case, first of all, I am going to write number of shares of Jet Limited. Number of shares of Jet Limited. Number of shares of Jet Limited given in the question. Jet Limited is the acquiring entity. Total number of share is 3,000. Total number of share is 3,000. From the perspective of the purchasing unit, this time you are not having any shares of acquiring entity. You are not having any shares of acquiring entity. So from your perspective, all these shareholders are outside shareholders. Isn't it or not? So you will have to pay them. At what value you should make them the payment? The point is that obviously these shareholders will claim that intrinsic value of our company is 125. So kindly pay us this much of amount. So we shall multiply it with the intrinsic value of share of obviously of Jet Limited, of acquiring entity, because they are shareholders of acquiring entity. They are all are outside shareholder from the perspective of the acquirer entity. Intrinsic value of Jet Limited. Intrinsic value of Jet Limited we computed was equal to 125. If we will multiply it, obviously we will get figure equal to the net assets, because we have already computed net asset. So it will be equal to rupees 3,75,000. That means this much of purchase consideration we have to give this time. Acquirer entity is supposed to pay this much of consideration. Is it clear to you or not? Now, in order to deliver this consideration, purchasing company will issue, okay, first let me stop it here. I will make another step, third step. Number of shares to be issued. So number of shares to be issued by number of shares to be issued. Number of shares to be issued by Y Limited, that is acquirer entity, Y Limited, to discharge purchase consideration. To discharge purchase consideration. So in order to discharge rupees 3,75,000, obviously now acquirer entity is going to take into account its own intrinsic value of share. Its own intrinsic value of share is equal to rupees 120. So these many shares I will have to issue. I will have to divide it by 120 and it will give me 3125. So total number of share which we should issue to the shareholders, 3125 shares. Correct? 3125 shares of our company we are supposed to issue to the shareholders. Clear? But point is that the moment we are going to derive this figure, 3125 shares we are supposed to issue, now it will click to the acquirer entity. Now it will click to the acquirer entity that out of 3125 shares, actually which we are supposed to issue to the shareholders of the acquirer entity, to the acquiring entity is already having 1000 shares of our company. Correct? So, I will write here first of all, shares already held by Z Limited. Now Z Limited is already having 1000 shares of our company. Actually, when we are going to issue 3125 shares to the shareholders of the Z Limited, they will become our shareholders. But suddenly now we will see that 1000 shares are already held by Z Limited. So technically now I need not require to issue 1000 shares. I am supposed to issue only these many shares. Correct? So number of shares to be issued. Number of shares to be issued. Number of shares to be issued. How many shares you are going to issue? The point is this. Technically, you are supposed to issue only 2125 shares. Of course, 2125 shares of rupees 100 each. Shares of rupees 100 each at the rate of 120. Technically, you are supposed to issue these many shares, 2125 shares, correct? So we will issue 2125 shares. So what will be the purchase consideration now? Thus, under the fourth step, I will write effective purchase consideration or effective consideration. It is not necessary to write the word effective. Thus, consideration payable will be equal to what? It will be equal to 2125 into 120. Logically, I should write 120. Isn't it or not? Because every time we do in this manner. However, in this case, instead of writing 120, I am multiplying it with rupees 100. Why I am multiplying it with this figure, I will let you know. 2,12,500 will be the purchase consideration. Reason is that in this question, it is stated that entries to be made at par. Entries to be made at par. In this question, it is stated that entries to be made at par. In this case, it is clearly stated that entries need to be made at par. That is the reason why I am taking 2125 into 100 and not 2125 into 120. Is it clear to you? Obviously, if this line would not have been written over here, I would have definitely considered 120 as the figure. Is it clear to you or not? Right, sir, absolutely clear. Well then, if it is clear to you, after having computed all these things, let me also discuss the next step, books of acquiry. Books of acquiry entity. Books of acquiry entity. As you know, in the books of the acquiry entity, we are supposed to prepare, as usual, one, we prepare acquirer company's account, correct? Then we prepare realization account, Besides that, besides all these accounts, realization account, otherwise, let me create a little bit of more space. Acquirer company account, realization account. Then in order to understand them better, I will also prepare shareholders account and shares in Y limited account. If any more account I will need, I will definitely prepare that. Okay, one is acquirer entity. Acquirer entity is Y limited. In the books of Z limited, we are going to prepare acquirer entity, and the name of acquirer entity is Y limited. I am going to prepare the realization account. Okay, realization account. Although it is not needed, but just for better facilitation, I am writing here shares in Y limited account. Y limited account. And besides that, I am preparing shareholders account. So these are the accounts which we are supposed to prepare to close the books of the accounts of the acquiring entity. Clear? And in order to close the books, first of all, we will look into the balance sheet of the acquiring entity. In the balance sheet of the acquiring entity, what we see, the first item is sundry assets. So I am going to write sundry assets. That is equal to 3,50,000. 3,50,000. Correct? On the asset side, one more item is appearing in the form of investment. What we will do, I will let you in a short while. Now we move over to the liability side. In the liability side, we find creditors equal, this is realization account. Just wait. I wrote in acquirer company. We are preparing realization account to sundry asset, 3,50,000. And then I will write here by creditors. Amount of creditors is equal to 95,000. After writing these figures, now we will look into the balance sheet. There is what we call share capital. And share capital is equal to actually 3 lakh. So I will write share capital towards the credit side of the shareholders account, 3 lakh. This entire share capital belongs to outsider, no doubt about it. This is acquiring company share capital, isn't it or not? Right, sir. Now, when I am going to prepare shares in Y limited, please pay attention. I told you towards the asset side of the acquiring entity, there are two items. One is sundry asset and another one is investment, correct? This shares in Y limited, because that investment of Z limited is nothing but shares of Y limited. In the balance sheet, it is also written shares in Y limited. So that investment will be brought down over here, and you are going to write here 1 lakh at balance sheet value. I have already told you, if we transfer any item of balance sheet in the accounts, that will be at value which is being presented in the balance sheet itself. So the investment of Y limited is nothing but shares in Y limited. So we will write here balance brought down. Is it clear to you or not? Besides that, there were some reserves in the question, and reserves were, I think, 55,000. So I will write the reserves in the shareholders account to the extent of 55,000. Correct? So right now, we may say that we have transferred all the items of the balance sheet. Correct? Now I am going to write here by Y limited, that is acquirer entity, for purchase consideration due. This is the amount of consideration. And we computed consideration 2,12,500. 2,12,500. Now I am going to write it towards the debit side of acquirer company. And here I am going to write to realization account. That is equal to 2,12,500. Now we are going to receive the payment. When we will receive the payment, we will write here shares in Y limited account, because we will receive the payment by way of shares. So shares in Y limited, 2,12,500 I will write. So this account is closed. Because in this question we are preparing shares in Y Limited account, this will be written over what we call debit side also, because we have credited here. So towards this particular account on the debit side, I am going to write Y Limited, because we are receiving these shares from Y Limited. The title of this account is Y Limited or acquirer entity, 2,12,500. Now, total shares available, correct, here is equal to 3,12,500. And now we will close this account by transferring the balancing figure to the shareholders account. So all the shares, 1 lakh plus this, 3,12,500 will be closed by transferring it to the debit side of shareholders account. On the debit side of the shareholders account, now I am going to write 2 shares. So this figure will now find place over here. So shares in Y Limited. Shares in Y Limited, 3,12,500. Correct? This is how you are supposed to do this one. Now, ultimately, we will tally this account, realization account, only 350 minus this. So that will be equal to 42,500. So loss will be transferred to shareholders account. And on the debit side of shareholders account, I will write here to realization loss 42,500. So 3,55,000 and 3,55,000. So your shareholders account is getting tallied. Is it clear to you or not? Now the next thing is we have to pass the entries in the books of purchasing company also. So your next step will be books of acquirer entity. Books of acquirer entity. Books of acquirer entity. As far as books of acquirer entity is concerned, in this particular case, what you are supposed to do, your first entry will be obviously with respect to what we call assets which you have taken over, sundry assets account debit. I am going to write sundry assets account debit. That is equal to 3,50,000. 3,50,000. Is it clear to you or not? Right, sir, it is clear. Sundry assets account debit 3,50,000. Fine. Yes, sir. As far as acquiring company is concerned, you may say, sir, their investment was also there. Remember one thing, that investment is already closed by transferring it, as we just saw. That is the reason actually why I was preparing this particular part first. Correct? Their investment account is already transferred to shares in Y Limited, and all the shares have been posted to the shareholder account. So their investment you will not take over. Correct? Now you are going to take over their creditors. Their creditors is equal to 95,000. You are going to take over their creditors to the extent of 95,000. In this particular question, actually the problem is this, because it was given in the question that entries to be made at par. So sometime question may say so. At that time, you should immediately come to the conclusion that this is a case of common control. This is a case of common control. Correct? This is a case of common control. So if the question would state that entries is to be made at par, in that case, it is better to treat it as what we call case of common control. And in case of common control, correct, generally what happens whenever we takes over the other entity, absorb the other entity, an existing company is taking over another existing entity. So whatever reserves are there, we have to, actually you have learned in your past phases of the education that reserves of the what we call acquiring entity are also taken over. But the fact is that, let me clarify this myth. Suppose in this particular question, Jet Limited is being taken over, and obviously it is a case of common control. And in the books of Jet Limited, we found that there is reserves of rupees 55,000. So if there are items of other equity in the books of acquiring entity, generally in case of common control, those reserves are brought forward. Generally it is said by the faculties and by the authors, etc. But the fact is that you must understand, reserves of Jet Limited can never be taken over. Can never be taken over. The reason is very simple. Because we have transferred the reserves to the shareholders account, it is already closed. So rule is not that we are taking over their reserves. The statement of the standard is that in case of common control, generally the reserves or the items of the other equity will not be taken over. It is not written in the statement like this. It is written that the entities of the reserves will be preserved. Entities of the reserve will be preserved. What does it mean? It means we are not taking over the reserve of Jet Limited, but we will preserve its entity. How can we preserve its what we call identity? We can preserve its identity by creating a reserve from our side. Actually, we are not taking over the reserves of, as I told you, acquiring entity, because practically it is not possible. The reserves get closed, as we have seen in the books of the acquiring entity. But standard at the same time says that generally in the case of common control, all the reserves or the items of the other equity must be preserved by the what we call purchasing unit. So in this case, I am not taking over the reserves. Although for the sake of simpler words, you may say that we are taking over. Actually, we are not taking over. In fact, we are creating these reserves out of our own resources. That is how we are maintaining the identity of the reserves. Is it clear to you? So this is the point which most of us actually confuse. Not only you, but many people and author also. So that is why I am taking over the reserve here in this particular case. You need to understand this particular point. In case of common control, if you are an existing entity and you are taking over the other entity, then logically all the items, other equity items which are appearing in the books of acquiring entity must be preserved by the acquirer entity. And when we say preserved, that doesn't mean we are taking over. It means we are creating similar sort of reserve from our resources. Because reserves was appearing in the books of acquiring entity at 55,000, I am going to write here 55,000. Technically, it is a loss to us, loss to the acquirer entity. But in case of common control, see here, try to understand what I am saying, because one student did ask one question regarding that. Actually, one question of common control we did, wherein reserves was there, but we did not brought it forward, or we did not preserve the entity of that reserve. Because in that particular case, try to understand, it was not a case of an existing company taking over the other existing company. In that case, we were dealing with the new company, and I gave the answer to that guy. I forgot the name. He asked this particular question, and very good question it was, no doubt about it. At the same time, he asked her why we did not take the reserves, or why we did not actually brought forward the reserve. In simpler word, why we did not created the reserve. When we did one question of common control, there was positive balance in the reserve, but still we did not actually created similar sort of reserve in the books of acquirer entity. The reason was that over there, it was not a case of an existing company taking over another existing company. It was a case of one company dealing with a new company. An existing company was dealing with a new company. In fact, one division of existing company was dealing with a new company. Over there, actually, you will not take over. But if an existing company will take over another existing company, and it happens to be a case of common control, in that particular case, the standard says that identity of all the reserves must be maintained. And when we say identity of the reserves must be maintained, many among us actually construe it in a very mischievous manner, in a wrong fashion. It doesn't mean we are taking over the reserves. You are all at professional level. Just think for a while how it is possible, because reserves are already closed in the books of the acquiring entity. So we have to actually create some sort of what we call reserves through our own resources. Is it clear to you or not? Is it clear? Just to simplify it further, I will simplify it further, because I'm still not having a feeling that most of you have understood the way actually I want you to understand. Just imagine for a while, from Delhi actually Agra is not very far away. And each one of you have heard about what we call Taj Mahal. It's a wonderful, wonderful historical monument, no doubt about that. Correct? One of the wonders of the world. Now suppose one person goes to see the what we call Taj Mahal, and he was virtually bemused and bewitched by the what we call beauty of Taj Mahal. And he is so bemused and so bewitched by the what we call beauty of the Taj Mahal that he is interested in what we call just preserving the identity of Taj Mahal. Now, obviously, just you imagine for a while, is it possible to actually just lift that historical monument and bring the what we call monument to his house? It is not possible. However, he can preserve the what we call beauty of Taj Mahal. How? How he can preserve? One, he can actually create another Taj Mahal, which again actually looks very impossible. But the fact is that he can go to the market and he can buy a toyish, what we call a Taj Mahal. And he can keep that Taj Mahal in his house. So that way around, we may say he is preserving the identity of the Taj Mahal. He is not bringing the Taj Mahal, he is not taking over the Taj Mahal, but he is creating from his own efforts, he is creating in some or other way around a Taj Mahal in his house. Are you getting my point? This is the situation here. So we are not taking over the reserves, we are creating the reserves from our resources. So 55,000. It is a case of common control, because in this particular case it is specifically written that entries to be made at par value only. So it is better to consider it as a case of common control. And here it is a case of one company taking over another entity. Then consideration. I will write the consideration. Amount of consideration in this particular case, amount of consideration is 2,12,500. I will write here 2,12,500. If you remember, under common control case, I did mention this particular point that if balancing figure is, let us say, towards this side, we obviously write capital reserve. But in this case, balancing figure is over here. And if you remember, I talked over there also, in case of common control, most of us sometime actually write goodwill. Even your module actually has done this. I should not say mistake, but they have written goodwill. Logically, in my opinion, that is wrong, because in case of common control, it is clearly stated that not a new asset will be recognized. So it is better to debit, even though it is a debit balance, write it capital reserve. This is balancing figure. Of course, debit capital reserve is also means goodwill. So 12,500 will be your balancing figure. Is it clear to you? Now, we are supposed to discharge the consideration. I will write here consideration account debit. Consideration account debit. And that is equal to 2,12,500. And then I am going to write here 2 share capital. In this case, I have already told you, and we have already computed that 2,125 shares we are issuing. But now, because it is stated in the question that entries to be made at par value only, so we are going to take into account par value only. So, and further in this question, when we were analyzing the question earlier, I told you there is a case of intercompany transaction. So we will cancel out the amount which is owed by one company to the other company, and that was 20,000. So we will write here, actually this is, I am writing the narration, cancellation of intercompany dues. Cancellation of intercompany dues. Intercompany dues. Intercompany dues. Cancellation of intercompany dues. So we are going to now cancel out intercompany dues. So intercompany dues, how it will be cancelled out, please pay attention. In order to cancel out the intercompany transaction, we will have to debit the creditors and we will have to credit the debtors. Actually, in this question, debtors and creditors are not given separately. Not given. So instead of writing creditors, I think in the balance sheet creditor was written. Just let me write. Where is the question? Oh, I have to move way back. In the balance sheet, creditors are written, but on the opposite side, there is only sundry assets, correct, in this particular question. See, at this level, you have to keep an eye for all these things. A slight mistake could actually result in unnecessarily cutting off marks. Internet jagging. This is problem sometime. All these electronic gadgets are concerned. The moment I complained, it got resolved. Where it has gone. Right. So it is better to write creditors account. Fine. We have written creditors only. Creditors account debit. But on the asset side, debtors are not there. So you better write sundry assets. Correct? 20,000. So this is cancellation of the intercompany owings. And then there was treatment of unrealized profit, correct? Unrealized profit. I told you unrealized profit is equal to how much? 5,000, which we computed because it was given in the question that in the books of Y Limited, there is stock, obviously under sundry asset, which they have purchased from what we call Jet Limited, and the amount of stock is actually 30,000. So it becomes a case of unrealized profit, and unrealized profit must be eliminated also. In order to eliminate the unrealized profit, what we are supposed to do, the point is this. In order to eliminate the unrealized profit, I'm going to write profit and loss account or reserves account, because when earlier goods were sold, they must have included the profit in their profit and loss account. So logically, profit and loss account will now should be reduced because it is unrealized profit, and the amount of stock will also be reduced. But in the question, stock is not given. So I'm writing sundry asset, and in bracket, I will write stock. So 5,000. However, it is a case of common control. In case of common control, to remove the unrealized profit, we write profit and loss account debit to general reserve. And just for knowledge sake, if this question would not have been of common control, it would have been of acquisition method. In that case, instead of profit and loss account, I would have written goodwill account debit or capital reserve account debit to sundry assets account or stock account. Is it clear to you? In that case, I would have written this entry. However, this is a case of common control. I will have to write this particular entry. So this is all about as far as what we call when acquiring company holds share in the books of acquired company. Nothing else, although I have already told you, at the most you may be asked to prepare the what we call accounts in the books of acquiring entity. Sorry, you may be asked at the most computation of purchase consideration, and at the most what we call entries in the books of acquiring entity and entries in the books of acquirer entity. At the most, generally you will be asked only till up to the computation of purchase consideration. There is another section I have attached, and honestly speaking, I don't think you are going to get any question. See, I should be very honest to you. Even though I am doing this particular section for you, and this section deals with cross-holding. I told you earlier there are three sort of scenarios which we may have to face. So first two we have already seen, and now we will see that when concurrently one company is having shares of the other entity and other entity is also having what we call shares of the other entity. We'll talk about, as I promised, that in this particular part we shall try to cover up the last portion of intercompany holdings, although chances are almost negligible at this level that any question could be asked, but still just on the safer side, because we have done everything. I have a habit of doing 100%, and that's what I would like to inculcate in you. Correct? Hope you will show the patience and keep on writing. Correct? Earlier you were writing lots of messages, but I have seen there is a little bit decline. Anyway, the following is the balance sheet of A Limited and B Limited. Correct? Now, if you look into the balance sheet, and you have to look it very carefully, share capital is, further it is given share capital fully paid equity shares of 100 each. And actually, this figure is like this. 15 lakh. Share capital is 15 lakh and 5 lakh. Correct? One share is of 100. General reserve is actually 2 lakh and 1 lakh. Then we have profit and loss account equal to 1,60,000 and 10,000. Then we have debentures. This company is not having any debentures, and this company is having debentures. Correct? And further we have current liability of 2 lakhs and 2 lakhs. 2 lakhs and 90,000. Correct? Further we are being given property, plant and equipment, as we can see, 10 lakh and 50,000. Then sundry debtors 2 lakh 90 and 1 lakh 50. Further we are given stock 4 lakh 80 and 2 lakh 10. And now you can see here 1,000 shares. This is written in the column of what we call this entity A Limited. This is written in the column of A Limited. So A Limited has purchased 1,000 shares of B Limited, and for that they have made payment of 1,50,000. Whereas in this case, A Limited is also having what we call 3,000 shares in A Limited, and they have purchased 3,000 shares of A Limited at a price of 5 lakh. This is the question. Further, this particular line is given that B Limited traded in raw material which were required by A Limited for manufacture of its products. And stock of A Limited includes 1 lakh worth of purchases made from B Limited, on which B Limited made a profit of 12% on selling price. This is a case of unrealized profit, as I just told you. Further, it is given A Limited owed 25,000 to B Limited. This is a case of intercompany transaction. These two entries will be passed in the books of the acquirer entity. It was decided that A Limited should absorb B Limited. So A Limited should absorb B Limited on the basis of intrinsic value of the shares of the two companies. Also, it is given before absorption, A Limited declared a dividend of 10%. So before absorption, A Limited has also declared a dividend of 10%. A also decided to revalue the shares in B Limited before recording the entries in the books of the absorption. This is the question which is given to us. We will note down once again the share capital. Share capital is 15,000 shares, and it has got 5,000 shares. Correct? And we have noted down the what we call respective investment in each other. And moreover, you are having the questions before you. So let's come to the point and start solving this particular question. Obviously, I will need a bit of a space to solve. Well, so this is the third part. This is the third part, as I told you, as far as intercompany holdings is concerned, wherein both the companies have what we call holdings in each other, and we call it a case of cross-holding. So in order to understand the repercussions of all these things, let's have a look. It's a pretty complicated one, no doubt about that. But still, this is section 8C, and section 8C deals with cross-holding, as I have already told you. Cross-holdings. This section deals with cross-holdings. And you know the meaning of cross-holdings now. So that should not be a tough task for you, especially if you have understood the first two parts In this case, we should not presume everything is given in the question. We are making a bit of analysis. First of all, company A is there, company B is there, correct? And share capital of both the companies is given to us. So first of all, we note it down. Intentionally, I'm noting it down just to keep your attention intact. 15 lakh we just went through, and then 5 lakh is the total share capital of B Limited, correct? And then I'm going to divide it by number of shares, divided by face value. Face value is 100 and 100. So we get number of shares. So number of shares is equal to 15,000. Number of shares is equal to 15,000. As far as this entity is concerned, the number of shares of B Limited will be equal to 5,000. Correct? Now, if I will open it up, out of these 15,000 shares, we have just seen that B Limited, out of these 15,000 shares, correct? We have seen that 3,000 shares are held by B Limited. 3,000 shares are held by B Limited. So, 12,000 shares are not held by B Limited as far as total number of shares of A Limited is concerned. Just, I want to know, out of total share, what fraction of shares are held by B Limited. So what I am going to do, 3,000 divided by 15,000. Out of 15,000, B Limited is having 3,000 share. So we can say that 1/5 of our share capital is in the hands of B Limited, isn't it? Can we say it that way around or not? Fine, sir. Similarly, now as far as B company is concerned, if company B is concerned, out of 5,000 shares, we have seen that company A is having 1,000 shares. We just went through it. So company A is having 1,000 shares. Obviously, company A is not having 4,000 shares of B Limited. From the perspective of the B Limited, these 1,000 shares are held by A Limited. Now, suppose if I say 1,000 divided by 5,000, so I may say that even company A is having 1/5 of the total share capital. Company A is having 1/5 of the total share capital of what we call B Limited. Is it clear to you or not? Right, sir, it is absolutely clear. If it is absolutely clear, just to mark it down, so total fraction of share capital in the hands of A Limited of B Limited is 1/5, and at the same time total fraction of share capital held by B Limited in A Limited is also 1/5. However, important point is that both the companies are holding upon shares of each other. Is it clear to you? Obviously, in this particular question also, we shall have to apply the intrinsic value of share method. Now you may wonder, sir, how can we apply it? Let's have a look over here. So first of all, I will compute the intrinsic value of shares. So in order to compute the intrinsic value of share as usual, first of all, I am going to write down the assets and liabilities of both the entities. So property, plant and equipment of these two entities, first of all, let me jot it down, 10 lakh and 50,000. Correct? Besides that, in the question we have already gone through, there are debtors, and debtors of A Limited given in the question is 2,90,000, and of B Limited it is given 1,50,000. How much? That is equal to 1,50,000. Besides debtors, now in the question there was cash balance also, cash bank, whatever it is, 1,40,000 and 90,000. Besides cash balance in the question, there is one more item, I think stock. I haven't written stock, 4,80,000 and 2,10,000. And here you have to exercise caution. Here I am writing a word, proposed dividend. Sir, from where you got this proposed dividend? In the question it was written that A Limited has declared before absorption, that means before A Limited took over B Limited, Before that, A Limited has declared a proposed dividend. Now, total share capital of B Limited as A Limited is actually 15 lakh as we have seen. So that means the total proposed dividend declared by A Limited must be equal to 1,50,000. That is 10% of 15 lakh. See here, please try to understand this particular point. Where should I make you understand? See here, A Limited's total share capital is 15 lakhs. Before absorption, that means when B company was not in our fold. Earlier to that, we had proposed a dividend at the rate of 10%. So 10% proposed dividend means 1,50,000. Because out of 15 lakh worth of share capital, company B was having 3,000 shares of our company. That means one fifth of the total share capital was in the hands of B Limited. So whatever proposed dividend which we have declared, out of that, 1/5 must belong to B Limited. Obviously, the shareholders of B Limited will get what we call 1/5 of the total, what we call proposed dividend. So that is the reason, because we have proposed a dividend before the absorption, so out of 1,50,000, 30,000 worth of proposed dividend is receivable by B Limited. That is why B Limited is going to reflect it as an asset in its books. Is it clear to you or not? So this is the point. And then I will write here less liabilities. As far as liabilities are concerned in the question, we are being given, first of all, current liability, and there is no current liability of this entity. I think debentures were not there, if I am not wrong. Debentures. So let me first of all write debentures. 10% debentures. When we were going through the question, we saw that debentures of this entity is equal to nil and debentures of this entity is equal to 3 lakh. After debentures, there was current liability. Current liability is 2 lakh and 90,000. Clear? Then you must not forget to write here proposed dividend, because A Limited has proposed the dividend and total dividend proposed by A Limited is 1,50,000. It is a liability for A Limited. Out of 150, that's a different matter. 30,000 is payable to B Limited. Is it clear to you? Now in this question, you must have noticed we haven't written investments made by both the companies in each other. We have escaped off that particular item intentionally, correct? I will simply compute the net assets. Of course, this will be known as net assets without considering investments. Without considering investments. We did not consider the investment and we computed the net asset without considering investments. If I am going to actually find out the net assets, I will find that it is equal to 15,60,000. You can do the calculations by yourself. And 1,40,000 will become the net assets of this entity. Of course, we have found out the net assets without taking into account the investment made by the entities in each other. Is it clear to you or not? Now the question is that we have to find out intrinsic value. And for that, we need to have the value of the investments. Correct? But point is that how to find that out. So here, what we are going to do, see here, I will take a presumption in order to compute the intrinsic value of share. Now I am going to take a presumption. What sort of presumption? Presuming, or I will write presumptions. We presume that A stands for value of net assets, total net assets. Actually, this is the net asset, but this is not the value of net assets proper, because we haven't taken into account the investment. So I'm presuming for a while that A is equal to value of net assets of A Limited. Value of net assets of A Limited. We are presuming. Likewise, we are presuming that B stands for value of net assets of B Limited. Correct? So we have to take this presumption. Little bit of mathematics now will come into play. So because mathematics will come into play, now I am going to write here value of net assets. So we have to find out value of net assets. How can we find value of net assets? See here. I will write here A. And so far the value which we have computed in respect of company A is equal to 15,60,000. I am going to write 15,60,000. I know that this is the value of the net assets, but without considering the value of the investment. Could you tell me what will be the value of the investment of A Limited in B Limited? What will be the value of investment of A Limited in B Limited? See here, that is 1/5. I told you total fraction of shares held by A Limited in B Limited is equal to 1/5. Is it clear to you? That is equal to 20%. So, and we have presumed that value of net assets of company B is equal to B. We have presumed it. Their proper net assets value is equal to B. So that means 1/5 of B. 1/5 of B. So this is the value of our investment in company B, 1/5 into B. Are you getting my point or not? I will simplify it further so that it becomes a little bit easier to handle. 15,60,000. What you do, you divide 1 by 5. When we divide 1 by 5, it will be equal to 0.2. So 0.2b. So now we can say that A is equal to, A stands for value of net assets of A Limited. So value of net assets of A Limited must be equal to 15,60,000 plus 0.2b. Now I will simplify it further. See here, 15,60,000. 15,60,000 plus 0.2b. So 0.2. And we know what is B. See here, we have already written B is equal to, we can say it in this manner. B is equal to 1,40,000. B is equal to 1,40,000 plus. Actually, before I move to this step, let me actually clarify in this manner. I have written here value of net assets of A Limited so that you understand it better. Because generally students of commerce don't understand the mathematics so easily. I have seen it through my own experience. Don't worry about it. I am including myself. So here I wrote value of net assets of A Limited is equal to this. Similarly, we can say value of net assets of B Limited, because the value of net assets of B Limited is 1,40,000. But this is without considering investments of B Limited. So what will be the value of investment of B Limited? B Limited also holds 1/5. 1/5 means 0.2, 20% or 0.2. Is it clear to you or not? You can write 1/5 or 0.2. So 1/5 of total net assets of A Limited, and we have presumed total net assets of A Limited as A. So this is the value of net assets of B Limited. So that this is the point I was trying to tell you. Because we have seen that A is equal to 15,60,000 plus 0.2 into B. That means 1/5 of net assets of B. So this is the value, this is the net assets of A Limited. Now I am opening it up. 15,60,000 plus 0.2, and we know now B is equal to this much, 1,40,000 plus 0.2 A. So this is the equation now in front of us. I will solve it further now. It will be equal to 15,60,000 plus multiply 0.2 with 1,40,000. Don't be scared of 28,000. 28,000 multiplied 0.2 with 0.2 A. It will be equal to plus 0.2, that will be equal to 0.4 A. So 0.4 A. So this is the situation at this moment. Now we will take 0.4 A towards the what we call left hand side. So it will be equal to A minus 0.4A is equal to 15 lakh 60 plus 28,000. That is equal to 15 lakh 88,000. If I am going to subtract 0.4A from A, it will be equal to 0.96A. 0.96A is equal to 15 lakh 88,000. 15 lakh 88,000. Clear? Now, we can find out the net assets of A Limited, because A stands for value of net assets of A Limited. So now we have got the total net assets of A Limited, 15 lakh 88,000 divided by 0.96. And this is equal to 1654,167 approximately. So this is the value of the net assets of A Limited. Now we have got the value of net asset. This is your value of net assets of A Limited. Value of net assets of A Limited. This is how you are going to find out the value of net assets of A Limited. Correct? Now you can also find the value of net assets of B Limited. Value of net assets of B Limited. Value of net assets of B Limited. What will be the value of net assets of B Limited? First you write the equation. B is equal to 1,40,000 plus 0.2A. Now we know the value of A. The value of A is equal to 1654,167. Correct? So we can solve it to find out B, and it will be equal to 4,70,833. So this is how we are going to find out the value of net assets of both the entities. Now we have got net assets of A and B, and there is no preference share capital. So net assets means assets available for the respective shareholders. 1554,167 and 470,833. Now we are going to divide it by number of shares to find out the intrinsic value of share. So number of shares, 15,000 share, 15 lakh divided by 100, and 5 lakh divided by 100, 5,000 shares. So intrinsic value of shares now we can find out, and intrinsic value of share will be equal to 110 and 94 approximately. Is it clear to you? At the most you may be asked till up to this particular under what we call cross holding. I don't think anything will be asked, but still, if you can just show a little bit of more patience. Step 3, I want to know consideration payable. You have done till up to this point, so kindly do this also, consideration payable. Because A Limited is taking over B Limited, how much consideration in this case A Limited will deliver to B Limited? This is also the point. So first of all, I will write here total number of shares of B Limited. Total number of shares of B Limited is equal to 5,000. Total number of shares of B Limited is equal to 5,000. We have already seen that out of these 5,000 shares, 1,000 is already held by A Limited. Just imagine the situation 1 when acquirer company holds shares in B Limited. Correct? Held by A Limited. Held by A Limited. Held by A Limited 1,000. So from the perspective of A Limited, outside shareholder will be considered 4,000. Outside shareholders will be considered 4,000. So you are supposed to pay to the outsiders. Now these outside shareholders will claim that we have, because our company, that is company B, is having an intrinsic value of 94, so our worth is equal to this much. That is equal to 3,76,000. Pay us 3,76,000. They will ask for this much of payment. We will say, okay, we will pay you this much. And in order to pay this much, as you know, we are going to divide it by intrinsic value of share of our company. So 3,76,000, we computed intrinsic value of our company, that is equal to 110, correct? So it will tell us number of shares to be issued, number of shares. Logically, to make a payment of 3,76,000, we need to issue 3418 shares. It means 3418 share. But now, when the time of issue will come, again it will click to us that out of 3418, now you think of situation 2. Out of 3418 share, 1000 shares are already in the hands of B Limited, because B Limited is also having some shares of our company. So 1000 held by B, 3000 shares held by B. In fact, they are having 3000 shares. 3000 shares already held by B. Already held by B. So we need not require to issue 3000 shares. So how many shares we are supposed to issue? So net number of shares to be issued. Net number of shares to be issued. To be issued. That is 418 only. Only 418 share we are supposed to issue. Is it clear to you? And what will be the purchase consideration? We will multiply it with 110. So your purchase consideration will be equal to 45,980. This will become your purchase consideration. Is it clear to you or not? Having completed a very tough topic with respect to what we call intercompany holding, wherein we had discussion with respect to 3 scenarios, and last session you must have noticed was pretty lengthy one, almost of 2 hours. And now we are moving over to a yet another important section, and this is very, very important section. Section 9, reverse acquisition. In the initial stages, I told you, generally 99.99% legal acquirer happens to be the legal acquirer. However, on rare occasions, we may find actually that sometime the legal acquirer is not the accounting acquirer, and such a scenario is known as reverse acquisition. Isn't it or not? And today in this particular section, we are going to actually talk about, and we are going to pick up 2 questions, and both the questions have been picked up from your module, and we shall analyze how the accounting will be unfolded when legal acquirer is not the accounting acquirer. So reverse acquisition topic we are picking up. In the meantime, green signal is also on. Very lovely good evening to all those who have just connected with us now. And we are beginning now reverse acquisition. So kindly open down your section 9, and along with that your register, pen, pencil, whatever. And in case if you are interested in writing, and in fact I always stress upon this particular fact, please and kindly take the pain of writing. The more you are going to write, the more you are going to understand, and more you are going to retain. So on such note, such prefacing note, and I have a habit of what we call using a pretty longer prefacing note, isn't it or not? Sometimes it might be boring, I know very well, but now we are going to straightway come to the business end to start today's this particular session. 9.1 is the question which we are picking up. This question is of reverse acquisition. Reverse acquisition means when legal acquirer is not the accounting acquirer, or not the what we call acquirer for the purpose of accounting. Correct? So that is known as a situation of reverse acquisition. So let's have a look over here to find out the intricacies involved with all these things. This is the balance sheet of H Limited and S Limited, which is given to you. In the balance sheet, you can notice, one, we have what we call non-current asset, and besides that current asset, very small balance sheet is given to us, and their total is also given to us. Total is actually 3,000 and 4,000. Correct? After that, we are being given equity share capital. Important point is that you need to take into account the face value. And here the equity share capital is 800. You can use 800 lakhs or crores, whatever it is, correct? And then other equity is 500 and 1,600. Besides that, we have got non-current liability and current liability, non-current liability and what we call current liability. So far, so good. No problem. Further, it is given that H Limited and S Limited shares are quoted in the market at rupees 20 and 50. So presently, the quoted price of the respective companies in the market, as you can see, is equal to 20 and 50 respectively as at 31st of 3, 2022, not 20. Correct? 31st of 3, 2022. Further, it is given that H Limited issues share in exchange ratio based on quoted price. Correct. So this time you can say that quoted price of the respective companies are given, number one, and further it was decided that H Limited is going to discharge the consideration. So for a while it seems that H Limited is taking over the business of what we call the other entity, because generally the entity which discharges the consideration is considered as the acquirer entity. So far till up to this particular point, we are under an impression that H Limited is the acquirer entity, because it is clearly mentioned in the question that H Limited is going to issue the shares in exchange ratio based upon the quoted price. Now further, in this particular question, just diagrammatically, I have provided you a little bit of insight that H Limited is there, S Limited is there, and no doubt H Limited is the legal acquirer. Why? Because H Limited is issuing the share and S Limited is the legal acquiree. No doubt about that. Correct? And how we inferred it out, because it is given in the question that H Limited shall issue shares to S Limited. So, according to this particular point, it seems that H Limited is the acquirer entity, at least legal acquirer, from the what we call from the legal perspective, we may say. Now we move over to the other facets of the question. Further, it is given in the question, pass entries in the books of the acquirer and prepare the consolidated balance sheet. So, in this particular question, how to begin and how to analyze the things. Let me have a quick look over the what we call items so that I am escaped of looking at the question later on. Although solution is given in detailed terms, yet I would like to solve this question, but where is the space? Space is the constraining factor. Oh my God. Almost every space is filled up. Okay, no problem. I will create further space. That is good thing about this electronic pads. Whatever space you want to create, you can create actually the space lots of times, no problem in it. So how to begin this particular question? Just have a look over here. In this particular question, first of all, we are dealing up with reverse acquisition case, correct? This is section 9. I've already told you it's a pretty strong topic, and you can definitely in the upcoming examination expect a question out of this particular topic. This is my feeling, this is my hunch, you may say so. Reverse acquisition. Reverse acquisition. Some of you who might have joined us late, correct? Because still I can see lots of messages are flowing in, good evening, good evening. Once you have joined late, there is no point in saying the good evening, rather you say late evening. Anyway, now we are going to start the session as I've already told you. In this particular case, what is happening? Let me come to 9.1 first of all. 9.1 is the question we are picking up. Correct? 9.1. In this question, there is a company by the name of H Limited. Correct? And we have seen that H Limited is taking over S Limited. How we inferred it out, how we concluded it. It is not given in the question in a very clear manner that H Limited is acquiring the S Limited. We inferred it because in the question it is given that H Limited is going to discharge the consideration. So that is the reason at least we can conclude that H Limited is the legal acquirer. So that is the reason I am going to write here legal acquirer. You need not require to write all these things in the examination. This is for your understanding. Correct? And then no doubt about that, S Limited is the legal acquiree. Legal acquiree. From the legal perspective, without an iota of doubt, H Limited will be considered as legal acquirer. S Limited will be considered as legal acquiree. And as I told you, how did we come to the conclusion regarding this aspect? Because it was given in the question, given that given that H Limited shall issue or shall pay consideration, you can simply write in this manner, because it is given in the question that H Limited is going to issue the shares to S Limited. So indirectly it means it is H Limited which is providing the consideration as per the information furnished to us. So we have concluded, because we do not have any other alternative, so we will conclude that H Limited is the legal acquirer and it is the legal acquiree. But as we will move further, what does it mean? Now under step number 2, what I am going to do, first of all, once again, I am going to write here H Limited and S Limited. Is it clear to you? Just for your kind attention, I would like you to write also the share capital. Given in the question, share capital was 1000. Actually, it is not mentioned whether it is in lakhs or crores, whatever figure you may like to write. Correct? 600. And further, it is given that face value of the share is rupees 10 in the question. So that means as far as number of share is concerned, number of shares, we may conclude that H Limited is having 100 shares of 10 each, while S Limited is having 60 shares of rupees 10 each. Is it clear to you? As per the information. Now we move a little bit further. This is just to open the question in a threadbare manner. Further, I write exchange ratio. As we saw in the question, it was given that quoted price in the market of the respective companies were provided. And on that basis, I will compute the exchange ratio. It was being given in the question that exchange ratio, but before I start computing the exchange ratio, first of all, let me know the quoted prices. As far as quoted prices were concerned, given in the question that H Limited is presently having in the market a price of rupees 20, while price of S Limited is actually 50. Correct? Current price of what we call share of S Limited is pretty high. In fact, both the companies are commanding a good price because their face value is 10 and respective quoted prices in the market are 20 and 50. We have now seen all these things. Now, how to compute the exchange ratio? In order to compute the exchange ratio, first of all, let me shorten it down. If I will shorten it down, it will be equal to 2:5. Okay, I shortened it, 0, 0 cancelled. So 2:5, we can say presently is the ratio. Now, in order to compute the exchange ratio, see here what I am doing. Pay attention here. I am crisscrossing all these items. See here. When I say I'm crisscrossing it, what does it mean? That means I'm shifting from my right hand side 5 to this side, and I'm shifting 2 to this side, so that it will give me a better idea what exactly will be the exchange ratio. Now, after shifting this, what we come to know? We come to know that it means H Limited, shall issue 5 shares. H Limited shall issue 5 shares for every 2 shares of S Limited. For every 2 shares of S Limited. Is it clear to you or not? That is why I did a shifting and reshifting. Is it clear to you? So it helps us in analyzing the situation in a better manner. It means in this particular case, H Limited will issue 5 shares for every 2 shares of S Limited. Is it clear to you or not? It is quite obvious because the quoted value of S Limited is much higher in comparison to H Limited's quoted value. So once we know the exchange ratio, now we can say exchange ratio is actually 5:2, which means from the perspective of the legal acquirer is H Limited, for every 2 shares in S Limited, we are going to issue 5 shares. Is it clear to you? Right, sir, it is absolutely clear to us. After that, this is our step number 3. Now we come to step number 4. So now, on the basis of the quoted prices and the exchange ratio, how many shares, if I would like to ask, of you, how many shares in this case, H Limited will issue to S Limited? So how will you tell me? Number of shares to be issued by H Limited to S Limited So how many share in this case H Limited is going to issue S Limited? Could you tell me? First of all, you let me know the total number of shares of S Limited. We saw earlier total number of shares of S Limited. Actually, I have written here 600. It is 800 shares. Sorry, extremely sorry. Total number of shares of S Limited is 800. So 800 divided by 10 is equal to 80. No problem in it. Simply just have a look. Correct? So there are 80 shares. Total number of shares of S Limited is 80. And now we have come to know that H Limited is going to issue 5 shares for every 2. So I am going to divide it by 2. For every 2 shares, in this case, we are issuing 5 shares. Is it clear to you? So 40 into 5 will be equal to 200. Now we have come to the conclusion that ultimately H Limited is going to issue 200 shares to the shareholders of S Limited. Is it clear? Now, step number 5. If I am going to ask you, total number of shares in the group will be how many now? Total number of shares in the group. A group means acquirer and acquiree, or parent and subsidiary. In this case, we will say acquirer and acquiree. So acquirer and acquiree is a group now. And if I am going to ask you, what is the total number of shares? Because till up to this particular point, we are under an impression that H Limited is the acquirer entity. Till up to this particular point, we are under an impression, and everyone will be under that impression, that H Limited is the acquirer company. So in the group, when we take into account the number of shares, we always take the shares of the parent only. Now parent's total number of shares, if we will take into account, just have a look over here. Earlier I told you total number of shares of parent 1000 divided by 10 is equal to 100. Okay. Total number of shares of parent, that is H Limited, is 100. And because H Limited is issuing 200 more shares, so plus issued to S Limited, Now they are going to issue 200 shares to S Limited. So total number of shares in the group, we may say, is equal to 300. But the problem is that the moment I come across this figure, suddenly my eyes started what we call widening, almost like a saucer. Why? Because the moment I realized that total number of shares in the group are 300, and out of 300, actually 200 shares are in the hands of the shareholders of S Limited. So that means in the group, we may say held by S Limited 200 shares, isn't it? Held by S Limited. So out of 300 shares, we may say that shareholders of S Limited are holding upon 200 shares, while held by H Limited is only equal to 100. Held by H Limited will be 100. Now, after the issuance of the share, what we find, who is the real controller? In this case, because majority of the share, 2/3 out of 300, 2/3 share are in the hands of S Limited, and only 1/3 are in the hands of the H Limited. So that is why it will become a case of reverse acquisition, because from the legal angle, no doubt about that, H Limited is the acquirer entity. But now, when we look into the substance, because India always deals with the substance, the reality is that actually the control is held by S Limited. So that is why it will become a case of reverse acquisition. I will also write here, since S Limited holds, 2/3 stakes, 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 2/3 stak 2/3 stakes in the group, that is, majority of the share are in the hands of the S Limited, we may so. Since S Limited holds 2/3 of the stakes in the group, comma, control shall be considered in the hands of S Limited, shall be considered in the hands of S Limited, in the hands of S Limited, in the hands of S Limited, and further, S Limited shall be considered acquirer for the purpose of accounting, shall be considered acquirer for the purpose of accounting, for the purpose of accounting. For the purpose of accounting. Is it clear to you or not? Now, because in this particular case, the legal acquirer, that is H Limited, is not the what we call accounting acquirer, it becomes a case of reverse acquisition. Is it clear to you or not? Right, sir? Now we got a bit of idea. Now the next point is, if you are the acquirer, now S Limited will become the acquirer. So far so good, no problem. This is step number 5. Correct? I have already told you I am doing it in a threadbare analysis. Correct? Every skin of the question, every layer of the question is being actually sketched out. Correct? So this is point number 6 now. First of all, I will write the title, Books of S Limited. Now, Books of S Limited, because ultimately we have to do the accounting in the Books of S Limited. Books of S Limited. S Limited is accounting acquirer. Accounting acquirer. Accounting acquirer. Accounting acquirer. Clear? Till up to this point, if it is clear, now we can move further. Now you presume for a while. You have the question in front of you. Most of the figures are memorized to me, so don't worry about that. In case if I write any wrong figure, you kindly write the correct figure. Correct? The point is this. My main intention is to make the what we call concept absolutely clear. That is what I am more interested in. Now, if S Limited is going to pass the entry, now you have to presume you are the S Limited and you are the accounting acquirer. Now you know what exactly the accounting acquirer does and what Ind AS says about it. The accounting acquirer need to pass the entry for all the assets and liabilities taken over. Now it will be presumed that it is S Limited which is taking over all the assets and liability of H Limited. Is it clear to you or not? So that is the reason S Limited, what it will do, it will look into the column of H Limited and shall find out what assets are available over there. So basically now S Limited is taking over all the assets of H Limited. So I will write first of all non-current asset. You must have noticed non-current asset is actually 2000. This figure is written in the balance sheet and we shall have to presume that this is equal to the fair value because Ind AS says that acquirer will record all the assets and liability at fair value. And further, current assets are given in the question. I will write current asset also, that is equal to 1000. So I will write here 1000. Correct? Only two assets were there, if you remember. And besides that, I think there were two liability. One was non-current liability. I will take over the non-current liability of H Limited. Non-current liability of H Limited, I think, was 700. And besides that, current liability will also be taken over. Current liability was 800. Now the next question is, now we have to give the consideration. We means the S Limited. Now S Limited will have to discharge the consideration. Correct? First question is, how much consideration now S Limited will discharge? Consideration. The question, bigger question is, how much consideration now S Limited will have to discharge to the H Limited? Now just think for a while that you are the S Limited and you are going to now discharge the consideration to the S Limited. So how it will be decided that how much consideration the acquirer entity, accounting acquirer entity will provide to the accounting acquiree entity H Limited. So first of all, you need to understand that to whom the consideration is actually paid. The consideration is paid to the owners of the business. Who are the owners of the business? The shareholders. Isn't it or not? So you will look into the number of shares of H Limited. First of all, if you will look into the balance sheet, you will find that total number of shares. Anyway, how you are going to actually find out consideration, I am telling here itself. For that, you will have to take into account the number of shares of H Limited, number of shares of H Limited, correct? And obviously, because their quoted market price is given, so the shareholders of S Limited will claim that our share is commanding a price of so and so in the market, kindly provide us this much of consideration. So number of shares of H Limited into quoted price, which is given in the question, into quoted price. So this is how you are going to derive the amount of consideration. Is it clear to you or not? So what will be the amount of consideration if I am going to ask? So accounting acquirer S Limited will look into the column of the H Limited, find out the number of shares. We saw that their total number of shares were 100, 1000 divided by 10, and quoted price we just noticed is equal to 20. So this much of consideration accounting acquirer will deliver, that is 2000. This is the important point. So now, in this case, 3500 minus 3000. So the difference will be treated as goodwill. Without an iota of doubt, I will write here goodwill. So 500. So 500 will become your good. Is it clear to you or not? So not a big problematic situation. Only thing is that you need to take note of this particular fact, that how much consideration now the accounting acquirer is going to deliver to the accounting acquiring company. After this particular entry, now the second entry, of course, is with respect to discharge of consideration. We have to pay 2000 rupees. We are the acquirer entity now. So consideration, we are supposed to pay rupees 2000 because the value of the total shares of what we call accounting acquiring company H Limited is 2000. So we are supposed to pay 2000, no doubt about that. But the next question is how many shares we are going to issue for the same. So you can find it out very easily. Number of shares to be issued. Number of shares to be issued by H Limited, sorry, this is the problem. S Limited, not H Limited, by S Limited. By S Limited to H Limited to discharge consideration. To discharge consideration. To discharge consideration. To discharge consideration. Now the point is, what is the total amount of consideration, sir? Rupees 2000. So in order to discharge 2000, obviously the issuing authority, the issuing company, which is S Limited in this case, will consider its own quoted price. So we are going to divide it by quoted price of rupees 50. As we saw, the quoted price of S Limited is 50. So that will tell me the total number of share to be delivered. So total number of share to be delivered is equal to 40. So 40 shares we are going to deliver. Is it clear to you or not? When we say 40 shares, it means 40 shares of rupees 10 each, because the face value is rupees 10, of rupees 10 each at a premium of, because we are issuing share of 10 each at the rate of 50, because this is the issue price, this is the quoted price. So at a premium of 40 each, at a premium of 40 per share, we may say so, 40 per share, at a premium of 40 per share. 10 plus 40 will make 50. So this is how we will find out the number of shares to be issued. So now we may say that in order to discharge the consideration, S Limited will issue 40 shares. Share capital we shall write here 40 into 10. That is equal to 400. Correct? And now we shall write here 2 security premium account. Security premium account. And here I am going to write 40 into 40. Security premium will be equal to 1600. Is it clear to you or not? This is how the S Limited is going to pass the entry. Obviously now you will have to prepare the consolidated balance sheet now. In order to prepare the consolidated balance sheet, this is your step number 7. Correct? Under this step number 7, I am going to prepare the consolidated balance sheet. So I will write here consolidated balance sheet. Now, when we prepare the consolidated balance sheet, under the first item, first of all, let me write here assets. And on the asset side, first of all, I am going to write non-current asset. So I will write here non-current asset. Under the non-current asset, actually in this question, simply non-current assets are given. Correct? So first of all, who is the acquirer entity? S Limited. I have already told in the previous sections also that whenever we are going to prepare the consolidated balance sheet, the items which are appearing in balance sheet of the acquirer only will find place, and besides that, and of course those items will find place at values which are available in the balance sheet. As far as acquirer entity is concerned, you are going to pick up their items appearing in the balance sheet at a value which is available in the balance sheet, never ever at revised value. Plus, we will add to those items all the assets and liabilities which we have taken over of acquiring entity. Is it clear to you? So we are the acquirer. Don't lose sight of this particular fact. S Limited. First of all, look into the column of S Limited. Find out the non-current asset. Non-current assets of S Limited is actually 3000. So write 3000. They will come as it is. And at what value you have taken over the non-current asset, you can look into the entries which you have incorporated in the books of the acquirer. Here you have written 2000. So this value, suppose if non-current asset of acquiring entity would have been taken over at 6000, I would have added 6000. Is it clear to you? Acquirer's item will find place only at carrying amount. That is amount at which it is available in the balance sheet. But in this case, non-current asset of the acquiring entity H Limited has been taken over at 2000. So I will simply now add to get the value of non-current asset in the consolidated balance sheet, that is equal to 5000. Besides that, because in the non-current asset, after that I will have to write the goodwill also, because we just computed under entry number 1 we had goodwill. So goodwill I will write 500. Then I am going to write current asset. As far as current asset is concerned, current asset of S Limited, first of all, S is the acquirer entity, 1000. And we have taken over the current asset of the acquirer entity at 1000 only. So I am going to add 1000. If we would have had taken over their asset at 3000, I would have added 3000. The point is this. Is it clear to you? So I am going to add here 1000. So now the value will be equal to 2000. So total will become 7500. This is your asset side. Coming over to the liability side. As far as liability side is concerned, I will write here first of all equity and liability. Equity and liability. Equity and liability. Equity and liability. Under the equity and liability, first of all, I am going to write equity. Under the equity, we write generally, first of all, share capital. Now, my question to you is, whenever we prepare the consolidated balance sheet, it is not the question, in fact, I am already delivering the answer. So, while writing the share capital, only the share capital of the acquirer entity will be written. Is it clear to you or not? Only acquirer entity share capital will be written. Now you let me know what is the share capital of the acquirer entity. Who is the acquirer entity? S Limited. Correct? So their share capital we saw in the balance sheet is 800. So I will write rupees 800. Their share capital is 800 without an iota of doubt. I will write here 800. But. You must not lose sight of this particular fact that when you wrote this entry, it is important that whenever you are going to prepare the balance sheet, correct, consolidated balance sheet, you need to keep on what we call looking at the entries, and hardly 2 or 3 entries you pass. So you need to have a look over the entries, correct, in case if you develop any sort of confusion, any sort of dilemma. So in order to erase that out, here I see that I have S Limited has also discharged the consideration, and in order to discharge the consideration, we have issued further share capital at a nominal value of 400. So that means our share capital has gone up from 800 by rupees 400 to 1200. So total share capital of acquirer, accounting acquirer, is 1200. Is it clear to you? Correct. After the share capital, we generally tend to write other equity items. Now coming over to the other equity item. As far as other equity item are concerned, again, first look into the column of S Limited. We find that the other equity of S Limited is 1600. We are not going to add the other equity of the acquiring entity, because it will get closed. Their share capital, their other equity item will already get closed when the acquiring entity will do the accounting, isn't it? We have already seen. So other equity only and only of the acquirer entity will find place. But the point here is that you need to keep an eye over the entries which you have just written over here. For instance, here you have written security premium. So security premium is also a part of other equity. So I will add 1600 further. This is security premium. 1600. If there would have been any gain on bargain purchase, I would have added. Anyway, so 3200 will be the total of other equity. I am going to write other equity. Is it clear to you or not? Right, sir. Absolutely clear. Now I will write here non-current liability. As far as non-current liabilities are concerned, in this case, S Limited is having 1200 worth of non-current liability, and we have taken over 700 worth of liability, non-current liability of H Limited. So 1900 will be the total. Likewise, I shall also write here current liability. Current liability of S Limited is 400. We have taken over the current liability of the other entity, H Limited, 800 and 1200. 1200. So after this, you must tally it. It will be equal to 7500. So this is how you are going to prepare the consolidated balance sheet, and this is all about reverse acquisition. But as I told you, there are 2 questions, and both the questions we have picked up from your module, and now there is not much of variety in it. Important thing is that once the conceptuality gets what we call cleared, then it is pretty easy to handle this particular topic. So I hope your conceptuality, as usual, must have been cleared almost like a morning in the hills, because mornings in the hills are absolutely crystal clear. Anyway, come over to here after this philosophical dialogue. I do not know why in your class only this pen actually plays tricks. 9.2 is the question which we are picking up now. Again, this question is of reverse acquisition. In this case, there is a company by the name of DA Limited. There is another company by the name of TA Limited. One is DA Limited, another is TA Limited. Question says that were amalgamated to form a new company, Data Limited. So both these companies have combined to form a new company, Data Limited. In this case, so far, this is the situation. Further, it is given that on 31st of 3/2023, they got amalgamated and formed a new company, Data Limited, and Data Limited issued requisite number of equity shares of rupees 10 to take over the businesses of DA and TA Limited. So the new company issued the shares to DA Limited and TA Limited, and to take over the business. So after having this sort of information, it seems that Data Limited, the newly formed company, is the acquirer entity, and both these entities are the acquiring entity as far as legal perspective is concerned, because it is clearly given that Data Limited is going to issue the shares. Further, it is given that the abstract of the balance sheet. Now, the abstract of the balance sheet of the two companies are also available in this particular question. Now, in this case, what we find as far as assets of these companies are concerned, under the non-current asset, we have got two assets. One is property, plant and equipment, and another one is financial asset. Correct? Financial asset is a term nowadays used for investment or financial sort of what we call assets. Financial asset term may fall under non-current asset category, or it can also be under category of current asset. Correct? Anyway, in this case, property, plant and equipment and financial asset is given, while TA Limited is having what we call property, plant and equipment worth rupees 8,000 and 500 worth rupees financial asset. Further, current assets are also given. Correct? Now, in the question, under equity and liability, under the equity, share capital is given. Equity share capital, that is 6,000, 10,000. Correct? Other equity is given 3,000 and 1,000. And non-current borrowing, non-current liability in the form of borrowings is equal to 2,000 and 3,000, and current liability 2,000, 1,000. However, this question little bit takes a bit of deviation from the previous one, in the sense that below it is given that the fair value of the following items are also given. Now, the fair value of property, plant and equipment is given, as we may see. So, in this case, we find that fair value of property, plant and equipment of DA Limited is 8,000, while fair value of TA Limited is equal to 6,000. Correct? It is also given below. Further, it is given current asset is equal to 5,000. So, value of current asset, fair value of current asset of DA Limited is 5,000. Actually, this is for DA and this is for TA. Correct? Then, fair value of current assets of TA Limited is 7,000. 7,000. So, book value is 6,000, but fair value is 7,000 as given below. Fair value is this time given. However, no fair value of this item financial asset is available. Further in the question, it is given fair value of the business is 7,500 and fair value of the business of TA Limited is 15,000. You know the meaning of fair value of the business. Fair value of the business indirectly means, let us say, this is the total equity share capital of what we call DA Limited. So we may say, when we say that fair value of the business is 7,500, indirectly what we are trying to say that total fair value of the share capital is equal to 7,500. That is what it means by. Is it clear to you? Total fair value of the shares, that means 6,000 worth of share capital is equal to 7,500. If suppose this company today is going to sell all of its share, probably it would sell the share at 7,500. So whenever we say fair value of the business, that is what exactly we mean by this. Stands for the total fair value of the total share capital. Likewise, this entity is having total share capital of 10,000 and its fair value is equal to 15,000. Is it clear to you or not? Is it clear? Fine, sir. If it is fine, then further it is given. However, in this particular question, you need not require to stretch your mind because it is clearly given. However, the control of Data Limited is taken by the management of TA Limited. This time in the question itself it is given that control will not lie in the hands of the Data Limited, rather the control will lie in the hands of TA Limited. So quite obviously it will become a case of reverse acquisition, because we saw earlier that two companies are combining into a new company, Data Limited, and Data Limited will issue the requisite number of shares. So obviously on such information, based upon such information, one may conclude that it is Data Limited which is the legal acquirer. But now the question states that the control will be in the hands of the TA Limited. That means for the purpose of accounting, Data Limited will not be considered as accounting acquirer. So that is why this becomes a case of reverse acquisition. first of all you need to understand on such lines. Important point, don't lose sight of this particular fact that what are the fair value, correct? And because in this question it is clearly given that TA Limited is the acquirer company, besides that I will also prove it. I will also give you a proof also, correct? You must understand as a professional students that why TA Limited has, it is written that why TA Limited is in the driver's seat. But important point is that later on when I am going to prepare the balance sheet, I will caution you, because many among you I have seen is still having little bit of doubts. Because TA Limited is the acquirer company, accounting acquirer company, in the balance sheet, all the items of TA Limited will not come at fair value. They will come at this value only. Is it clear to you? At book value only. Items of acquirer company in the consolidated balance sheet will come only at carrying amount. Is it clear to you? And because now TA Limited is taking over the business, later on when TA Limited is going to pass the entry in its books, it is going to write property, plant and equipment account debit 8,000. Similarly, financial asset 800, and then current asset at 5,000. I mean to say, because TA Limited is the acquirer now, when later on it is going to pass the entry, it will note down the items of TA Limited at the revised value, or the fair value should I say. So at those value, these items will figure in the what we call consolidated balance sheet. Is it clear to you? That means whenever we prepare the consolidated balance sheet, it is important to keep in mind that the items of the acquirer entity find place in the consolidated balance sheet at carrying amount only, while all the other items will find place at values at which you have taken them over. So it is as simple as that. One need not require to have any sort of doubt now over it. Is it clear to you or not? So on the basis of this information, now we are, although this particular question is also given to you in a solved manner, but I will solve it for you. In order to solve this question, again, I will need a bit of space. I think this much of space should be enough. Okay, this is your 9.2, I think. So 9.1 we have already finished. Now, in order to solve this particular question, what we are supposed to do, first of all, let me actually give you a bit of insight. And why I keep on giving some diagrammatic analysis, reason is that later on sometime else, if you intend to actually solve the question, you should not lose sight of any important point which we discussed in the class. That's the basic idea of giving you some diagrammatic analysis. Correct? For example, in this particular question, I will begin as usual. There is an entity by DA Limited. There is another entity by the name of TA Limited. Correct? DA Limited, TA Limited. Two entities were there. And these two entities, as it was given in the question, combined or merged into a single entity. That is known as technically amalgamation. So Data Limited, they have formed a new company, Data Limited. It is given. So, and it is also given in the question that Data Limited in this case is the legal acquirer, because Data Limited will issue the shares. So no doubt Data Limited is the legal acquirer. From the legal perspective, Data Limited is the legal acquirer. Correct? And both these entities will be legal acquiry company, no doubt about that. Both these companies will be legal acquiry. Legal acquiry. Because Data Limited will be taking over these two companies. So they are legal acquiry, it is the legal acquirer. However, it is given later on in the question that control shall lie in the hands of TA Limited. So it was given in the questions, control given control shall lie in the hands of TA Limited. So quite obviously, in this case, TA Limited will be considered acquirer for the purpose of accounting. So TA Limited will become acquirer for the purpose of accounting. For the purpose of accounting. Correct? Till up to this particular point, one should not have any sort of doubt, I think so. I hope everything is clear till up to this particular point, correct? So once you are thorough with this particular aspects, now we come over to the next one. In this particular question, this is our step number B or whatever it is, correct? In this particular question, DA, TA are the two companies. And let us say I am interested in asking you a very simple question. What is the fair value of the business? Because it is given in the question. And why I am asking, I will also let you know. Fair value of the business. Fair value of the business. It was given that fair value of the business of DA Limited was how much? I think 7,500. Fortunately, I am able to recap. And it is 15,000. So total fair value of the group is equal to 22,500. We may say so. I told you the meaning of fair value of the business. The fair value of the business directly, indirectly stands for the total fair value of the total shares, total share capital. Is it clear to you? But anyway, so we may say that the fair value of the respective businesses is equal to this much. Now, if you look carefully, so we may say that total fair value of all the shares in the group is equal to this much. We can say so. And out of 22,500, we can see that 7,500 divided by 22,500 is our take. Our take means DA, entity DA stake or stakes, correct? Similarly, 15,000 divided by 22,500. So, if I will solve it further, it will be equal to 1 by 3. That means in the group, my stake is equal to 1/3 and their stake, TA Limited's stake is 2/3. So you can see also from here, as I told you earlier, I will prove it also. So we can clearly see and visualize in this particular case also the control is in the hands of TA Limited. Although this step was not needed, to be very honest with you, but just to prove the point. Now, the next point is point number C. Fair value per share. Suppose if I am interested in knowing, because in the last question it was given that quoted price per share was 20 and what we call 50 respectively. However, in this particular question, no such information is available. So I'm trying to find out the fair value per share of the respective companies. But first of all, I would like to know the fair value per share of TA Limited. Per share. Because TA Limited is the entity ultimately now which will have to discharge the consideration. So we must have their fair value. Now you let me know, if suppose I am interested in finding out the fair value per share. Fair value per share. How we are going to find out? See, we can find it out in this manner. I will take into account the fair value of the business, as I told you earlier. Isn't it or not? So fair value of all the shares is fair value of the business. And it is given in the question. I told you fair value of the business stands for total fair value of the total share capital. So fair value of the business, and I can divide it by number of shares. I can divide it by number of shares to track out what we call fair value per share, isn't it or not? So we can see that fair value of the business given in the question of TA Limited is equal to 15,000. So I will write here 15,000. And total number of share is 1,000. Actually, in this question, it is not mentioned the face value. So whenever the face value of the share is not given in the question, always presume it to be as 10. We are presuming that total share capital is actually 10,000 given. But in this question, clearly the face value is not given. So we are presuming that face value is 10. Correct? So it comes to rupees 15. So now we have tracked out the fair value per share of TA Limited. Is it clear to you or not? Similarly, you can also find out the fair value per share of DA Limited, but honestly speaking, that is not required. Required is only this point. Is it clear to you or not? If you want to find out their value, you can also find out. I will find out in this manner. Here I have written TA Limited. I will write here 1. I will write here 2. Fair value. If you want to find out the fair value of the other entity, the fair value of the other entity is, you can find out 7,500. 7,500. And their number of shares, you need to have their number of shares. What were their number of shares? I have forgotten their number of shares. This is the problem. When you forget, you will have to move back and then you will have to find out the shares. This is the problem. Anyway, for you, I will have to do everything. Let me see their total number of shares. Sometimes it skips out of memory. No, that is the only problem. And this is the balance sheet, I think. No, this is not the balance sheet. This is the solution. This internet lagging sometimes creates problem. Yes, now we have the total number of shares. So you can see here, total number of shares, 6,000 is given over here. And we are presuming one share is of 10 each. So 600 will become what we call the number of shares. This is what we are interested in. So now I will move back and come back to the solution. Here the solution was being done. Okay. So the fair value of this entity, that is DA Limited, although we do not need it, honestly speaking, I will tell you why we don't need it. 600. If suppose I am going to divide it by 600, what will be the figure? 7,500 divided by 600. Sorry, fair value was 7,500. Let me check. Right, 7,500. So that comes to 12.5. Although we are not interested with this value, to be very honest with you, that comes to rupees 12.5. Correct? So you have found out the respective fair values. Is it clear? Now the next question obviously is how much consideration. Step number, this is D. How much consideration now the legal acquirer will have to pay to the, not legal acquirer, rather the accounting acquirer, TA Limited will pay. So consideration payable. I told you consideration payable in the last question. How did you decide the amount of purchase consideration which was supposed to be paid by the accounting acquirer S Limited to H Limited in the last question? How did you figure it out? You took the total number of shares of the H Limited, you multiplied it with their quoted value, isn't it? Similarly, you will take into account here the total number of shares of S Limited. Total number of shares of S Limited, sorry, in this case, there is no S Limited. There is DA Limited. Total number of shares of DA Limited. And you are going to multiply it with, because in the last question, 20 quoted price was given. This time quoted price is not given. So we will take into account the fair value per share. Sir, but you told earlier that this figure is not required. Now you are using it. I will tell you that without using it also we could have found out. Because now I have calculated, I am going to use it. Number of shares of DA Limited into what we call fair value per share. Fair value per share of DA Limited. Per share of DA Limited. So this much of consideration we will have to pay. Now we just saw that their total number of share is equal to 600. And fair value per share is equal to 12.5. So this will deliver us 7,500. Actually, why in this question I need not require this calculation? Now I can explain. Because the fair value is already given. Fair value of DA Limited is already given in the question, 7,500. This value is given. And I have already told you This 7,500 is nothing, but it is the total value of the total share capital. Because ultimately you will have to discharge the consideration equal to the value of the share capital. So value of the share capital of DA Limited is 7,500. It was given in the question. So you could have simply written 7,500. Anyway, if you want to find it out in this manner, so fine, no problem. Correct? And so after having written this point number D, now we move over to point number E. Of course, in point number E, I would like to know how many shares I am going to discharge. So number of shares to be issued, to discharge consideration. So how many shares now I will issue? I am TA Limited, accounting acquirer. Consideration payable is rupees 7,500 and fair value of our share which we computed earlier, fair value of TA Limited is equal to 15. So we are going to issue the shares on the basis of value of our share. That is why it was needed. It is imperative. And this step is imperative. No doubt about that. We need to have this value. Is it clear to you? Anyway, so now we may say that 7,500 divided by 15 is equal to 500. So 500 shares we are supposed to issue of rupees 10 each. At the rate of 15. At the rate of rupees 15, it means actually at 5 rupees per share premium. Is it clear to you or not? So after having dissecting also these things, now we are in a position to pass the entries in the books of acquirer. So next step, this is F. Books of TA Limited. TA Limited is the acquirer entity for the purpose of accounting. Correct? As I told you, TA Limited now, when it is going to pass the entry, it will look into the values, the revised values. For example, it is taking over property, plant and equipment of DA Limited. But now the value of property, plant and equipment, as I told you earlier also, now the fair value is equal to 8,000. So I will write here 8,000 and this item will appear in the new balance sheet, in the consolidated balance sheet at 8,000. Besides that, there is financial asset. However, financial asset was not having any revised value. So we will take them over at 800. And then there are current asset, and current asset were also having fair value to the extent of 5,000. So obviously now legal acquirer is going to take over all these assets at these values. Now we are going to take over their liabilities. One liability was in the form of borrowings, that is non-current liability in the form of borrowings, 2,000. And further there are some current liability. In this particular case, current liability I think was also 2,000. And then I am going to write here consideration. So consideration we have just extracted is equal to 7,500. Correct? 7,500 we are supposed to pay 600 number of shares of the acquiring entity into 12.5. So 7,500. Now in this question we are having gain on bargain purchase. Gain on bargain purchase, this is your balancing figure. This will be equal to 13,800 minus 11,500. It will be equal to 2,300. Then after this particular entry, we are going to write the next one. That is with respect to discharge of consideration. So I will write here consideration account debit. Now we are supposed to pay consideration of rupees 7,500. Consideration account debit 7,500. And for that we are supposed to issue 500 shares. So I am going to write here to share capital. So I will write here share capital. And share capital as we saw, 500 shares of rupees 10 each. So 5,000 I will have to write. Besides that, I will have to write here security premium. Now security premium in this particular case is equal to, security premium in this particular case is equal to 500 into 5. Share of 10 is being issued at the rate of 15, so 2,500 will be your security premium. And then finally, we are supposed to prepare the consolidated balance sheet. Now in order to prepare the consolidated balance sheet, I will write here consolidated balance sheet. In the consolidated balance sheet, first of all, as usual, we are going to write the assets. Time and again I have told you, now TA Limited is the accounting acquirer, and the items of TA Limited will find place in the balance sheet at carrying amount. That means the values which are given in the balance sheet. And items which we have taken over obviously will be figured in the balance sheet at values at which we have incorporated in the books of acquirer. Under the asset, as usual, first of all, in this particular case, I am going to write the non-current asset. Under the non-current asset, there is property, plant and equipment. First of all, I will write the property, plant and equipment of TA Limited, and TA Limited is appearing at 8,000. Property, plant and equipment of TA Limited. And we took over the property, plant and equipment of DA Limited at fair value of 8,000. So I will write here 8,000. So your total amount will be equal to 16,000. Is it clear to you or not? Clear? After that, we are being given financial asset. Financial asset. As far as financial assets are concerned, in this particular case, first of all, let me write the financial asset of TA Limited. TA Limited's financial asset is actually, I think, 500. So I am going to write here 500. What is happening to this particular pen? Right. Now we will look into the entries which we just passed, asset taken over to liability taken over. We will see that financial assets have been taken over at financial asset of the other entity was, I have forgotten, I think 800, right? So 1,300. And then in this case, there are current assets. So I will write current asset. As far as current assets are concerned, TA Limited 6,500 given in the question. Current assets of the acquiring entity DA Limited we have taken over at fair value of 5,000. So we must not forget to write here 5,000. And then in the outer column, I am going to write here 11,500. Is it clear to you? Now I will tally it out to find out the total. 800, 800, so it is 28,800. This should be your total. Is it clear to you? Now we come over to the liability side. As far as liability side is concerned, equity and liabilities. Equity and liabilities. Under the equity and liability, we need to first of all write here equity. Under equity, we need to present the A, share capital. Acquirer entity is TA Limited. First of all, think of the total share capital of TA Limited, which is given in the balance sheet as 10,000. Because share capital of acquiring company will never find place, correct, in the new balance sheet, that is consolidated balance sheet. Further, TA Limited share capital is 10,000 and in the entries we have issued 500 shares of 10 each. So this share capital will increase by 5,000. And in the outer column, I am going to write here 15,000. Correct? So this is how I am going to write. And then other equity item. Likewise, other equity of acquiring entity cannot find place in the consolidated balance sheet. Acquirer's other equity, first of all, let us recap. Other equity of acquirer given the question in the balance sheet of TA Limited is 1,000. Besides that, we just saw that in order to discharge the consideration, we have paid some premium also. 2,500 was the premium. 500 shares into 5. Besides that, in the first entry in this question, we are also having a gain on bargain purchase. And gain on bargain purchase also figures under other equity. And gain on bargain purchase was 2,300. So I will add all these items, 5,800. I can write the other equity in the outer column. 5,800. Is it clear to you or not? Till up to this particular point, there should not be any problem. And at the same time, now we will write here 2, non-current liability. Under non-current liability, we are having borrowings. As far as borrowings are concerned, first of all, TA Limited, which is the acquirer entity, their borrowings is equal to 3,000. And we took over the borrowings of the other entity, acquiring entity DA Limited, at 2,000. In the outer column, I am going to write 5,000. And then finally, I am going to write here current liability. Current liability of acquirer entity TA Limited is 1,000. And we took over the what we call liability of the other entity at 2,000. So in the outer column, I am going to write here 3,000. 28,800. So your total is absolutely fine. 28,800. So this is the topic related to reverse acquisition. Is it clear to you? In this particular session, we are going to do only till up to this particular point. So we are moving and stretching our discussion to some topics which are conceptual, and you are going to be asked questions, let us say of 3 marks, 4 marks or 2 marks. Now, for instance, now we are picking up a section number 10, I think. We had finished till up to section 9, sorry. And now today we are going to start section 10, identifying the acquiring enterprise. Correct? We have already seen, in fact, we did actually talk about this particular fact, and even in the previous section when we talked about what we call reverse acquisition. Correct? But these are questions you can say related to case studies with respect to identification of the entity who is having the control. Let's go through quickly this particular question to know what exactly we are supposed to do under such question in case if the questions are tossed up from such topics. Correct? So here we go, and we hope that each one of you are absolutely ready, and very lovely good evening once again to those who have just connected with us now. So we start, and we are starting section 10, correct? Section 10, in order to start this section 10, first of all, let's just wait for a while. Right now, 10.1 is the question which we are starting. Company P Limited, a manufacturer of textile products, acquires 40,000 of equity shares of Company X. Please pay attention. Company P is a manufacturer of textile products, and it acquires actually 40,000 equity shares of Company X, and which also manufactures complementary products. Complementary products means products related to textiles. And this entity, Company X, is having 1 lakh shares. That means out of 1 lakh shares of Company X, Company P Limited has acquired 40,000 shares. Further, it is given that as the part of the same agreement, Company P purchases an option to acquire an additional 25,000 shares. What does it mean? Sometime when I invest, and especially when my investment is in a very heavy block, for example, I am the P Limited and I have invested in 40,000 shares of a company which has issued 1 lakh shares. That means total issued number of shares by that particular company, investee entity, is 1 lakh. And out of those 1 lakh, 40,000 shares are in my hand. Quite obviously, it's a pretty substantial investment. Now, generally what happens sometime, actually with an eye in future, P Limited has agreed into an agreement with that particular entity, investee entity, that we shall have the right to purchase further 25,000 shares in your company. Sometimes such rights are also what we call acquired, and such rights are known as options. So they have an option to acquire an additional 25,000 share. Presently, they are having 40,000 share, but they have got an option. And remember one thing, the other entity cannot decline that at the same time. The option is exercisable at any time in the next 12 months. So within next 12 months, we have the right to get 25,000 more share of what we call company X, the investee entity. The exercise price, this is just to confuse you, the exercise price includes a small premium to the market price at the transaction date. For example, whensoever in future I am going to get 25,000 additional share, so as per the agreement, at that time I will have to pay a little bit extra, correct, than the what we call market price. Suppose at that time market price is 12 per share, I may have to pay 14, 15 as per the agreement. But point is that I have the right to get further 25,000 share of the investee entity. Now, after the above transaction, that means out of 1 lakh, you have got 40,000 shares and you have entered into an agreement to buy further what we call 25,000 shares. The shareholdings of the company's X to other original shareholders are 35,000 and 25,000. That means after you have purchased 40,000 shares, and besides that you have entered into an agreement to get 25,000 more share. Question says that the shareholdings of company X to other original shareholders are 35,000 and 25,000. So what's the question? Each of these shareholder also has currently exercisable options to acquire 2,000 additional share. Now these two shareholders are also having an option to get 2,000 additional share of this particular entity. Now my major question is, who is in the driver's seat? That means who will be considered as the what we call controller of the company. Now see here, that means who will be considered as accounting acquirer. First of all, we need to understand in this particular question some basics. For example, I have already told you in this particular case, there is company X. There is company X, number one. And besides that, there is an entity by the name of P Limited. It is given in the question that company X has issued 1 lakh shares. It is given in the question that company has issued 1 lakh share. Out of these 1 lakh shares, as it is given here, P Limited has acquired 40,000 share. So out of 1 lakh share, 40,000 shares are in the hands of P Limited, isn't it? So obviously now the remaining shares are 60,000. And question states that when we acquired 40,000 share, we also entered into an agreement whereupon actually we got an option to buy 25,000 additional share in this particular company. So after this agreement means after having purchased 40,000 share, we are also into an agreement whereupon actually we shall have the right to get 25,000 more share of this particular company. But point is that at this moment we are having 40,000 shares and remaining 60,000 shares are there. Now question later on states that the remaining shareholders are held by two more shareholders. Let us say shareholder 1 and shareholder 2. And both these shareholders are having, it is given in the question, 35,000 shares and 25,000 shares. 35,000 shares and 25,000 shares. Shareholder 1 is having 35,000 shares and this fellow is having 25,000 shares. So rest of the 60,000 shares are in the hands of two shareholders. Correct? Now the point is that if suppose I want to know, correct, whether P company is having the control over this particular enterprise or not. So Standard India's 103 says that in processing or assessing the control, we not only take into account the present holding, but also the potential voting rights. What we mean by potential voting rights means the potential shares which we may acquire in future. For instance, in this particular question, present situation is that company P is having 40,000 shares. As you can see, company P is having 40,000 shares, number one. Besides that, there are two more shareholders, shareholder 1, which is having 35,000 shares. And besides that, there is shareholder 2, and he is having 25,000 shares out of 1 lakh shares of company X. Company X is the investee entity. However, within next 12 months, P Limited can acquire 25,000 more share because they have an option. Correct? Besides, in this question, it is also given that other two shareholders are also having an option to get 2,000 additional shares. So in future, even S1 can get 2,000 more shares. That means in future, P Limited will have 65,000 shares. S1 Limited will have 37,000 shares. S2 Limited will have 27,000 shares. Remember one thing, when we are going to purchase these shares, how we are going to purchase these shares? From this particular company, it means this company will have to issue these many shares, 25,000 plus 2 plus 2, that means 29,000 more shares. Then only we can get what we call further shares. So total shares of X Limited will be equal to 1,29,000. So if I will consider the potential voting rights, what I find that out of 1,29,000, P Limited is having 65,000 shares. And that is more than 50%. Because now more than 50% shares will be in my hands. So it can be safely assessed that P Limited can be considered as the what we call accounting acquirer. Is it clear to you or not? That is how you are going to deliver the answer. Here I have also written, in assessing the control, not only the present holding but also the potential voting rights are also considered. Correct? Presuming P company and other shareholders exercise the option. Suppose if they exercise the option, then what will happen? Then total issued capital of X Limited will be equal to 1,29,000. Obviously, because X Limited will have to deliver 25,000 shares to P Limited and 2,000 to as shareholder 1 and 2. So total number of issued capital will be 129. But out of 129, as I just told you, out of 1,29,000, P Limited will have 65,000 shares. That is 40 plus 25, which would be more than 50% of the shareholding. As such, one may conclude that P Limited is exercising the control and shall be considered as accounting acquirer. Is it clear to you? This is how you will have to deliver the answer for such questions. Correct? This is the point. That is why we are picking up this particular topic, in case if such questions are asked. To be very honest, so far till up to this particular time, such questions haven't been asked, but yet they may be asked. Company GX Limited, a manufacturer of cosmetic product, acquires 50,000 of equity shares of company SQM. So there is an entity by the name of GX Limited producing cosmetic products, acquires 50,000 equity shares of a company by the name of SQM. And this SQM is manufacturer of complementary goods. Complementary goods means goods related to cosmetics. Out of 2 lakh shares in issue, that means the investee entity SQM Limited has issued capital of 2 lakh shares. And out of 2 lakh shares, this time we have got the GX Limited, we have got only 50,000 shares. As part of the same agreement, Company GX Limited acquires the right to direct all financial and operational activities of SQM Limited. Question is, does GX Limited has control over the SQM Limited? I think you should be in a position to deliver the answer to this particular question quite easily. Isn't it or not? The investee entity, as you must have noticed, is actually SQM Limited. And SQM Limited is having total number of shares, which total number of issued shares is equal to 2 lakh. Out of 2 lakh, GX Limited this time is having only 50,000 shares. On the basis of voting rights, we may say that GX Limited is not having more than 50% of the voting rights. So this time, logically, GX Limited is not having more than 50% of the total stakes. But in spite of that, control could be or can be acquired. As I told in the very first session, if you remember, when we started this particular chapter, I told you that control can be acquired either through majority stakes or by way of what we call some agreements. So here we have entered into an agreement. GX Limited has entered into an agreement whereby GX Limited shall have the right to direct all the relevant activities of the SQM Limited. Relevant activities, financial and operational activities. So in this case, we may conclude that in spite of not having more than 50% of the stake, in spite of that, still GX Limited shall be considered as what we call controlling SQM Limited and shall be considered as acquirer for the accounting purpose also. Why? Because they have got the right and power to direct all the relevant activities of SQM Limited as per the agreement. This is exactly what I have written over here. Even though GX Limited is having 25% stakes, that is 50 divided by 2 lakh in SQM Limited, yet one may conclude that GX Limited is exercising the control, as GX Limited has the right to direct all the relevant activities of SQM Limited. Thus, GX Limited shall be considered as acquirer for the accounting purpose. This is how you will have to deliver the answer to such questions. Similarly, now, next one is 10.3. Now, under 10.3, what is given? Company A and Company B operate in power industry. There are two companies, Company A and Company B, and they are into power industry. And both the entities are operating entities. Both are operating entities, basically means both are still what we call operational entities. Company A has much larger scale of operations than Company B. However, now it gets clarified that Company A is quite larger company, bigger company in scale of operations as far as concerned. It is now given that Company B merges with Company A. Company B is merging with Company A such that the shareholders of Company B would receive one equity share of Company A for every one share held in the Company B. So as per the agreement, because Company B is merging with Company A, indirectly it means Company A is taking over Company B, and Company A will discharge the consideration, and as per the agreement, for one share of B Limited, one share will be given by Company A. Such issue, now question says that such issue of share would comprise 20% of the issued share capital of the combined entity. So once we shall have issued the shares, question says that after the issue, what will happen? It means of the total issue, 20% of the share capital will be held by the shareholders of B Limited. Once we shall have had issued the shares, after the issue, question says that such issue of share would comprise 20% of the total issued share capital of the combined entity. So after the merger, that means because B company is combining with Company A. So after the merger, we may say that out of total share capital, 20% share capital will be held by directly or indirectly Company B. It means majority of the share capital, that is 80% of the share capital, shall be held by Company A. Is it clear to you or not? By Company A. Because in the merged entity, larger number of share, 80%, are held by Company A. So that is the reason we may presume that in this case, control is in the hands of Company A, and Company A will be considered as controlling the situation, and it will be considered as accounting acquirer. Is it clear to you or not? Is it clear? In the merged entity, as I told you, in the merged entity, combined entity, in the merged entity, out of total share capital, B Limited shall have only 20%. Quite obviously, it means majority stakes, 80%, are in the hands of A Limited. So A Limited will be considered as the accounting acquirer. In the merged entity, stakes of B Limited is 20%, as I told you, while A's stakes is equal to 80%. As such, control shall be in the hands of Company A, and Company A shall be regarded as also the accounting acquirer. Is it clear to you? Now let's have a look over this particular question. Company A and Company B, again, similar sort of question. They both are in the power industries, both are operating entity. Company A is, now this time question says Company A has much smaller scale of operation than Company B. In the earlier one, in the previous one, actually, we saw that Company A was having the larger scale, but now the question actually states that Company B is larger in comparison to Company A. Company B merges with Company A. Even in this case, Company B is merging with Company A in such a manner that the shareholders of Company B would receive, in the last question, one share. Here it is written 10 equity share of Company A for one share held in Company B. That means for every one share, this time Company A is issuing 10 shares. So what is happening after the issue of shares? 70% of the issued share capital of the combined entity. After the issue, that means once we shall have issued the shares, it will comprise 70% of the total share capital of the combined entity. So because this time it will constitute 70%, And this issue will go to company B Limited quite obviously. So it means in the merged entity B Limited's stakes are 70%, and obviously it means A Limited will be left up with 30%. So in this case, we shall say that control is in the hands of the B Limited. Control shall be considered in the hands of B Limited, and at the same time B Limited will be considered and regarded as accounting acquirer. Is it clear to you or not? So this is how you are supposed to do such questions. Here it is given company A decides to spin off two of its existing business. If you remember, we used this term spin-offs under when I actually made you understand the cases of demerger. So company A, indirectly it means because company A is spinning off two of its divisions or two of its what we call existing business. So company A will be considered as demerged entity, correct? Both these businesses are currently housed in two separate entities, company B and C. It means there is a big organization by the name of A Limited. A Limited is having two existing businesses, and both these businesses are basically done through two separate entities by the name of B and C Limited. But without any doubt, because this time this particular entity A Limited is spinning off what we call B Limited and spinning off its existing businesses. So this entity will be termed as demerged entity. To facilitate the spin-off, it is given that company A will incorporate a new entity D Limited. Generally, we use the term spin-off. There is a slight difference between sale of division and what we call a spin-off. In case of sale of division, generally we sell a particular division or particular segment or operation of a business to a new entity. But generally in case of a spin-off, what we do, we means company A Limited will form a new company. They themselves have formed a new company by the name of D Limited. That is the only difference. This company is formed by actually A Limited. So when we restructure the things in such a manner, you can say so, then it is known as spin-off. So generally in this case, we are not actually selling the particular division to a third party. Here we ourselves are creating a new party, and that party will take over the businesses. Now here it is written, company A incorporates a new entity D Limited with a nominal equity and appoints an independent directors to the board of the company. Now, important thing is that this company D Limited is having independent board, correct? So they cannot get pressurized. Company D signs an agreement to purchase the companies B and C in cash. As I told you, this company is formed, and as per the agreement, this company will take over the business of these two companies. Further, D Limited says that we are going to allot the consideration, and we will allot the consideration by paying you cash. Here it is written that they are going to purchase the company B and C in cash, correct? However, D Limited has also put up a condition. D Limited has agreed to take over B and C Limited. They have also agreed to discharge the consideration. They have also agreed to discharge the consideration by way of cash. But they have also put up a condition. The condition is that conditional on obtaining sufficient funding. That means D Limited is telling to A Limited that we shall purchase these two segments, will pay the amount in cash, conditional upon the fact that we are able to raise this much of funds. Is it clear to you? If we are able to raise the funds, then definitely we are going to pay the amount. To fund these acquisitions, the company D issues a prospectus offering to issue shares for cash. So in order to raise the cash, now it is given company D actually issues a prospectus in order to raise the capital. In order to raise the capital, they have issued a prospectus, and it is given now below that at the conclusion of the transaction, company D is owned 99% by the new investor. Because company D has floated the shares in the market to raise the required amount of funds. So they have floated the shares, and out of these shares, actually 99% shares are purchased by the new investors. They are new investors. They are new investors means they are not at all connected with the demerged entity A Limited. They are not connected with A Limited. So, indirectly, it also means only 1% shares were acquired by A Limited, as also written here. Company D owned 99% new investor, with Company A retaining only 1% non-controlling interest. So this time Company A is not at all having any sort of control over D Limited. Is it clear to you? So in this case, we shall presume that D Limited is now getting the control of the situation, and D Limited will be considered as the acquirer entity. There are many reasons behind it. Number one, the demerged entity, this is known as demerged entity, as you know, because their divisions have gone to what we call D Limited. This is the demerged entity. But the point is that demerged entities having only 1% stakes in Company D, so they are not having any control over it. Number one. Number two, they are having independent directors, correct? And they are discharging the purchase consideration. On account of these things, we may say that Company D is the acquirer and controller of the situation, and for the purpose of accounting, Company D will be considered as the accounting acquirer. The answer will go like this. In order to settle the cash, Company D issues prospectus, correct? Out of total issue of share capital, as I told you, 99% shares are in the hands of the new investor, and I have written in the bracket, not in the hands of demerged entity or members of demerged entity. They are completely new investors, while 1% is in the hands of A Limited only. Also, D Limited is having independent board of director. Further, D Limited is settling the purchase consideration. As such, D Limited shall be considered as legal as well as accounting acquirer. So such sort of questions sometime may be tossed up in the examination. So to be on the safer side, we are picking up such questions also. Likewise, sometime question may be asked with respect to determination of acquisition date. Earlier when we started the topic, if you remember, correct, I told you your very first step to do the accounting is the determination of acquisition date. No doubt, generally the determination of acquisition date is not a very tough task, but still the question based upon such may be a little bit complicated. Company ZX Limited acquired 80% equity interest in BX Limited for cash consideration. Now, Z Limited has acquired 80% stakes in what we call BX Limited. The relevant dates are as under. The relevant dates are given to you. Date of shareholders agreement is given 1st of June 2023. Intentionally, they have given this date much earlier. Further below, it is given appointed date as per the shareholders agreement. If I am taking over the business of somebody, quite obviously, it cannot happen that in one day every dealings, all the legal formalities will be complied up with. Correct? Slowly and steadily, both the parties will move. Correct? There will be some mutual consensus, mutual agreements. Correct? And details shall be finalized. So, here first of all we appointed date as per shareholders agreement. So first of all we held a meeting with the shareholder on 1st of April 2023, but obviously this cannot be treated as date of control. Date of obtaining control over the board representation. However, this is the important point. On this particular date, we have got the what we call representation over the board of that particular company. Now, if our company has got the control, we have acquired the control over the board representation. That means we have acquired the right to constitute the board. Now, if this right accrues, it means now the control of the other entity is in our hand. So in this, and if you remember, we talked about this particular fact earlier in the very first session also. So in this case, it will be considered as what we call 1st July 2023 will be considered as the date of control, because on this date, entity ZX Limited has acquired the control over the board. Is it clear to you? So in this case, as the control over the financial and operating policies are acquired through obtaining board representation on 1st July 2023, this is the date which will be considered as acquisition date. Correct? Simple answers. 11.2. Can an acquiring entity account for business combination based on signed non-binding letter of intent where the exchange of consideration and other conditions are expected to be completed within 2 months? Now, what is the meaning of this particular question? First of all, suppose there is an entity A Limited, and this entity is interested in what we call taking over, let us say, entity B. Let us say they have entered into an agreement. Now company A tells company B, we will take you over, no doubt about that. And we are going to complete everything within next 2 months. So next 2 months, whatever date will fall, that date cannot be considered as date of control. Simply because in this case, the agreement is non-binding. A non-binding agreement is one where no legal action can be taken against the party if the party doesn't keep the words or doesn't keep the commitment or simply backtracks or simply violates, correct, or simply put up in simple words if there is any breach of any clause of the agreement. So because it is a non-binding agreement, correct, it cannot be treated, it cannot be considered for determining the acquisition date. Your answer will be simple, correct? No, as per the requirement of the standard, a non-binding letter of intent does not effectively transfer the control and hence that cannot be regarded as the basis for determining the acquisition date. 11.3. On 1st of April, Company HX Limited agrees to acquire the share of Company BH in all equity deal. So on 1st of April, actually what is happening, on 1st of April, HX Limited, 1st of April, HX Limited agrees to acquire BH Limited in an all equity deal. Means whatever consideration we are going to pay by way of equity share. As per the binding agreement, this time there is a binding agreement, Company HX will get effective control on 1st of April. So there is a binding agreement that on 1st of April, the control will also accrue to HX Limited. However, the consideration will be paid only when the shareholders' approval is received. Now, problem is this, actually point is this, not the problem. This time, approval of shareholder is irrelevant because there is a binding agreement that on 1st of April, the control will flow to what we call HX Limited. Correct? However, to confuse you, here it is written that shareholders meeting is scheduled to happen on 30th of April. And if the shareholder approval is not received for issue of new shares, then the consideration will be settled in cash. What is the acquisition date? In this case, acquisition date will be 1st of April. Why? Because on this particular date, there is a binding agreement that control will accrue to HX Limited. Now, here the shareholders' approval is not going to play important role because purchase consideration as written in the question can also be discharged by way of cash. So, in this particular case, 1/4 will be your date of control. 11.4 states that on 9th of April 2023, S7 Limited, a listed company, started to negotiate with R8 Limited. So here in this particular question, lots of dates are given. First of all, it is given on 9th of April 2023. There is a company by the name of S7 Limited. And it is a listed company and it started negotiations with R8 Limited. On this particular date, negotiations have started about the possibility of a merger. On 10th of May 2023, further now it is given that on 10th of May 2023, the board of directors of S7 Limited authorized the management to pursue the merger with R8 Limited. So on this particular date, board of directors allowed their management to pursue the matter. Still, this date cannot be treated as date of control because it is simply what we call stretching the proceedings. On 15th of May 2023, so now we move over to 15th of May 2023, the management of S Limited offered management of R Limited 12,000 shares of S7 Limited against their total shareholding. So on this date, the management of S7 Limited offered R8 Limited shareholder that our company will pay you 12,000 shares. Still, this particular date cannot be treated as date of control. On 31st of May, now the next date given is 31st of May 2023. On 31st May 2023, the board of directors of R8 Limited accepted the offer subject to shareholders' vote. Now this offer which was made on 15th of 5 2023 to R8 Limited, it is given accepted the offer. They have accepted it. Well, we are going to accept that our shareholder will receive 12,000 shares as part of what we call deal. but it is still subject to their shareholders' vote. So still this particular date cannot be considered as state of control. On 2nd of June 2023, both the companies jointly made a press release about the proposed merger. So even 2nd June 2023, because on this date they made a public statement, public release also, but it is still a proposed merger, not formalized merger. So that is why even this particular date cannot be treated as date of acquisition. On 10th of June 2023, the shareholders of R8 Limited approved the terms of the merger. On 10th of June, now shareholders of both the companies, they have simply said, well, we accept the terms of the approval. Still, this date cannot be treated as date of acquisition. On 15th of June, the shares were allotted to the shareholders of R8 Limited. So it means on this date, because we have allotted the shares, we have what we call discharged the purchase consideration. So quite obviously now we are having the majority stakes, and quite obviously now we are having the control. So in this particular case, 15 June will be considered as your date of control. Is it clear to you or not? Right, sir. So now we move over to an interesting topic that is known as business combination achieved in stages. What we mean by business combination achieved in stages. In order to make you understand this particular point, suppose this is year one. This is year one. And on this particular date, presuming that I have invested or I have 30% stakes in a particular company, correct? In year one, I have invested somewhere in a company that is the investee entity, and because my investment is 30% in that particular company, quite obviously it means I am not having the control over that particular entity. Is it? I am not having the control, but my investment is there, no doubt that. Let us say after 3-4 years, again I invest into that particular entity. Again I invest into that particular entity. And this time I acquired further 25% stakes. Because my earlier investment was 30%, and now I have acquired 25% more share of that particular entity. So what will happen? Now, the day on which I am going to acquire further investment of 25,000 more share or 25% more share, my total stakes in that particular company combinedly will be equal to 55%, and it can be now inferred that I am having the control over that particular enterprise. So point which you need to understand under business combination achieved in stages is that when an entity acquires the control on account of additional investment, that means earlier you might have had done some investment in the entity, and because today you are doing some additional investment, and if because of your additional investment you are getting the control, then it becomes a case of business combination achieved in stages. Is it clear to you or not? In order to understand this particular point carefully, just pay attention, because lots of things which you need to understand as a professional student. Problem is that on many occasions I have noticed actually superficial study we do, and later on actually we review that why during that particular time we did not pay attention towards this particular point. Why I am saying so? Because lots of questions, even in your interviews when you are going to face later on, shall be asked upon from what we call this particular topic. So pay attention towards this particular topic. Business combination achieved in stages, I have already told you what exactly is this. So it is also known as step acquisition. So when an entity acquires the control by way of additional investment in the entity, so that is known as business combination achieved in stages. And whenever there will be a situation of business combination achieved in stages, question will simply ask you calculation of goodwill. We have already learned how the goodwill is computed. In the very first section, dealing with the practicals, we did lots of questions with respect to computation on goodwill, NCI and all. As you know, first of all, we simply take into account the NIFA. We simply segment it into two parts, share of NCI, share of parent. And then share of parent is compared with the what we call investments, and the difference gives us what we call goodwill or gain on bargain purchase. But in case of business combination in stages, there is slight variation to compute the what we call goodwill or gain on bargain purchase, and you should be aware of that. So in order to make you aware of that, let's first of all have a look over here. 12.1 is the question I am picking up. In 12.1, I have written entity A acquired. Entity A acquired 35% of entity B in 2021. What is happening in this particular case? There is an entity in this particular question. What is happening? Pay attention also, because I will have to clarify this particular point to you. In fact, I have already drawn a diagram for you, but still. So, company A acquired 35% of entity B, 35% of entity B in 2021. In 2021, this red line is denoting year 2021. Correct? For rupees 35,000. That means company A has invested in company B and it acquired 35% stakes. And these stakes were acquired for rupees 35,000. This is the situation presently right now. Is it clear to you? Further, it is given that in 2022, the fair value of the shares of entity B is 42,000. Now the next year starts. Let us say next year is starting from this particular point. In the next year, what is happening? First of all, question says that in year 2022, the investment which I made earlier in 2021, and at that time I purchased 35% worth of stakes in this particular entity B, and I purchased it for 35,000. But as you know, the value of the investment keeps on fluctuating. Now the question says that in 2022, the fair value of the share of entity B is rupees 42,000. It means, see here, this is year 2022, because question hasn't specified a particular date. Let us presume this particular date, no problem, just to make the point a little bit more clear. Let us say in 2022, the value of the investment as it is given in the question has moved up to rupees 42,000. The fair value of this investment has gone up to rupees 42,000. Correct? This is the fair value of your investment. Fair value of your investment. Now, in order to make you understand further, you must remember, later on you will have to do a chapter by the name of financial instruments. By the name of financial instrument. We will also see that financial instrument is actually covered by Ind AS 109, Ind AS 107 and Ind AS 32. These three Ind AS actually govern the entire gamut of financial instruments. And over there you are going to learn that if an entity, or for that instance, if an entity or any individual, if it makes an investment somewhere, then those investment, first of all, investment is a financial instrument, no doubt about that. So investments can be measured. We will see when we are going to learn all these things under financial instrument. But just to make this particular point clear, I would love you to actually understand a bit of what we call this particular part. When we do the investment in a particular entity, such investment can be measured, and it is our option. It is the option of the investor whether it wants to measure the investment through this approach or through this approach. There are two approaches, in fact. One is known as fair value through profit and loss account approach. Another one is fair value through OCI, other comprehensive income approach. Right now, I know it looks a little bit difficult to comprehend in case if some of you are still not aware of what we call all these things, financial instrument. When I will make the investment somewhere else, obviously I will have to do the accounting for my investment also. So it is my discretion, it is my choice whether I want to actually classify my investment under the category of fair value through profit and loss account. What does it mean? I will also let you know. Don't worry about that. It is my discretion, it is my choice that whether I want to classify my investment under this category known as fair value through profit and loss account, or what we call fair value through other comprehensive income. It is my discretion, my choice. Is it clear to you? Suppose I have decided that I will keep the investment under this particular category. Then I say I am going to measure or classify my investment under this category, fair value through profit and loss account. What does it mean? It means whenever any changes in the fair value will take place, those changes will be adjusted through profit and loss account. Suppose if the value of the investment has gone up, then obviously the asset is increasing. I will write here investment account debit. And because I have already decided that I am going to measure my investment as per fair value through profit or loss account, it means any changes in the fair value will be taken to profit or loss account. That is what we mean by it. Is it clear to you? Suppose if I had decided that I am going to keep my investment under this category, fair value through other comprehensive income. What does it mean? It means if there will be any changes in the fair value, those changes will be incorporated or adjusted through other comprehensive income. As you know, profit and loss account under division 2 is divided into two segments. The upper segment is known as profit and loss. The lower segment is known as other comprehensive income. So in this case, if the value of the investment would increase, then my entry would have been investment account debit to OCI account, other comprehensive income. That is the only situation. Is it clear to you or not? Why I told you about this? Because in this case, the moment your investment has gone up, your investment value has gone up from what we call 35,000 to 42,000. See here, because the value of your investment has gone up from 35,000 to 42,000. Obviously, it has gone up by 7,000. And here it is written also. Rupees 7,000 reported under OCI in 2022. What does it mean? That means when the value of my investment went up, this entity reported this increased value in OCI. Indirectly, it means this entity has kept the investment for the purpose of measurement under the category of fair value through profit and loss, the fair value through other comprehensive income. That means this entity is measuring their investment as per FVTOCI, fair value through other comprehensive income. So on this date, I am going to pass a particular entry. So in this case, my entry will be, okay, I will write the entry here. Profit and loss, investment account debit to other comprehensive income. Because fair value of my investment has gone up, so that gain has been taken to other comprehensive income. Is it clear to you? Okay. Now what else is given in the question? If further A Limited further acquired 40% stakes in B Limited. A Limited acquired further 40%. Exact date is not given, but for the purpose of simplification, we presume that on this particular date, in 2022, let us say A Limited acquired further 40% stakes. So further investment has been done. So on this date, further investment has been done. Just wait. Further investment. I will write FI, further investment. Correct? Further investment. And further investment, as is given in the question, to the extent of 40%, we acquired 40% more stakes on this particular date. Further, it is given consideration paid 60,000, because when I acquired 40% more stakes, obviously I will have to pay something for it. So consideration amount which I delivered for this particular stake, this 40% stake, consideration. What is the amount of consideration? The consideration amount is rupees 60,000. Everything has been given in a solved manner, but you kindly pay attention. Consideration amount is 60,000. Is it clear to you? We acquired additional stakes. Because on this particular date we acquired additional stakes, then what will happen? Because earlier we had 35% and now we acquired 40% more shares. So this particular date obviously will become date of control, because on this date, my total stakes will move up to 75%. So this will be considered as your date of acquisition. Correct? So now on the date, obviously we will have to compute goodwill, etc. Correct? Now importantly, another important point is given here. Entity A identifies the net assets of B Limited as rupees 1,20,000. And on this date, on this particular date, just wait. On this particular date, when we acquired 40% stakes, it is given that net identifiable asset NIFA of B Limited is equal to rupees 1,20,000. A Limited identifies net assets of B Limited at 1,25,000. Interestingly, another important point is given. Value of 35% shares at this date is rupees 45,000. Now, another important aspect which is given, that on this particular date, when we acquired 40% stakes, it is given that our 35% stake, our original investment or previous investment, we may say so. So previous investment of 35%, which we did at a cost of 35,000 and whose value has gone up to already 42,000, correct, has again moved to rupees 45,000. This is also given in the question. So that means on the date of control, your investment fair value has gone up to rupees 45,000, because on this date, we have already passed an entry, correct? We have already taken the value from 35 to 42. Now this value has gone up from 42 to 45,000 on the date of control, correct? So another entry I will have to pass. An entry will be same, but the amount will be different. Investment account debit, I am going to write. Now from 42 to 45, that means the value is increasing by 3,000. I will write here 3,000. Is it clear to you? And I will take it to profit and loss account. Sorry, other comprehensive income. So we may say that on the date of acquisition, fair value of my previously held investment is 45,000. Fair value of my previously held investment is 45,000. Is it clear to you or not? Further in the question it is given NCI is valued at proportionate net asset method. Question now says that show workings in journal entry. It has got printed twice. Now ultimately I will have to pass the entry. But for the purpose of passing the entry, I need to have the amount of goodwill also. In this case, I will have to find the amount of goodwill. On this date, I will have to find the goodwill. How I am going to find the goodwill? Just pay attention. For that, I will require a bit of space. Now I will tell you how we are going to find the amount of goodwill. Generally, in order to find the goodwill, what we do? First, as I told you, we normally take into account the NIFA, correct? Normally we take into account, now what I am doing, computation of goodwill or gain on bargain purchase, whatever it is. And in order to determine the amount of goodwill or gain on bargain purchase, normally what we do, first of all, we always take into account on the date of acquisition NIFA. So on the date of acquisition NIFA, net identifiable assets, in this case of B Limited, on the date of acquisition. So on the date of acquisition, because we acquired control on 40% on this particular date, NIFA is 120. So I am going to write here 1,20,000. So 1,20,000 is the total net fair value of net assets of B Limited. Now out of this, what I am going to do, just pay attention. Out of this, I would like you to write, correct also. Out of 1,20,000, first of all, I will pluck out the share of NCI. If I am going to ask you, what is the stake on the date of control of NCI? First, you let me, what is your stake on the date of acquisition? On the date of acquisition, our stake, acquirer's stake, will be 75%, obviously 35% earlier, 40% now, 75%. So what is going to be the stake of NCI? The stake of NCI on this particular date obviously will be equal to 25%, and we have to use the PSNA method. So 25% of 1,20,000. When we say 25% of 1,25,000, what does it mean? That means on the date of acquisition, whatever net assets of acquiring company are there, out of that 25% of the net asset belongs to NCI. So 25% of this will be equal to 30,000. Correct? Now whatever remaining, of course, remaining always signifies share of parent. It always signifies share of parent. So share of parent in net assets, share of parent in net asset, share of parent in net asset. Of course, in net assets of B Limited on the date of acquisition. So share of parent will be equal to 30 minus 120. Obviously, it is 90,000. Are you getting my point or not? Now, the question which we have done till up to this particular point, over there, in order to compute the goodwill, what we were doing, we were simply now comparing the share of the acquirer or the parent. Okay, I will write acquirer. Share of acquirer. We were comparing the share of the acquirer in the net assets with the amount of consideration. That is exactly what we were doing so far till up to this particular point, because prior to this point, we never actually confronted this situation, correct? This situation means business combination achieved in stages. So we were simply comparing it with the what we call consideration, and we were arriving over the amount of goodwill or gain on bargain purchase. But here in this particular question, as you can see, it is not as easy as it looks superficially. But I will make it very easy for you. Don't worry about that at the same time, as I normally do the things in fact. In this case, you are not going to simply compare it directly with the consideration. Correct? Why? I will also tell you the reasoning. First of all, I am going to ask you a very simple question. No doubt, this is the total share in the pocket of the acquirer. This is the total share of the acquirer in the net assets on the date of acquisition, because 1,20,000 worth of assets were there. Your share is 75%, no doubt about that. So your 75% stakes are delivering you a right over 90,000 worth of net assets of the acquiring entity. But now you will have to look here very carefully. I am going to ask you, out of this net asset, you are getting right over the net asset 90,000, but at the same time, you must not forget that you had made some earlier investment known as previously held investment. It is known as previously held investment. That means some share of net asset is flowing to the acquirer entity on account of previously held investment, and some of the share in net asset is flowing to the acquirer due to the additional investment. Try to understand my point. No doubt about that, this is the share of acquirer. This is the share of acquirer in the net assets. No one can dispute this particular point. But my point is that out of this 90,000, some of the what we call right is flowing to us because of our previously held investment, and some of the right is flowing because of our additional investment. Try to understand. If I am going to ask you how much claim over these net asset you are having, or how much right you are having over these assets on account of your previously held investment, how will you let me know of that? First, you write here share of net asset, share of net assets on account of previously held investment. Previously, how much you held? 35% stakes, no doubt about that. Share of net asset on account of previously held investment. Previously held investment means 35%. Previously held investment was 35%, no doubt about that. But today, on the date of control, your 35% worth of investment which you made at a value of 35,000, because right here it is written, correct? You paid 35,000 at that time, but the fair value on the date of acquisition of your previously held investment is rupees 45,000. And what does it signify? It signifies that you are having a claim over 45,000 worth of net assets of the acquiring entity. So now we can say that out of this 90,000, 45,000 worth of assets are flowing to the acquirer on account of its previously held investment. Is it clear to you or not? That is why we are stressing upon the previously held investment. Is it clear to you or not? So in this particular case, I would say that out of total share which acquirer is having in the net assets, actually 45,000 worth of net assets are moving over to the acquirer because of their previously held investment. So now the scenario is share of net assets on account of additional investment. Now the major question is, when you made the additional investment 40% on that date, because of 40%, how much you are getting actually out of the net assets? So share of net assets on account of additional investment. So share of net assets on account of additional investment, obviously 90 minus 45 will be equal to 45,000. So now we can say that out of total 1,20,000 worth of net assets on the date of acquisition, 30,000 worth of net asset belong to NCI. Of course, rest of the net asset belong to acquirer, no doubt about that. But important point is that out of this 90, 45 is coming towards acquirer on account of previously held investment, correct? And balance 45,000 we may say are accruing to acquirer on account of additional investment. So in order to compute the goodwill, you are going to compare this 45,000 with the consideration. That means when we are going to compute the goodwill, actually what we are doing, we are trying to find out what value of net assets we are getting on account of additional investment, because the consideration is given for additional investment. You can compare the consideration of additional investment with the what we call net assets which the additional investment is fetching. So now we can compare this 45,000 with the consideration as it is given in the question. In order to get 40% stakes, you paid 60,000 rupees. This is the extra consideration which you are paying, isn't it? So that is the reason why under what we call business combination in stages, we have to compute the goodwill in this manner. So consideration, I will write here consideration, amount of consideration. So consideration is rupees 60,000. Consideration is rupees 60,000. Is it clear to you? So in this case, because amount of consideration is more, so we may say there is a case of goodwill 15,000. Although I have given it in a solved manner, yet I would love you to actually do the solution in this manner. Is it clear to you or not? I hope business combination achieved in stages has become absolutely clear to each and everyone. Clear? So, first of all, in this case, because the question had also asked us to pass the entry, your first entry will be investment account. This will be your first entry. This will be your second entry. And what will be your third entry? Your third entry will be, here I am going to write the third entry. Your third entry will be net identifiable asset. We are getting net identifiable assets of 1,20,000. 1,20,000. Isn't it or not? 1,20,000 worth of identifiable asset. First of all, I am going to write here to NCI. That means I am plucking out the share of NCI which we computed 25% equal to 30,000. Correct? Then out of these net assets, as I just told you, 45,000 worth of net asset were accruing to us on account of previously held investment. So I will write here investments in B Limited. Obviously, these are your previously held investment. In more technical language, we will call it, we are cancelling out our previously held investment. And to understand, you can say we are plucking out the share of net assets which is flowing to us on account of our previously held investment. So right now, it means we are noting down the net assets which are coming to the acquirer on account of the additional investment. And then we are going to compare it with the consideration, the additional consideration, how much we paid for additional consideration. So we have paid 60,000 rupees. So I'm going to write here 60,000 rupees. Is it clear to you? Is it clear? And the difference will be obviously goodwill, which we have already found out. You can find it out through entry also. Now, another important point. Because you have sold the investments, correct? You have sold the investment. So whatever income now is there in your OCI, you can retransfer it to your profit and loss account. So you can write an entry over here if you wish. You can write another entry here. OCI account debit. Total amount in OCI 7 plus 3 is 10,000. And you can take it to the profit and loss account. So this is how you will have to approach. So in this particular, suppose one more point before I wrap the things up. See here in this particular question, it was written clearly that the previously held investment are 35,000 and in year 2022, fair value of the investment is 42. And it was written in the question that increase of 7,000 was reported in OCI. Suppose if nothing would have been written, then it is up to you. You simply write the assumption that it is presumed that investments are being measured at what we call fair value through profit and loss account. So in that case, your first entry would have been investment account debit to profit and loss account. The second entry also to profit and loss account. Is it clear to you? If nothing is mentioned, it is entirely your prerogative whether you want to treat the measurement of the investment through FVTPL or what we call through FVTOCI. Is it clear? I have done my level best effort to see to it that this particular topic becomes absolutely crystal clear. Although it is given in a solved manner, you can go through it. Now the next, as you can see, we have already finished still up to section 12 last time when we did the topic that is business combination achieved in stages, and it was pretty important topic from the examination point of view. Now we are moving over to, as I said, section 13. It deals with contingent consideration. Now the topics which we are going to take up today, basically from these topics you can expect in the examination some conceptual based questions of 3-4 marks, correct? So here we go, contingent consideration. If you remember, actually in the very first session when we were talking about the accounting aspects in the books of the acquirer, I did talk about this particular fact that on the date of acquisition, of course we shall have to do the accounting, but besides that, we also talked about this particular fact that on that particular date, we will have to compute the amount of purchase consideration which acquirer would deliver to the acquiring entity. Now, over there, in that particular session, I talked about that particular fact that purchase consideration comprises of not only the cash payment which we are going to deliver on the date of acquisition. Besides that, it also takes into account plethora of things. For example, like equity share capital, preference share capital, debentures, which acquirer would issue to the acquiring entity. And besides that, it also takes into account any contingent consideration. And at that time, I also talked about this particular fact that we shall discuss the contingent consideration later on. So now the moment has come to discuss what we call contingent consideration. What is contingent? First of all, the meaning of contingent. For example, if I would say your success depends upon your hard work. So here, your success is depending upon, that means your success is contingent upon your hard work. That is exactly the situation here, contingent consideration. This particular sort of consideration depends upon some conditions which will be imposed by the acquirer entity. For example, today, we are acquiring the business of a particular entity. And let us say purchase consideration has been decided at 200 lakhs. Besides that, the acquirer entity tells to the acquiring entity that we shall pay you 50 lakhs more, but after 2 years. We shall pay you, besides these 200 lakhs, we are going to pay you 50 lakhs more, but after 2 lakhs. But here the condition is imposed. Now what is the condition? The condition is that acquirer entity imposes a condition that in the next 2 years, let us say your profit should be more than at so and so amount. So here the condition is imposed upon the acquiring entity that if you will be able to what we call earn a particular specified amount of profit, then we are going to deliver you what we call 50 lakh additional consideration. So here the additional consideration, correct, is depending upon what we call some conditions. So that is why it is known as contingent consideration. But the important point is that even though this contingent consideration has been agreed upon today and it will be payable after 2 years, in spite of that, Ind AS 103 states that such contingent consideration need to be made a part of purchase consideration. That means on the date of acquisition, I will make this as a part of purchase consideration. Now, but the question is, because I am supposed to pay 50 lakhs after 2 years, at what value should I record it today? Generally, the rule is fair value, but the fair value, how we are going to compute the fair value? Here, fair value stands for present value. That means I will have to compute the present value of 50 lakh, which would be paid by acquirer entity after 2 years. So at that value, I am going to include it today. Is it clear to you? And how I am going to include it today? As you know, on the date of the acquisition, acquirer entity passes an entry, asset account debit, that is all the asset taken over at fair value, 2 liabilities taken over. Then we will also write 2 consideration, and besides that, we will also write 2 provision for contingent consideration. 2 provision for contingent consideration, because we will have to make a sort of provision for that, because we may have to pay this particular contingent consideration later on. At your level, actually, only thing is that question is going to ask you only compute the amount of purchase consideration, and they are going to deliver you a sort of what we call case study. How the case study will be given, just have a look over 13.1. Now, in this particular question, and this question is hardly of 4 marks, correct? Keeping into account your level. In your module, hardly 1 question is there, and we are picking up 13.1. So in 13.1, what is there? Just pay attention down over here. E1 Limited acquires B Limited. There is an entity by the name of E1. It acquires what we call B1 Limited, and purchase consideration was agreed upon rupees 100 lakh in cash. And it was agreed that we are going to give you 100 lakhs and we are going to provide you 100 lakhs worth of purchase consideration in cash. And also E1, the acquirer entity, shall pay 20 lakhs after 2 years. So here, there is another agreement taking place on the date of the acquisition between these 2 entities, whereby the E1, that is acquirer entity, is telling to the B entity that we will pay you 20 lakhs extra or additional what we call amount after 2 years. And they are also imposing a condition. The condition is if profits of B Limited for the second year will exceed 2 crores. That means in the second year, if the profit would exceed 2 crores, then only we are going to pay you what we call this 20 lakhs. Is it clear to you? And the fair value, further it is given fair value of contingent consideration on the date of acquisition is 13 lakh. Now in this question, fair value of the contingent consideration is already given to you. Is it clear to you? On the date of acquisition. Besides that, it is given that fair value of contingent consideration at first year end is rupees 16 lakh. So this is the scenario of this particular question. So how we are going to deal up with that? So how we are going to deal up with that I will let you know in a short while. Just pay attention here. To make you understand it better, Please reduce the sound. Kindly reduce the sound, please. Okay then. So here we go and we start this particular section, section 13, and it is an important section in the sense that you can definitely expect a small question on it. Section 13, as I told you, deals with contingent consideration. Contingent consideration. Contingent consideration. Now the question which we just studied, in this particular question, what was the scenario? There was an entity by the name of, and in fact this was question number 13.1. In this particular question, what was given to us, that there was an entity by the name of E1, and this entity is taking over or acquiring, should I say, entity B, entity E1. And this entity, as I told you, is taking over what we call entity B. As per the mutual agreement, it was decided, presuming that this is the date of acquisition, on the date of acquisition, E1 shall pay 100 lakhs as PC. It is given in the question that E1 will make a payment of 100 lakhs and the payment of 100 lakhs will be done in cash. So obviously this is the amount of PC and the PC will be delivered in cash. Further, as we saw in the question, it was given that E1 Limited has decided or agreed to pay 20 lakhs additional consideration. So E1 will pay additional consideration. How much additional consideration E1 Limited is going to pay to B Limited? Additional consideration. So additional consideration in this particular case is given to us as 20 lakhs. Correct? Additional consideration 20 lakhs is given to us. Correct? Additional consideration 20 lakh is given to us. So, and this additional consideration will be given only if the condition will be met. And the condition is that the profits of the acquiring company, condition is that profits of the acquiring company must exceed, as it was given in the question, 2 crores. 2 crores in second year. And it was given that we are going to pay you 20 lakh after 2 years. And we will pay you 20 lakhs only if in the second year your profit would exceed what we call 2 crores. Is it clear to you? Further, in this particular question, it is also given that fair value of consideration, fair value of additional consideration, it was given in the question that fair value of additional consideration on the date of acquisition is 13 lakhs. And at the end of the first year, it is 16 lakhs. This is the question. Intentionally, I wrote the question just to make you aware of all the what we call information of the question. Correct? Now, after having a look over this particular question, what should we do? As I told you, Ind AS 103 states that on the date of the acquisition, when you are going to record the purchase consideration, of course, by way of entry, in that case, the contingent consideration must be made a part of it. So that mean when I am going to record the entry and when I am going to record the entry on the date of acquisition, in this particular case, on the date of acquisition. So first of all, I will write here on the date of acquisition. And on the date of acquisition, as you know, normally what entry we pass, as I told you earlier, normally we write all the assets which we take over at fair value. Correct? We write in this manner, all the assets taken over. Besides that, we also write to all the liabilities taken over. And then we write cash provided purchase consideration is given in cash, or you can simply write consideration. Of course, as per the agreement, 100 lakhs will be paid by way of what we call cash payment. So I'm going to write here 100 lakhs. Is it clear? 100 lakhs. And then I will have to write here, I will have to present here the additional consideration also. That is the point is. Now the question is that what value you are going to present it. So actually in the examination, you will have to write only this particular entry. Is it clear to you or not? You need not require to do anything extra, but point is that you should also understand some logic being a professional student. As I told you, when I am going to record the contingent consideration, I will have to make a provision and I will write here provision for contingent consideration, provision for CC. CC means contingent consideration. At what value it will be recorded? It will be recorded at fair value. And fair value in this question is clearly given. Question states that fair value of the contingent consideration, the value of consideration in absolute terms is 20 lakh. No doubt about that, because we are supposed to pay 20 lakh at the end of second year. But it is given that on the date of acquisition, the present value or fair value of contingent consideration is only 13 lakh. Quite obviously, the present value will generally be lesser than the what we call absolute amount, which will be paid later. We are supposed to pay 20 lakh at the end of the second year, and today we are trying to find out its fair value. Actually, in order to find the fair value, honestly speaking, the present value is considered. However, in the question it is given clearly. So, 13 lakhs I am going to write here. Actually, you are supposed to do in the examination only this up to this particular point of time. Because question is simply asking you what will be the amount of consideration. So the total consideration will be equal to 100 plus 13, 113 lakh. This will be your answer. But just to make the point more clear, correct? You will have to do only till up to this particular point. As I told you, question will hardly comprise of what we call 2 marks, 3 marks or 4 marks, not more than that. Now, just presume for a while. I'm simply elaborating the discussion a little bit further. As you know, when we are going to reach the end of the first year, now, so because this is the date of acquisition, now we reach the end of the first year end. At the first year end, how I am going to record this consideration? First year end, although it is not needed at your level, to be very honest, but still I am trying to make you understand. At the end of the first year, it is given in the question that present value has gone up to 6 lakhs. The fair value is now 16 lakh because now we have reached the end of the first year. Correct? So now, because provision for contingent consideration which we created on the date of the acquisition, reflecting it at 13 lakh, now we know that provision basically is a sort of liability, and now the value of the liability has gone up. So quite obviously, it's a sort of loss for us, isn't it? Because it is a loss to us, I'm going to record it in the profit and loss account. I will write here profit and loss account, and in bracket, if you want to show, you can show it fair value change. Fair value change. Fair value change. You write here fair value change. Fair value has changed by 3 lakh because from 13 to 16 it has moved. That means liability has gone up by 3 lakh. That is why it is a loss. So profit and loss account will be debited, and provision for CC will also be increased. Our liability is going up by 3 lakhs. That is why it is a loss to us. So this is the entry I am going to write at the end of the first year. Now we are going to, let us say, reach the end of the second year. End of second year. End of second year. Now in second year, 2 scenarios may unfold before us. 2 scenarios may unfold before us means because either of these 2 events would take place. One, either the target would be achieved or target would be achieved, isn't it or not? Either the target will be achieved or it will not be achieved. Presuming that at the end of the second year, target has been achieved. Now, if target has been achieved, what will be my entry? A. Target achieved. That means the acquiring entity has met the condition. Target achieved. Acquiring entity was asked to have a profit of in excess of 2 crores, and we presume that they are able to meet it. Target achieved. Now, if target is achieved, in that case, what entry you are supposed to pass? You have to think on logical lines. Because the target has been achieved, and as an acquirer entity, now you will be under foundation to pay off the amount. Logically, you are supposed to pay 20 lakhs without an iota of doubt. Isn't it or not? So if you are going to pay 20 lakhs, obviously your cash will move out of your business. So you are going to credit the amount of cash to bank. You are going to write 20 lakh. But how much there is balance in the provision so far? You are supposed to pay now 20 lakh, but if you look more carefully, then you'll find that balance in your provision actually is 16 lakhs. So that means if target is achieved, number one, you will have to pay the contingent consideration in absolute terms, that is 20 lakhs. But in your provision account, the balance right now is 16. So because of 20 lakh worth of payment and because of available balance of 16 lakh, there will be another loss of 4 lakh. So we are going to record it in this manner. Whatever balance is there in the provision, now we are going to debit it. Provision for contingent consideration account debit. That is 16 lakhs. Is it clear to you? I will debit 16 lakhs. Total balance is there 16 lakhs and now we are paying off this liability. So obviously the provision will be elapsed. And because there is balance of 16 but I am supposed to pay in absolute terms rupees 20 lakhs. So I am going to write here 20 lakhs. That means there will be a loss of 4 lakhs. So in this case, if target would be achieved, obviously we will have to make the payment and there will be some loss. Now another scenario is there. Out of these two, one will take place. If target is achieved or target is not achieved, suppose at the end of the second year, target is not achieved. Target not achieved. Target not achieved. If target is not achieved, in this particular case, you just think logically, what should be the entry? You have kept in provision 16 lakh worth of amount under an impression that you may have to pay this particular amount. That is why you are creating a provision. Provisions are always actually made in accounts to meet any eventuality. So in this particular case, you were under an impression that you may have to pay actually 20 lakh, of course, if the condition would be met. Now, if the condition is not met, that means you are escaped of what we call that particular payment. Now you need not require to make the payment. Now, if you need not require to make the payment, then why the hell in provision for accounts, you are going to keep a balance of 16 lakh. You will revert it back to the profit and loss account. Is it clear to you or not? So if target is not met, then again you are going to debit the provision for contingent consideration account, but this time it will be a gain for you. Provision for contingent consideration account, you will debit it and you will take it back to the profit and loss account. As we call it in accounts, we are reverting it, R-E-V-E-R-T-I-N-G. We are reverting it, we are taking it back to profit and loss account. I will take it back to profit and loss account. As I told you, at your level question will simply ask, what will be the amount of consideration? Your answer will be 100 plus 13 lakh, that is 113 lakh. Later part which I did, basically to make you well aware of how the accounting is dealt up with. Is it clear to you or not? Well, after this, we pick up another question in this particular case. In this particular case, there is one more question, I think. In fact, two more questions. 13.2. Now in 13.2, it is stated that D Limited has acquired 100% of equity of F Limited on 31st of 3, 2021. So this time D Limited acquired 100% stakes in F Limited. Purchase consideration comprises of an immediate payment of 10 lakh. Of course, immediate payment means on the date of acquisition, we will have to make an immediate payment of 10 lakh. And the agreement is that two further payment of 1.21 lakhs. Two further payment of 1.21 lakhs each. And condition is if the return on equity exceeds 20% in each of the subsequent 2 financial years. If in each of the subsequent 2 financial years, of course, the return would exceed, in that particular case, we will have to make the payment. Correct? So this is the scenario in this question. Just allow me a second, actually. Just allow me a second. Actually, there is an urgent call. Hello? हाँ कहाँ से हाँ हाँ बोलिए शायद आपने पहले कॉल करा हो हाँ बोलिए हाँ हाँ बोलिए क्या क्या काम Yes. So we were talking about this particular question. In this particular question, actually, the agreement is that we are going to pay you at the time of acquisition 10 lakhs, and agreement is that we are going to make you two further payments of 1.21 lakhs each in each of the subsequent year, but the condition is that your what we call return on equity must be more than 20%. So this is the question. Now, question will ask you, in fact, this question we have picked up right from your module itself, compute the value of the total consideration on the acquisition date. Only this much will be asked, correct? But just to make the point a little bit more clearer, as always, now in this question, this is this question was 13.2, correct? So 13.2, now we pick up 13.2. This is the question, 13.2. In this question, as we noted down, what was the situation? There is an entity by the name of D Limited, correct? There is an entity by the name of D Limited. And this entity is taking over E Limited, as we just saw. Further, it was agreed that on the date of acquisition, whatever is the date of acquisition, it was agreed between the two parties that immediate payment will be equal to 100 lakhs. Immediate payment will be equal to 100 lakhs. And then purchasing company is telling to the other company that at the end of each of the subsequent year, that means the first year will end here, no doubt about that. We will pay you 1.21 lakh. Further, we will pay you at the end of the second year also 1.21 lakh. But the condition is attached. The condition is attached that we would pay you only in case if your return on equity will be more than, return on equity will be more than 20%. Return on equity should be more than 20%. Then only we are going to make the payment. Is it clear to you? In each of the subsequent year. This is the condition here this time. Actually, if I am going to compute the amount of additional consideration in absolute terms, it will be equal to 2.42. So at the end of the second year, logically, by the end of the second year, we should have had paid 2.42. But here in this particular case, what is happening? Company is telling that in case at the end of the first year you are able to achieve the target, we are going to make a payment to you of 1.21 lakhs. Is it clear to you? This is the scenario in this particular question. Now we come back, and further in this question it was also given discount rate is 10%. Discount rate 10% is also given in this question. Obviously the discount rate has been furnished so that you can find out the present value, and the present value is considered what we call as fair value with respect to deferred consideration. So in this particular case, what is happening? Logically, suppose if in the examination, if I have to deliver the solution to this particular question, how I am going to deliver? First of all, I am going to write purchase consideration on the date of acquisition. Only this much solution logically I need to provide. Purchase consideration on the date of acquisition. Now, purchase consideration on the date of acquisition, A, immediate payment. On the date of acquisition, the immediate amount is, immediate payments is equal to 10 lakhs. Correct? So I am going to make a payment of 10 lakhs. rupees in lakhs. So 10 lakhs I am going to make a payment. And plus I will add here, but I must write here provision for contingent consideration. Now provision for contingent consideration, how you are going to find? Because right now you are on this particular date. After that, at the end of the first year and then at the end of the second year, you are supposed to make payment of 1.21 lakh each. So you will have to compute the present value. In order to compute the present value, what I am going to do, 1.21 at the end of the first year I will have to pay. I will multiply it with discount factor at 10%. Discount factor at 10%. If I am going to consider the discount factor, it will be equal to 0.9091 something. You can take 0.909 also if you want. Correct? That is equal to 1.10. And at the end of the second year, the present value will be equal to 1.21 multiplied with discount factor at 10%, which will be equal to 0.8265. So in this case, it will be equal to almost 1 lakh. Just allow me. 1.21 into 0.8265. Yes, approximately 1. It is coming 1.000065. So I will consider it as, for simplicity's sake, as 1. Is it clear to you? So now, if I am going to add both these, so ultimately I find that the present value actually is 2.10, whereas the absolute amount is 1.21, 1.21, 2.42. So that means on the date of acquisition, I must record a purchase consideration of 12.10. This is the answer you have to deliver logically. Correct? Only this much answer is required at your level. Just to make the point clear, further, entry. Now we are going to pass the entry. What entry I am supposed to pass? First of all, on the date of acquisition in year 1. In year 1, on the date of acquisition. On the date of acquisition, my entry will be, as I told you, my entry will be asset account debit. Asset account debit. Correct? And then I will write to liability account. Since in the question assets and liability no information is given, I will leave them blank. Then I will write here to cash, presuming the consideration has been delivered in cash. The immediate amount is 10 lakh. And then I am going to write here provision for contingent consideration. Now provision for contingent consideration at fair value we have recognized 2.10. So this is how on the date of acquisition we shall have to pass the entry. Now when we are going to reach the end of the first year, problem is that at the end of the first year, as per the agreement, either we may have to pay 1.21 lakh or we may not have to pay, depending upon the fact whether the condition has been achieved or not. So accordingly the entry will be passed. Is it clear to you or not? So at the end of the first year, similar to the one as we took in the last case, either of these two scenarios could unfold. But the question is that in this case, either at the end of the first year itself, either of the two scenarios may unfold, because it is given in the question that we are supposed to pay them 1.21 lakh at the end of each year, provided the conditions are met. So if target is achieved, if you are able to achieve the target, if target is achieved, then what will be the entry? You tell me. Since you have kept a provision for CC, how much provision by the end of the first year you have made? Actually, if I will break this provision, correct? If I will break this provision, that is 1.21 into 1.10, correct? And balance amount will be for second year. Is it clear to you or not? What my point is, because provision has been made by taking into account the present value of these two figures. So we can say that we are making a provision for this amount and we are making a provision for this amount. That is why total is equal to 2.10. So we may say that at the end of the first year, logically provision for contingent consideration for the first year's payment is actually 1.10, isn't it? So I'm going to debit it 1.10. And because the condition is met, I will have to make a payment of how much? I will have to make a payment of 1.21 lakhs. And the difference will be a loss to me. And difference will be equal to, that is 11,000, 0.11. If the scenario is met. If scenario is not met, if target is not met, if target is not met, if target is not met, then what entry you are going to pass? Obviously, whatever balance which you have kept in your provision, under an impression that this much of amount you may have to pay at the end of the first year, you will revert it back to what we call profit and loss account. So provision for contingent consideration for the first year is 1.10, and we will take it back to the profit and loss account as we need not require to pay this amount. Is it clear to you or not? So in this case, it will be again. Now we come over to the second year. At the end of the second year, again I will have to pass the entry in the similar fashion. At the end of second year. At the end of second year, you will have to pay 1.21 lakh only, provided actually the condition in the second year is met, because you have made an agreement that we are going to pay you 1.21 lakhs only, provided the condition is met. Is it clear to you? In the first year, condition is not met. So that is why whatever provision you created, you took it back to your profit or loss account. In this case, at the end of the second year, how much you are supposed to pay as per your what we call expectations? You are supposed to pay, because you have created a provision of 1 lakh, 1.21 into 0.8265. It means you are under an impression that a liability may occur, and for the same you have made a provision of 1 lakh. So at the end of the second year, if target is achieved, if target is achieved, then entry will be provision for contingent consideration account, provision for contingent consideration account, debit, that is equal to 1. And then you are going to write here to bank account. However, you will have to pay 1.21 lakh if condition is met. So in this case, your loss will be equal to 0.21, profit and loss account. So in this case, your loss will be equal to 0.21. Is it clear to you? If not met, if target is not achieved, if target is not achieved. Now suppose if target is not achieved, now you let me know actually what entry should I deliver in this particular case. How much I have made in the provision, or how much provision actually we have created, 1 lakh. We will take it back to profit and loss account. So provision for contingent consideration account debit, that is equal to 1 lakh. And now we will take it back to profit and loss account. We will write here to profit and loss account 1 lakh. Is it clear to you or not? Is it clear? So this is how you are going to actually do this particular topic. Third question is similar to the one which I just actually told you. Now we move over to the next one. What is the next topic? First of all, let me actually see, and then we are going to discuss about that. You can easily do 13.3. I need not require to tell you. I have already given it in a solved manner. You can easily manage this question. Don't worry. Section 14 now we are going to pick up. Section 14 is related to contingent liability. Contingent liability. If you remember again, you will have to remember all the things of the first session wherein I talked about this particular fact, contingent liability, if you remember. Very first point with respect to accounting, when I told, especially when I started the topic under the what we call accounting section, identifying, recording and measurement. As I told you that acquirer entity will have to record all the assets and liabilities which are appearing in the balance sheet of the acquiring entity. The general principle is that all those assets and liabilities are taken over and recorded at fair value. This is the general principle. However, I also told you there are some exceptions attached to that. Exceptions, correct? And we talked about contingent liability. If you remember the discussion of the very first session, whereupon I also told you by stretching a balance sheet also, that suppose this is a contingent liability of the acquiring entity. Obviously, it is not written in the balance sheet. That is why it is a contingent liability. Isn't it or not? And generally, a contingent liability means actually there is a present obligation, but we are under an impression that probability of outflow of funds is very low. That means we don't think actually that cash will move out of the business on account of this. So that is why we have recognized it as a contingent liability. That means under the footnote. Acquiring entity. However, Ind AS 103 states that when we are taking over the business of the acquiring entity, we will have to record the contingent liability also as a liability. That is why it is an exception to the general principle, because the general principle says that only the assets and liabilities which are appearing in the balance sheet of the acquiring company shall have to be recorded. But here we are recording a liability which is not appearing in the balance sheet. That is why it is an exception. Number one, Ind AS 103 states that such contingent liability will have to be recorded by the acquirer entity irrespective of the fact whether the probability of the outflow of funds is there or not. So we shall have to record it, and this is exactly the answer which we will have to deliver it. So such question, if they strike in the examination, and they might strike either under the objective sections or under the case study section, but they want what we call encompass more than 2 marks, correct? So 14.1 is the question on such line. Z500 Limited acquired C400 company on 1st of April 2019. For a lawsuit contingency, C400 has a present obligation as on 1st of April 2019. And the fair value of the obligation can be reliably measured at rupees 50,000. This is the scenario given in this particular question. I will explain it. Further, it is given that as of the acquisition date, it is not believed that an outflow of cash or other assets will be required to settle this matter. Further, it is given what amount should be recorded by Z500 company under Ind AS for this contingent liability of C400. So this is the entire question, but I am very sure most of you might not be able to or might haven't got it, the actual facts. Now I will explain the actual fact as usual, as I normally do. Is it clear to you? In order to explain the actual facts, what actually I am going to do now, just pay attention. First of all, I am going to stress the entire outline of the question. Actually, why I am doing all these things? Because later on, when suppose you are going to refer, you need not require to look at the question itself. Just looking at the topic, things should be recapped. That is actually my point is. So here right now it might be appearing to you that little bit of time is getting wasted, but actually it is resulting in lots of time savings later on. Section 14. Now we begin section 14. As I told you, this section deals with contingent liability, correct? So contingent liability. Contingent liability. In order to understand this particular question, as usual, first of all, I stretch a line. As per the information which we just saw in the question we found over there, and I am talking about section 14, question number 1. There is an entity by the name of Z500, and it is given in the question it is taking over C400 Limited, correct? Further, it is given in the question that on the date of acquisition, let us say this is the date of acquisition. It is given that on the date of acquisition, C400 Limited is having a contingent liability. In fact, it is having a liability which it has recognized as a contingent liability. So, CL here stands for contingent liability, correct? They are having a contingent liability for a lawsuit, and because it was given in the question that C400 is under an impression that probability of outflow of funds is is slim. So that is why they have recognized it as a contingent liability. This is the point here which you need to understand. Is it clear to you or not? C400 Limited has a liability and probability of outflow of funds, it was given in the question, is very slim. That is the reason actually they have recognized it as a contingent liability. As a contingent liability, it is given in the question. And this liability is for a lawsuit. So, some party might have actually put up a suit against them, a case against C400, and they are having a liability, contingent liability. Further, it is given that its value can be reliably measured at rupees 50,000. We presume this 50,000 is fair value. It is given in the question. Correct? So what answer now you are supposed to provide? As I told you, as per Ind AS 103, this is the answer which you will have to write for this case study. As per Ind AS 103, as per Ind AS 103, comma, contingent liability of acquiring entity, that is C400 you can write, of acquiring entity shall be recognized by the acquirer, acquirer entity at a fair value of rupees, 50,000, and you can also add irrespective of, as I told you, we will have to recognize this irrespective of the fact whether probability of outflow of funds is there or not. Irrespective of the fact whether probability of outflow of funds is there or not. So irrespective of that, we shall have to recognize this liability. This is the point which we need to understand here. There is another question it asked, correct, which you can do it by yourself. Now, we come over to next section. The next section, honestly speaking, so far, nothing has been asked from this particular section so far. And both the question which I did, correct, have been taken from your module. And section 15 actually is related to pre-existing relationship. Now, what we mean by here pre-existing relationship. This particular section is pretty formidable and very strong sort of, you can say, topic. It is not easy to handle, especially when students do not know much about this particular topic, no doubt about that, correct? What we mean by pre-existing relationship, I will just first let me actually explain it before I move further and dwell into the question, correct? Let us say there is an entity by the name of E1, Correct? This is an entity E1. And this entity, and there is another entity by the name of, let us say, E2 Limited. They are two separate entities. Remember one thing, at this moment, they are two separate entities. And let us say, because they are two separate entities, so it is possible that they might be doing business with each other. And let us say, E2 Limited has filed a case upon E1 Limited. E2 Limited has filed a case against E1 Limited on account of some breach of condition or whatever reason. Correct? So E2 has filed a case upon E1 Limited. Now, let us say this case was filed in the year 2020, for simplicity's sake. And now in year 2025, let us say, in year 2025, E1 Limited decided to take over E2 Limited. Are you getting my point or not? So now in year 2025, E1 Limited has taken over the business of E2 Limited. And earlier, we have already seen that E2 Limited has a case against us already pending. So on this particular date also, that case is still pending, but now we have taken over this particular entity. So we may say that on this particular date, there was a pre-existing relationship. Although we are using the word relationship, but to be very honest with you, there is a sour relationship. The relationship was not very good, in the sense means this company has already filed a case against us. Are you getting my point or not? So this is what we mean by pre-existing relationship. That means on the date of acquisition, when I am taking over the business of this particular entity, we are already involved in some what we call legal battles, correct, or legal wars, we may say. This is one way, one type of relationship which we may face. Another case, just take into account the another one. In this particular case, let us say there is an entity E1 and there is also an entity E2. We further presume that E1 is a very big brand name. So we have allowed our license or our name or our trademark to be used by E2 Limited. And let us say we gave our license or trademark in the year 2020. And when we gave our license or trademark or copyright to be used by E2 Limited, we gave it for, let us say, 10 years. We told them you can use it for 10 years. Is it clear to you? Now let us say after the end of the next 4 years, that means in year 2024, let us say. Correct? Or at the beginning of 2025, we may say, because 4 years have gone by. So in the beginning of what we call year 2025, E1 has taken over, let us say, E2. But we had given a license to them to be used by E2 Limited for 10 years. But now after almost end of 4 years, we are taking this particular entity back. That means this entity is losing out on 6 years of license period which was available with them, because we took them almost after 4 years. The point here is that on this particular date, there was a sort of relationship. Here relationship, I have already told you, there was something in which two parties were involved earlier before the actual business combination. I hope you have got it. Is it clear to you? That is what we mean by pre-existing relationship. Now the next part is how to deal up with that. Next part is this, how we have to deal up with that. This internet issue comes into play now, it seems. Just wait some time, it lags. I can't help it in this case. This is the only problem with this electronic pens, devices. Okay. What happened? Hmm. You may be wondering what is happening over here, isn't it or not? Sometimes this pen creates a bit of problem. I can't help it. Now see, after such long battles, actually problem is that where our studio is located right now, just on the side, a metro project work is going on and they are consuming hell of electricity. Otherwise, there was never ever problem of electricity in this area. But problem is that this is creating a problem. Okay, I will leave it as it is for a while. Then I will start from the next part. Okay, I will do it from this particular space, correct? First, in this particular question, you need to understand one point. One point which you need to understand is right here. If there is any pre-existing relationship, PER, pre-existing relationship, correct? Pre-existing relationship between acquirer and acquiree, between acquirer and acquiree. Now you have got the meaning of pre-existing relationship. So if there is any pre-existing relationship between acquirer and acquiree, correct? Prior to business combination, correct? Then, as I told you, then purchase consideration paid, because we are taking over the business of the other entity and some relationship was there already. So purchase consideration paid is considered inclusive of I'm using a word here, settlement amount. Is it clear to you? And so often we are going to use this word, so I will use the term SA. The point here is that, just think of this particular case. Earlier I told you E2 Limited has filed a case upon us, correct, in the year 2020, and almost after 5 years later, we are taking over E2 Limited. Quite obviously, when we will take over E2 Limited, whatever consideration which I am going to deliver to them, it will be presumed that it is inclusive of settlement amount. Now, what we mean by settlement amount? Because this company had earlier filed a case upon us, quite obviously I will have to make some payment to E2 Limited. Are you getting my point or not? To settle the what we call issue between us and they. So that is the point here, is that in case if I am going to make the payment later on after acquisition, it will be presumed that whatever purchase consideration I am paying to the other entity, it is inclusive of the settlement amount. Is it clear to you or not? So this is the point. And because we presume it in this manner, that is the reason, as such, settlement amount, SA, settlement amount for such, settlement amount for such settlement amount for such PER, pre-existing relationship, needs to be subtracted needs to be subtracted from PC, from purchase consideration. So in order to know the true value of the purchase consideration, we will have to subtract the settlement amount. Is it clear to you or not? Clear? Right, sir, absolutely clear. Important thing is that I told you, as far as relationship is concerned, I gave you two examples of relationship. One where the legal lawsuit was imposed upon us, acquirer entity, and one where the acquirer entity had given a license to the other entity. So we may say that as far as pre-existing relationship is concerned, pre-existing relationship could be we may say of two types. One, A, non-contractual. For example, in earlier case, when lawsuit was filed upon us, it cannot be considered as a contractual sort of pre-existing relationship. Did we make a contract with them? Did we make a contract with them that you should put up a what we call case upon us? No. So it is a non-contractual relationship. Non-contractual relationship like lawsuit. Correct? It could be non-contractual or contractual. Now, second case where license was given, it can be termed as contractual sort of pre-existing relationship. Why contractual? Because in this case, there is a contract between the acquirer and the acquiring entity that we are giving you this trademark copyright license for a particular period of time. So it is a contractual relationship. For example, license. You can write anything, license, trademark, etc. I'm simply writing license, correct? So this is the scenario as far as this thing is concerned. Now we come over to the accounting part. As far as accounting part is concerned, accounting part. How to do the accounting? The point is this. In order to do the accounting, what we are supposed to do, that is very important. First, I write here a non-contractual. If pre-existing relationship is non-contractual, in that particular case, settlement amount shall be subtracted from PC, as we saw earlier, PC, and when it will be paid, because ultimately we will have to pay the settlement amount, and when it will be paid, following entry will be passed. Following entry shall be passed. Following entry shall be passed. What will be that entry? The entry will be provision for litigation or lawsuit, if you want to write. Because generally, if a lawsuit is running against us, quite obviously we must have had created a sort of provision for the same. Provision for litigation account debit, profit and loss account debit to bank account. Suppose we had to pay 20 lakh because of that settlement, because that case was on when we acquired that particular entity, we paid 20 lakh. And let us say there was a balance in provision of 10 lakh, 12 lakh. So obviously the difference will be there, and that difference will be debited to profit and loss account. At the same time, if there was no provision, then entire amount which we are paying will be debited to profit and loss account. Is it clear to you or not? Then we pick up second point, that is contractual. Contractual. In case of contractual pre-existing relationship, correct? Actually, problem is that in case of non-contractual, there is less problem in the sense because we need not require to find out settlement amount. It will be given in the question itself. But in case of contractual, correct, like trademarks, copyrights, licenses, in case of contractual relationship, we will have to compute the settlement amount. This is the basic difference between these two, correct? So in this case, you will write here settlement amount. Settlement amount, first of all, we will have to find it out. So settlement amount shall be lower of, shall be lower of what? Shall be lower of right here. A, fair value of license. We are presuming we have delivered a license. You can write trademark, copyright, anything. Fair value of license on the date of acquisition. First of all, we will take into account the fair value of the license on the date of the acquisition. Correct? And from it, we are going to subtract less carrying amount of license, carrying amount of license, fair value of the license I will take into account, and then I am going to subtract the carrying amount of the license on the date of acquisition. Correct? So whatever value we are going to get, we are going to compare this value with penalty charges. Because we had given them the license for a particular period, let us say 10 years. And after 4 years, we are getting the company back in our fold. So that means still the unexpired period of license, that is 6 years, have gone by. That means the other entity had lost a bit of in this particular relationship. So that is why penalty charges will come into play. Penalty charges. Penalty charges will be computed in this manner. Unexpired fee. I will explain all these points. Don't worry about unexpired fee plus agreed percentage. I know that at this moment you might be feeling, sir, it is pretty tough. Nothing is tough. Point is this, only thing is that we have to be little bit more what we call resolute in our mission. That is the only point. Just pay attention. 15.1 is the case study I am picking up. You need not require to look at, you simply look over here. 15.1. If we are going to have a look over 15.1, we will find that there are two entities. Involved, and one entity is by the name of Progressive Limited. Progressive Limited. Correct? One entity is Progressive Limited, while the other name of the other entity is Regressive Limited. Regressive Limited. Regressive Limited. Two entities. Further, we are given that Regressive Limited had filed a case. Regressive Limited have filed a case against the Progressive Limited. Filed a case. So Regressive Limited has a case running against the Progressive Limited. Correct? Against the Progressive Limited, we may say. Okay. After this, what is happening? Because a case was being filed or a case was filed against us, so Progressive Limited has recognized a liability of 10 million. 10 million. Worth of, you can say, provision. Because they are expecting that a case has been filed against us, so perhaps we may have to actually pay 10 lakh to what we call Regressive Limited. They are under this sort of impression, Progressive Limited. Correct? Further, after some time, no doubt about that. So this is a scenario, and after some time, Progressive Limited is taking over the business of Regressive Limited. So Progressive Limited now takes over the business of Regressive Limited. When business was taken over, on this date, first of all, purchase consideration was agreed at 500 million. So Progressive Limited told Regressive Limited that we are going to offer you 500 million worth of purchase consideration. Also, what is important given in the question is that the Progressive Limited, which had recognized a liability because of the lawsuit running against them, correct? A lawsuit was being put against us, and we are quite obviously scared away bit, so we recognized a liability of rupees 10 lakh. But here in the question it is given that on the date of acquisition, the fair value of this liability is estimated at 20 lakhs. Fair value of this liability has been estimated at 20 lakhs. Correct? So in this case, how I am going to do the question? First of all, write A, settlement amount. First, you let me know what is the settlement amount in this particular case. Because on the date of acquisition, the liability has moved up to rupees 20 lakhs. So quite obviously, as a rule, we should settle the issue by paying them 20 lakhs. So settlement amount will be considered as rupees 20 lakhs. Is it clear to you or not? It's a very tough part, but I'm trying to make it as simple as possible. 20 lakhs. 99% student of your level will never do this topic. Settlement amount is 20 lakh. Now after this, as I told you, that whatever settlement amount is there, we will subtract it from purchase consideration, as it will be construed, it will be inferred that purchase consideration is inclusive of this amount. So purchase consideration shall be recorded. Purchase consideration shall be recorded. Purchase consideration shall be recorded at actually in this case all values are in millions. Correct? All values are in millions. Today eraser is not working. Anyway, 20 million. I thought by this time it would have been okay, but now it is okay. So 20 million. And purchase consideration will be recorded at, because in the question purchase consideration is given at 500 million. So I will have to subtract. As I told you earlier, the settlement amount will have to be subtracted to know the amount of purchase consideration. So it will be presumed that we will pay 480 lakh worth of purchase consideration. And besides that, we will have to pay 20 lakh worth of settlement amount. But in this case, when we will pay the settlement amount, the entry will be entry for payment of, entry for payment of, entry for payment of settlement amount. What entry we are going to pass? Because earlier we were under an impression as an acquirer entity that we are supposed to pay actually only 10 lakhs. But now we found that we are supposed to pay 20 lakhs. So that is the reason in this particular case, we will write the entry provision for settlement amount. We must have created a provision of rupees 10 lakh. And now we are supposed to pay 20 lakh. So it is a loss to us. Profit or loss account debit will be 10 lakhs. And I will write here to bank 20 lakhs. So this is the entry I will have to pass. Is it clear to you or not? Not tough as it looks. But in case of contractual, there is little bit of problem. Little bit, not lots of problem. Don't worry about that. So we were talking about the second situation now, correct? In order to understand that, we pick up case study 10.2. You need not require to look at the case study. You can simply look over here. In this case study, we will find that there is, in fact, you can study case study 10.2 in the meantime if you want. Otherwise, you can simply have a look over here. In this case, there is an entity by the name of Flower Limited. By the name of Flower Limited. Interesting name. And then there is another entity by the name of Petal Limited. Petal Limited. Correct? As per the agreement, we will see that Flower Limited is a big brand company. It has given a license to Petal Limited to be used by them for 10 years. Flower Limited had given a license to be used by Petal Limited, license for 10 years. License for 10 years was given to Petal Limited, correct? And after the 4 years, now Flower Limited is taking over Petal Limited. License was given for 10 years and after the end of the 4th year, now Flower Limited is taking over the business of Petal Limited. As per the agreement, now what happened? Purchase consideration, let us say, is decided between these two entities is equal to 2 crores. Is equal to 2 crores. Is it clear to you? 2 crores. And further, it is given, I will have to, it seems, go through the question. I am not able to recap it. Fully. So it is better to have a look over the question. Today, no, internet is creating a bit of problem. Right, here it is. Flower Limited acquires Petal Limited for a purchase consideration of 2 crores, correct? 2 crores. And Flower Limited provided a license for 4 years ago to Petal Limited for 10 years at rupees 5 lakh. The license can be terminated at any time by paying amount equal to unexpired initial fee plus 20% and fair value of license on the acquisition date is 9 lakh. So this was the information which I was skipping, that Flower Limited had delivered the license to Petal Limited for rupees 5 lakh. Correct? This is the point which one need to actually take into account. So here I will write now 5 lakh was the amount. License was given for rupees 5 lakh. License for 5 lakhs. Just wait. So license was given by Flower Limited to Peter Limited for rupees 5 lakh. This is the situation in this case. And further it is given in the question, as we just saw, termination amount or penalty charges, whatever you may like to write. Termination amount is equal to unexpired fee. Unexpired fee plus 20%. What does it mean? It means if any party will violate the term, that means Peter Limited was not allowed to use this license for 10 years. So logically it will be considered as a breach of contract by the Flower Limited, because Flower Limited is taking over the Peter Limited almost after 4 years after the date on which license was given. Is it clear to you? So 6 years of use of license were remaining, and Peter Limited now cannot use the license because it has been taken over by Flower Limited. So quite obviously, in this particular case, some termination or penalty charges will have to be paid by the acquirer entity to this entity, and as per the agreement, that is equal to unexpired fee. What we mean by unexpired fee, I will let you know in a short while, plus 20%. This is the scenario of this particular question. Further, it is given fair value of license. In the question it was given fair value of license on the date of acquisition. On the date of acquisition means when Flower Limited is acquiring this particular entity. On the date of acquisition is rupees 9 lakh. This is the entire scene of this particular question. And in order to comprehend it, now you will be able to explain. Don't think that it is pretty tough or something like. Nothing is tough in the life. Only thing is that we need a large-heartedness approach. So here we go. First of all, I will see to it that you understand it completely, comprehensively. First of all, we have to compute under step number A, settlement amount. I told you what we mean by settlement amount. Settlement amount, just a moment ago, I told you is lower off, if you remember, correct? Now you will be able to understand, then you will think, oh my God, it is so easy. I told you settlement amount will have to be computed in case of contractual relationship, and the settlement amount will not be given to us, correct? So in this case, as I told you, first of all, I am going to consider the fair value. I am going to consider the fair value of license on the date of acquisition. On the date of acquisition, fair value is equal to 9 lakh. It is given in the question, correct? It is given here, 9 lakh. Then I told you I am going to subtract the carrying amount. The carrying amount of license on the date of acquisition. Carrying amount of license on the date of acquisition. Just think for a while. Suppose you acquire a license from somebody for rupees 5 lakh to be used for 10 years. If you are going to use it for 10 years, that means you are going to amortize this particular asset every year by 50,000. That is why after the 10th year, the value of this license will become 0. Isn't it? That is exactly what we mean by it. Now, what is happening? That means we have used this license for 4 years. So in 4 years of time, I must have amortized it by rupees 50,000, 50,000, 50,000 and 50,000, or 50,000 into 4, I may say 2 lakh. That means at the end of the 4th year, the carrying amount of this particular license must be equal to 6 lakhs. Must be equal to 3 lakhs. Is it clear to you or not? Right, sir. It is clear, absolutely clear. So if it is clear to you, then in this particular case, I do not know why this problem is creeping up today. Not working at all. This is the problem. Anyway, carrying amount on the date of license is equal to 3 lakh. And you could have found out in this manner also. You could have found out in this manner also. See here, 5 lakh is the value for 10 years. If 5 lakh is the value for 10 years, what will be the value for 6 years? Because 6 years are remaining. So you could have found out in this manner also. Correct? Anyway, now we will take the difference of that. The difference will be equal to 6 lakhs. So we are able to find out fair value less carrying amount, that is equal to 6 lakh. And now we will have to compare it with, as I told you, B, penalty charges. And what we mean by penalty charges? Penalty charges. Penalty charges, as I told you, unexpired fee. Unexpired fee. Now what is unexpired fee? Actually it is written unexpired fee. And it is nothing but carrying amount of the license. It is carrying amount of the license. See here, you have purchased a license for 5 lakh to be used for 10 years. That means you have paid a fee of 5 lakh for 10 years. And 6 years are still remaining. So what will be the unexpired fee? That is equal to 3 lakhs. Is it clear to you or not? So unexpired fee is nothing but the carrying amount. And plus 20%. I will add 20% to it. So 20% if I am going to add, it will be equal to how much? It will be equal to this much. So ultimately it will be equal to 3,60,000. So out of these two, the lower figure will be considered. And the lower figure will be 3,60,000. This is the only difference. So here in case of contractual relationship, you will have to actually find out in this manner the settlement amount. And once the settlement amount is found out, now rest of the things you can easily manage by yourself. Under the second step, this was step number A. Under step number B, now I will write here purchase consideration. Amount of purchase consideration was 2 crores. That is 200 lakhs. Correct? And from there on, I am going to subtract settlement amount. Now, what is the settlement amount in this case? 3,60,000. As I told you, settlement amount must be subtracted from the purchase consideration. So the purchase consideration effectively, which we will pay, will be equal to 196,40,000 in this case. 196,40,000. And then we will also pay settlement amount separately and the entry, because in this case we haven't created any provision. So I will debit the entire payment to P&L account, profit and loss account debit to bank account, and we are supposed to pay 3,60,000. 3,60,000. Is it clear to you or not? Interesting? Very interesting. So this is how pre-existing relationship, although never ever question so far have been asked from this particular topic, but who knows? Who knows? Correct? So that is the reason we must actually keep ourselves on the what we call safer side. One more question is there in this particular section. Try to attempt that particular question of your own. So on such note, we end of this formidable chapter. Now we are moving over to section 16. Again, section 16 deals up with what we call some concepts, and in this case we shall be talking about what we call indemnification assets. Just have a look over your section 16, and in this section, as I told you, we are going to take up some concept based question on indemnification asset. Section 16, indemnification assets. Correct? Indemnification asset. Indemnification, if you remember in the very first session, we talked about this particular asset, indemnification asset. Indemnification means to compensate. Is it clear to you? So what exactly we mean by indemnification asset and what will be the treatment? So in order to understand that, we pick up question number 16.1 and you need not require to have a look over that. You can simply look over here. In this particular case study, what is happening? Actually, there is an entity by the name of A, and this entity as usual is acquiring the control of entity B. This particular entity is acquiring the control over entity B. Correct? Further given in the question that there are some customer of this particular entity, entity B, and who have filed a case upon what we call entity B. Correct? So as far as what we call entity B is concerned, as I told you, the customers of B Limited, customers of B Limited have filed a case, because of some or other reason. They might have filed a case, so it is given that they have filed a case on B Limited. So when we are taking over the control of company B, there is already a case which is running, and the customers have already filed a case upon what we call this particular entity. Correct? And because the customers have filed a case, and B Limited has actually recognized it as a sort of contingent liability, and not only that, they have also recognized this liability at a fair value of rupees 250 lakh. Fair value of rupees 250 lakh. So customers of B Limited have filed a case upon company B Limited, and company B Limited has recognized it as a contingent liability, and its fair value is 250 lakhs. Correct? Now, because in this particular case, entity A is taking over entity B. Entity A is taking over entity B. We know, and we have already gone through this particular concept, that company A will have to take over this contingent liability, not only take over this as a contingent liability, but shall have to recognize it, and shall have to recognize it at a fair value of 250 lakhs. But in this case, what else is given? In this case, it is also given that B Limited promised. So B Limited has given a promise to us. So B Limited promised to indemnify A Limited if losses will be more than 100 lakhs. Will be more than 100 lakhs. Now try to understand first of all before we put up the answer. Hardly 2 or 3 marks question. In this case, there is a contingent liability of B Limited, and this liability is having a fair value of 250. Quite obviously, now in this case, company A Limited will have to take it over and will have to recognize it as a liability. Now suppose after some time, this liability, after having taken over, gets materialized. So in that particular case, how much A Limited will have to pay? Quite obviously, the maximum amount which A Limited will have to pay will be equal to 250 lakhs. Isn't it or not? A Limited will have to pay maximum amount. So maximum possible payment from A towards this particular liability could be of 250 lakhs. So in this case, when this liability was taken over, B Limited promised that in case if losses to A Limited would be more than 100 lakhs. If losses to A Limited would be more than 100 lakhs, then we are going to compensate you. So as I told you, in this case, if suppose tomorrow A Limited will have to pay 250 lakh, of course it is a loss to A Limited, correct? So 250 lakhs. And the difference between that means this loss is exceeding 100 lakhs by 150 lakhs. So in this case, B Limited will have to indemnify us because they have given us a promise to the extent of 150 lakhs. This is the point of this particular question. Now, The point is that what is regarding what we call indemnification asset. That means in this particular case, entity A will have to recognize not only the contingent liability of 250 lakh, but they will also recognize an indemnification asset to the extent of 150 lakh. This is the point, and this is how you are going to deliver the answer. In the present case, this is the answer now. In the present case, fair value of contingent liability is rupees 250 lakhs. 250 lakhs. Therefore, A Limited shall have to recognize it as liability at rupees 250 lakh, because contingent liability will have to be taken over, shall have to be recognized, and shall have to be recognized at what we call fair value, 250 lakhs. Besides, in this case, as I told you, besides, comma, A Limited shall recognize an indemnification asset. They will have to recognize an indemnification asset of rupees 150 lakh. Indemnification asset of rupees 150 lakh, because in this particular case, as I told you, B Limited has given us a promise that in case if your loss would exceed 100 lakhs, then we will compensate you for the difference. So maximum possible loss could be 250. So it is exceeding 100 lakhs by 150 lakhs. So in this case, A Limited shall have to recognize besides the contingent liability and indemnification asset also. This is the point. Hardly 2-3 mark question. Similarly, next section is possible asset. Now what we mean by possible asset? Section 17. All these are concept-based topics. Section 17, and in this section, we will be talking about intangible asset, possible intangible asset. Possible intangible asset. What we mean by possible intangible asset, in order to comprehend this particular point, let's pick up 17.1. You need not require to look at the case study. You can simply what we call look over here. In this particular case, what is happening, 17.1 we are taking up. In this case, there is an entity by the name of K7 Limited. Correct? There is an entity by the name of K7 Limited. And of course, K7 Limited is taking over an entity that is online e-commerce entity. The entity is in e-commerce business, online e-commerce entity. So this entity K7 Limited is acquiring, as I told you, an online e-commerce entity. Correct? Because it is an online e-commerce entity, it is given in the question or in the case study that this entity is having 10 million registered user. 10 million registered user. 10 million registered users is something to reckon with. Correct? Because we are taking over this particular entity, and this particular entity is having 10 million registered user. So point is that in this particular case, this customer list Actually, it is known as customer list and it is an intangible asset. First of all, you need to understand this. It is known as customer list. And nowadays, customers list is also recognized as an intangible asset. So in this question, we will say that this database, correct, this database definitely, because it can work as a sort of asset. It can work as a sort of asset to us. How? Because we have got 10 million registered users. We have the names of 10 million customers. Definitely on that basis, we can enhance our business, enhance what we call our product. In fact, we can increase our sales because after all, 10 million registered users data is not what we call something which can be ignored. Is it clear? So in this particular case, further, even though we are acquiring this particular entity, it is also a possibility that this entity might deliver this particular data to somebody else. It is also a possibility. So that is why this asset will be recognized as possible intangible asset. Possible intangible asset in the sense that possibly it can give us some income. Is it clear to you? So that is the reason. So in this case, I will write here K7 Limited, K7 Limited, K7 Limited shall recognize customers list, shall recognize customers list, shall recognize customers list as a possible intangible asset, as a possible intangible asset, as a possible intangible asset. Why it is possible intangible? Possible means it can possibly bring us some return. Possible intangible asset. As online e-commerce entity, online e-commerce entity can deliver this data, can deliver this data to others also. So this customer list can be provided to anyone, isn't it or not, even though we are acquiring this particular entity. So that is why it is recognized as a possible intangible asset. Possibly it can bring us what we call some returns. Now, in this particular question, next topic is just a theoretical one, and we have already talked about. In fact, we have already finished this particular chapter, but just because some topics are still there, and I do not want to leave anything to chance, we have a habit of covering each and every aspect. Now, section 18 is related with bargain purchase, and I have already explained bargain purchase in the initial stages when we began this particular chapter. Bargain purchase. If you remember, in the initial stages itself, I told you, even though we study the concept of bargain purchase, but in practical life, bargain purchase is never ever possible. In spite of that, we study bargain purchase because I told you, on rarest of rare situation, only bargain purchase could arise. And it happens when the acquiring entities under some sort of pressure, some sort of foundation or compulsion to what we call sell their business. So only under such circumstances gain on bargain purchase could arise, otherwise never. Just to understand the point a little bit better, we presume that there is an entity by the name of H901. H901. We presume there is an entity by the name of H901. And we further presume that this entity acquires or is acquiring another entity by the name of Y100. The name of the other entity is Y100. Correct? We further presume that Y100 is under compulsion, due to some or other reason, under compulsion to sell the business. Under compulsion or foundation. Under compulsion to sell its business, to sell its business. So in this case, H1 Limited is acquiring the Y100 Limited. So in this case, gain on bargain purchase can definitely arise. And I told you, even in the initial stages, that generally the gain on bargain purchase can never arise. It could arise only if the other entity is under some sort of compulsion, foundation, mandation, correct, under some stress to sell its business. Now, if the gain on bargain purchase arise, standard also says that we have to review the entire vertical computation. Correct? So that before we arrive over the concrete conclusion that there is gain on bargain purchase, we must check that there is really gain on bargain purchase or not. Anyway, so in this case, I will write here the same thing which I just mentioned. Generally, gain on bargain purchase, does not arise. Generally, gain on bargain purchase does not arise. I have already told you. However, but at the same time, I add it back. However, if acquiring entity is under legal compulsion, or under some stress, in that case, gain on bargain purchase could arise. So in that case, gain on bargain purchase could arise. Otherwise, it is not possible. So in that case, gain on bargain purchase possibly can arise. Otherwise, it is not possible. Just for your knowledge sake, Ind AS 103 requires thorough, as I told you. Even though if you are having gain on bargain purchase, Ind AS 103 states that you must check and review again before you arrive over this particular fact that there is in reality gain on bargain purchase. So Ind AS 103 requires thorough review of all aspects before recognizing, as I told you, before recognizing gain on bargain purchase. So this is all regarding gain on bargain purchase, which I already explained in the very first session, if you remember. Is it clear to you or not? Now we are picking up a topic. This is 19th topic, but 19th topic right now we are not picking up. We will take it later on, correct? 19th topic is related to determination of business, and in this case there are some case studies, but honestly speaking, never ever case studies have been asked at your level. But in spite of that, we will do that, correct? So before actually we do this particular section, this is 19th section, why not we pick up the next section? Is it clear to you or not? Okay, so we pick up the next section. And which is the next section? Let me actually first check it also. So next section, as I told you, there are some case studies in this particular section. And after this, after the case studies, we have section In fact, just wait. This is your section 19, determination of business. After 18, determination of business, and it seems there is some numbering issue. So after that, there is section 21. So sometime it happens. House of care you may take, but still some printing mistakes take place. Anyway, it is in the numbering only. The next section is actually deferred consideration. There is no section 20, remember one thing, correct? But I will simply write 21. The printer actually forgot to put up section 20. Anyway, section 21 relates to deferred consideration. Deferred consideration. If you remember, in the initial stages, I also talked about this particular fact, that when acquirer entity takes over the control over the acquiring entity on that particular date, actually, we have to decide upon the purchase consideration. And in order to compute the purchase consideration, so often and so many times, I have already told you that we take into account the cash payment, the shares which we are going to issue, the debentures, preference shares. Besides that, we take into account the contingent consideration as we saw in the last session. And if there will be some deferred consideration, then that will also be considered as part of purchase consideration. Now, what we mean by deferred consideration? Actually, there is a slight difference between the deferred consideration and the contingent consideration. Under the contingent consideration, the payment is given after some time, not on the date of acquisition, but in spite of that, actually, we take that into account to compute the amount of purchase consideration. Correct? As we saw when we did some conceptual questions under contingent consideration. However, under contingent consideration, there are two possibilities, that additional consideration may have to be paid or may not have to be paid depending upon the fact whether the conditions which were specified are met or not. Isn't it or not? So contingent consideration is a consideration which is also paid later, but depending upon the fact whether the conditions attached are met or not. However, in case of deferred consideration, it is payable later, but in this case, there are no conditions attached. Is it clear to you? This is the only difference between contingent consideration and deferred consideration. However, on the date of acquisition, even though the payment will be made later, we will compute the present value of that, correct? And then we will make it a part of what we call purchase consideration. So deferred consideration, let's have a look over this. This is 21.3. So 21.3. In this particular question, what is happening? Simply you just keep your attention over here itself. In this particular case, there is an entity by the name of E1. There is an entity by the name of E1 and there is another entity, of course, E2. Needless to add that entity E1 is taking over the business of E2 or E1 is getting the control over E2. So E1 is the acquirer entity and E2 is the acquiring entity. Correct? Presuming that control was acquired on this particular date. So on this particular date, it was agreed that E1 Limited shall pay consideration PC, that is purchase consideration of 100 lakhs in cash. 100 lakhs in cash. So we presume that in this particular case, E1 Limited is going to deliver a payment of 100 lakhs in cash to E2 Limited. Is it clear to you? Further, there is an agreement. There is an agreement that E1 Limited is the acquired entity. E1 Limited shall pay further 20 lakhs or additional 20 lakhs after second year. So in this case, simply it is given that acquirer entity is going to pay some additional consideration, but additional consideration shall be paid only after the end of the second year. Is it clear to you? In this particular case, it is given and there are no conditions attached. That means this time the purchase consideration, additional consideration will have to be paid. Is it clear to you or not? And Let us say in the question you are being given that there is discount rate of 10%. Presume discount rate as 10% and discount factor and discount factor and discount factor at 10% for second year, or for 2 years should I write. For simplicity's sake, let us say 0.8264. So you are also being given this time the discount factor. So in this case, how you are going to compute the amount of purchase consideration? So in this case, while writing the response, all I have to show that what will be the amount of purchase consideration. That's all. The amount of purchase consideration, before we compute that, first of all, let me write here A, calculation of deferred consideration, calculation of present value of deferred consideration, calculation of present value of deferred consideration. So this is the only difference between deferred consideration and contingent consideration. So calculation of present value of deferred consideration. Now we will take into account present value of deferred consideration. And in order to compute it, what I am supposed to do, because I am going to pay 20 lakhs after 2 years, and today I want to compute its present value, obviously I will have to multiply it with the discount factor given to us, 0.8264. And by multiplying it with this, we are going to derive 16,52,800. 16,52,800. Is it clear to you or not? Clear? So this is the present value, and this present value will be considered as the fair value of the consideration on the date of acquisition. So on the date of acquisition, how much purchase consideration we are going to recognize? So purchase consideration to be recognized, purchase consideration to be recognized, purchase consideration to be recognized on the date of acquisition. So how much purchase considerations, how much consideration should I actually recognize? Obviously the payment which we are making on the date of consideration, that is cash payment of 100 lakhs, it was given in the question. So 100 lakhs, and besides that I will also add present value of deferred consideration. Present value of deferred consideration, DC. The present value is equal to 16,52,800. So this will be the amount of consideration on the date of acquisition, 116,52,800. Is it clear to you or not? Generally, at your level, you cannot be asked anything more than that. But this is just to enhance your knowledge, correct? Only this much, till up to this particular point you will be asked, but little bit extra why I am paying you, but little bit extra why I am delivering you. The reason being is that we have recognized a consideration today and the payment will be made later. So as a professional student, you need to know the accounting also of the later period. For example, in this particular case, just pay attention. Let us say year 1. When I will reach the end of year 1, now see here, actually on the date of acquisition we have recognized present value of deferred consideration as 16,52,800. And we also know that at the end of the second year we are supposed to pay 20 lakh. Important point is this. So what you need to understand here is that first of all you write here 16,52,800. And then you write here interest. Obviously, because when I am recognizing a liability of only this much, 16,52,800, And against that, I am supposed to pay 20 lakhs at the end of the what we call second year. Against this amount, I am supposed to pay 20 lakhs. Agreement is this only. So that means I will be paying some extra amount. So how to treat that extra amount? The point is this. So when we are going to reach the end of the first year, first of all, I am going to compute the interest on this amount at this particular rate, which is given in the question at 10%, correct? So your rate will be equal to your interest will be equal to 165,280. So this will be equal to my interest. Now, because my opening balance is this much and interest has become due, said that means this amount has gone up by 1,65,280. By the end of the first year, we may say that this liability has jumped by 1,65,280, isn't it or not? Right, sir. So that means the closing balance at the end of the first year, the closing balance at the end of the first year will be this much. That means when I am going to reach the end of the first year, we have already done the entry in the books of the accounts on the date of acquisition. But as a professional student, you need to know when you will reach the end of the first year, you are going to recognize an interest expense. And on the closing date, this liability has jumped to this much. You add 1,65,280 to 16,52,800. Is it clear to you? This is what exactly I want to inculcate in you. Correct? Simply don't think that this much is enough. If I am going to add it, it will be equal to 18,000, I think 80. Correct? So this liability at the end of the first year, this amount at the end of the first year will be recognized at this particular value. Is it clear to you or not? And you will also recognize in the first year, when you are going to prepare your financial statement at the end of the first year, you are going to recognize 1,65,280 as the expense. Is it clear to you? Right, sir. Now in second year, because closing balance at the end of the first year, so in the beginning of the second year, let me say this is the balance of liability 18080. Correct? In the second year, I need not require to compute the amount of interest, because if I am going to compute the amount of interest, it will be something 1,81,808 if I am going to compute 10%. Why? Because at the end of the second year, the story will come to an end. Because ultimately, I will have to pay 20 lakh. Try to understand what my point is. At the end of the second year, there should not be any closing balance of this particular liability. Or you can say in other words, at the end of the second year, this liability must move to 20 lakh. At least you can think in this particular fashion. Because at the end of the second year, we are supposed to pay 20 lakh. So in the second year, or we may say in the final year, what we should do after writing this amount, we should write this amount. Correct? And then we should take the difference of these two to arrive over the interest. If I am going to take the difference, then it will be equal to 1,81920. Point here, you can actually take 10% of this also, as we did in the earlier case. But if I am going to take 10%, it will be 1,81,008. There will be some marginal difference and account will not tally in that particular case. So that is the reason in final year, we simply take the difference of the what we call opening liability and the total liability at the end, and this amount gives us the difference. Is it clear to you? That means when we are going to reach the end of the second year, in second year, I will recognize an interest of this much. And this interest is nothing but the total difference between 16,52,800 and 20 lakh. So as a professional student, you need to understand that when we say that deferred consideration will be recognized on the date of acquisition as this, at this value, and later on we are going to pay 20 lakh. What does it mean? The inter alia difference is recognized as what we call interest. Is it clear to you or not? So this is the point which I want you to also have a little bit of knowledge about. Now, just because I want to tell you the accounting process also. In first year, what will be my entry in my first year? Generally, on the date of acquisition, I will write the entry asset account debit. In this particular case, unfortunately, it is not given in the question what sort of assets we are acquiring. To liability account, also it is not given in the question which sort of liability we are acquiring. So on the date of control, I will simply put in this manner, to cash, 100 lakhs worth of purchase consideration. And I will write here to provision for deferred consideration. Provision for deferred consideration. We write provision because this amount hasn't yet been paid. We are supposed to pay it. Is it clear to you? But we recognized it at a value of 16,52,800. That means total purchase consideration is recognized at this value. When we are going to reach the end of the first year, herein, as you saw, and as I was telling you, in this year we have recognized an expense of 1,65,280. Now, when we recognize the expense, what it means, interest is an expense to us. So first a due entry is passed, interest account debit or interest expense account debit. When interest will become due, interest expense account debit, then our liability will increase. Now, what is the name of the liability? The name of the liability is provision for deferred consideration. So provision for deferred consideration. So provision for deferred consideration, as you can see, has moved up by the amount of interest, 1,65,280. 1,65,280. So when I will reach the end of the first year, it means my provision for deferred consideration in the balance sheet now will be reflected at this particular value. This is what we mean by accounting. This is what as a professional student you have to think. Correct? Then likewise, when we will reach the end of the second year, again in the end of the second year, first of all, I am going to recognize the interest expense, because in the second year also interest expenses are there. These interest expenses will be debited to the respective year's profit or loss account, no doubt about that. Interest expense account debit. In second year, we recognized interest expense of 1,81,920. So I am going to write here 1,81,920. Correct? And then I am going to write here provision for deferred consideration. In technical business jargon, we call it, we are unwinding the things. Correct? That means we are taking the value of 16,52,800 towards what we call 20 lakh. This is what we mean by unwinding. So 1,81,920. So when we will pass this entry, of course now our liability or provision for deferred consideration has jumped to 20 lakh. And at the end of the second year, we are supposed to pay it, and we will pay it now. Provision for deferred consideration. Provision for deferred consideration account debit, 20 lakhs. Now we will pay 20 lakhs. This is how the accounting is done. Is it clear to you? Although in the examination, you cannot be asked till up to this particular point, as I've already told you. You will be simply asked what will be the amount of consideration till up to this particular level. So this is the point which you need to understand. And there I have added another section to it. And this is section 22. And section 22, as you can see, deals with business combination without transfer of business combination without transfer of consideration. Without transfer of consideration. So in practical life, even such a scenario could unfold. Sometime one entity gets the control over the other entity without paying anything to the other entity. This is a very interesting situation. Correct? So that is why I keep on telling we must do each and everything. In order to understand this particular point, logically this is your question number 22.1, but you can simply pay attention here. In this case, let us say there is an entity by the name of E1, another entity by the name of E2. Correct? We further presume that both these entities decide to merge their business. Both these entities decide to merge their business. So they have decided to merge their business. Let us say they have decided merge their business. Now, in this case, in the merged business, in the merged entity, we may say they have decided to merge. So in the merged entity, let us say total number of directors, or we may say board of directors. So total number of directors are 10. Let us say in the merged entity, total number of directors are 10. However, out of 10, 6 members we may say are from E1. 6 directors are from E1 and only 4 directors are from E2. So in this case, and we further presume, just to make you understand further, let us say E2 on the date of what we call this agreement, on the date of this particular agreement, we further assume that E2 is having a fair value, the business value. Fair value of business is, let us say, 10 lakh. Fair value of business is 10 lakhs and fair value of net assets. Fair value of net assets, let us say, is equal to 9 lakhs. As far as E2 is concerned. Now in this case, obviously E1 has got control over E2 simply because of the fact that in the merged entity, they are having 6 board of directors, 6 members as board of directors in comparison to or against what we call 4 members of E2. So quite obviously in this particular case, majority of the members belong to us. So we may have the control over the other entity. No transfer of consideration has taken place in this particular case. So even then control has been acquired. So that is how in practical life control can be acquired. But the point is what you are supposed to do in it. In this question, first of all, pay attention. In this PC, in this case, what is the amount of purchase consideration? You let me know. So purchase consideration will be nil. Of course, purchase consideration is nil. Nowhere it is given. Now you let me know what will be the NCI, because these are the things generally we compute on the date of the control. Now we have got the control over the other entity without investing a single penny. If we haven't invested a single penny in the other entity, so that means not a single share of the other entity is in our hands. That means all the shares of this particular entity, E2, are in the hands of other shareholders. So this is a very peculiar sort of situation, but you need to understand that in this case, NCI will be 100%. Very interesting, isn't it or not? We are not having a single share of the entity. Still we are having the control and all the other shares are in the hands of the other shareholders. So that is why we are going to say that NCI will be equal to 100%. Is it clear to you or not? Okay, 100%. And indirectly, it means when we say NCI is equal to 100%, you remember just way back, some time back, we did reverse acquisition. Over there also I mentioned that fair value of the entity or fair value of the business signifies the fair value of the share capital. Fair value of the share capital of E2. So if I say that 100% of the share capital is in the hands of the other shareholder, and the fair value of 100% share is 10 lakh, indirectly NCI at fair value is equal to 10 lakh, it means. So that is the reason in this case I will write here NCI is 100%, so indirectly it means equals to the total fair value total fair value of acquiry. So we may say NCI is equal to 10 lakh. See, it is given in the question fair value of the business or of the acquiry company is actually 10 lakh. And whenever it is written in this manner, it means it is the value of the 100% of the share capital. And 100% of the share capital is in the hands of the NCI. So equals to the total fair value of the acquiry company, that is 10 lakhs. So that means the value of NCI is equal to 10 lakh. Is it clear to you or not? So in this question, you also understand acquiry company, in this case, how to compute the amount of goodwill or gain on bargain purchase. So question may ask you to compute goodwill or gain on bargain purchase under such a situation. This is the point. And generally, in order to compute the goodwill or gain on bargain purchase, what we do, we simply what we call write the NIFA, net identifiable asset. And net identifiable asset of the acquiry company is equal to 9 lakh. It is given in the question. Out of this 9 lakh, we have already seen that NCI is having 10 lakh worth of asset. So total NIFA, net identifiable asset, are 9 lakh. And in it, share of NCI is 10 lakh. Is it possible? Yes, it is possible. Indirectly, it means acquirer share. In this case, E2, acquirer share will be negative. So Ind AS is very interesting in the sense that acquirer share can be negative. So in this case, we may say acquirer is getting what we call -1 asset. Correct? -1 lakh worth of asset. Is it clear to you or not? And now we are going to compare it with the amount of consideration. What is the amount of consideration? So consideration amount is 0. In this case, no consideration is passed. So obviously, we are getting a negative figure. That means acquirer is having a negative figure. I'm not writing here -1 because I'm simply going to write goodwill. So whenever we write goodwill, indirectly it also means loss. So in this case, amount of goodwill will be equal to 1 lakh. Is it clear to you or not? So how you are going to compute the amount of goodwill when purchase consideration is not transferred? This is the point which you need to understand. Is it clear? Now we come over to the last section of this particular part, this particular chapter, which I told you I will do after all the sections have been completed. There is another section I have added, 23, acquisition related cost. You must know that we have already talked about this particular fact, that if there will be any acquisition cost, that will be expensed in the books of the acquirer company. Correct? That will be debited to profit and loss account. This is what you need to understand. And now we will come over to this section. That is determination of business. Now, in this particular section, actually you haven't been ever asked any question out of this particular section, to be very honest with you. And further, such sort of section is not given in an appropriate manner in your module also. So I don't think any case studies will be asked, but still my advice is that you should not leave anything to chance. Still, at least first 4 or 5 studies you must do. Correct? Just to make you understand what exactly is this. In this particular case, there is an entity by the name of SY Limited. And there is another entity by the name of GX Limited. What this case study is all about. If you remember, in the initial stages, we talked about business. And I told you at that time that we have kept a separate section to elaborate this particular point. This is exactly what we are doing right now. It is given that SY Limited acquired 100% of the stakes in GX Limited. Further, it is given this entity is having their own workforce, factory, warehouse, plant, raw material, etc. Now, question is GX Limited is a business? So, without what we call any analysis, you can arrive over this particular conclusion. Yes, GX Limited is a business in this particular case because it is having all the inputs and all the processes and they can be combined and integrated to produce the output. However, you will have to write it in this manner. Yes, GX Limited is a business on the following grounds, and the grounds are that it operates a trade with a variety of assets such as warehouse, factory, plant, and has workforce. As such, there is a group of assets and activities that can be integrated to produce the output. So, GX Limited constitutes a business and company SY obtains control on this particular date by acquiring 100% voting rights. This is how you have to mention. So, these are the sort of case studies, correct, which you have to do. For example, in the next one I have given that there is a company by the name of A Limited, another company is D Limited. A Limited is getting 60% stakes, and for the same, A Limited is paying 600 million rupees to D Limited. And you are further given that D Limited is having net identifiable asset worth rupees 750 lakh. This entity D Limited is still in developmental stage and it hasn't yet started any operations. And this entity is having what we call a team of research engineers and who are developing a technology, and that technology has been applied for patent, but patent is still pending. And some negotiations to license the technology is in advanced stage. Actually, this D Limited might be what we call developing a technology, and they might be having a very high opinion regarding that particular technology. And that is why they are interested in licensing it out to the third parties, and already negotiations are on and on advanced stage. Only thing is that D Limited requires additional funds for completion of the development work. And perhaps that is the reason why A Limited was allowed to have 60% stakes in the D Limited. Now the point is company D Limited is business. Important point to understand that even though D Limited at this moment, because it is clearly given in the question, hasn't yet started the operation. But in spite of that, it has got the required sort of inputs and the processes which can be integrated and combined, and which are capable of generating the output. As I told you in the very first session, it is not a necessity that right now you might be producing the revenue. It is not a necessity. You might not be producing any revenue or generating at this moment. But if there is capability, in that case, it will be considered as a business. So although company D is not earning any revenues, an example of output, yet there are number of indicators that it has a sufficiently integrated set of activities and assets that are capable of being managed to produce a return for investors. Is it clear to you or not? And you can further elaborate it with all these things which I have written over here. So these are the case studies, to be very honest with you. But I have also told you this particular, I should be very honest, unnecessarily I would not like you to waste your time also. Correct? Because these case studies haven't been asked, but at least just to give you an idea that you should have at least this sort of thing in your mind, that in case if such a question strikes in the examination, you should be able to deliver the answer to it. Is it clear to you? Further, it is given in 20.3 that A Limited is taking over P Limited. And P Limited is also a subsidiary of the investment group. A Limited is taking over P Limited. A Limited is taking over P Limited. And P Limited is already having, actually P Limited is a subsidiary, we can say, of a property investment group. Property investment group. This entity is a subsidiary of this group and we are taking control over P Limited. Is it clear to you or not? And not only taking control, rather we are acquiring 100% stakes of P Limited. So this entity will also become our wholly owned subsidiary company, you may say so. Now, important point is that the P Limited owns 3 investment property. It owns 3 investment properties. And these properties have been given on a long-term lease on a single tenancy basis. On a single tenancy basis. And administration is done by former employee of property investment group. Although this line is not very important, but just it is also given that these properties have been given to the tenants on a single tenancy basis, and administration is done by the former employee of the what we call property investment group. Now, because P Limited has three investment properties. Investment properties are those properties which are kept by an entity for the purpose of earning rental income or for the purpose of sale. Such properties are known as investment properties. So they have kept some investment property and they have given them on long-term leases, correct? Obviously, because we have given such properties on lease, we need to give them some services. And for the same, P Limited, see here, I have kept arrow. P Limited is obliged to provide basic and maintenance services. So P Limited is under an obligation to provide some basic and maintenance services, and for the same, P Limited provides these services through a third party. So in order to provide the basic and maintenance services, P Limited has actually kept a third party which helps in what we call providing the basic and maintenance services. But in this particular case, you need to understand, we have three long-term properties. We have three long-term properties. And these properties, we have three investment properties. And these properties have been given on long-term leases. Long-term leases means we cannot alter, we cannot change. In case, suppose tomorrow we are interested in what we call making our mind to actually sell these plots, or what we call to use this property for some other purpose, we cannot do so because these are long-term leases. Is it clear to you? Long-term leases. Important point is that in this case, these properties are on a single tenancy basis. To a single tenant, you have already given all these properties. So in this case, we may say that there are no group of asset. In this case, there is no group of asset. Is it clear to you or not? So because in this case, A Limited is simply, we may say, acquiring investment properties and not any group of assets. Is it clear to you or not? And that is why, because in this particular case, there is no group of assets, so that means there is no group of activities which can be integrated to produce the output. So it will not be treated as a case of business. It will be simply treated as acquisition of asset. Is it clear to you? It will not be covered by Ind AS 103. This is the point. In this case, A Limited simply acquiring investment properties and not any group of asset with the integrated set of activities. As such, acquisition of P Limited should be treated as acquisition of asset, that is investment property in this case. Suppose if in this question it would have been written in this manner, that these three investment properties have been given for a short-term leases. For short-term leases. Suppose if it would have been given, and it would not have been given to single tenant, rather it would have been given to several what we call tenants. To several tenants. Suppose if it would have been given in this manner. So because this time the property have been given for short-term periods, so that means after a particular short period we can use it for any purpose. Correct? And similarly, because they have been given to several tenants, so in this case, we have the leeways. So if it would have been given in this manner, then I would have called it a case of business. Is it clear to you? In that case, it would have been considered as if we are acquiring a group of assets with a group of activities. Is it clear to you? So in the next question, in order to elaborate this particular point, the point which I just elaborated, I have written here. For example, in this case also, company A is taking over another entity, Q Limited, and similar to the last question, this Q Limited is a subsidiary of Property Investment Group. A Limited is acquiring 100% control over it. And again here owns three investment property. But here, see, these are multi-tenant residential structure and given on short-term leases. So because in this case, there is not a case of single tenancy, so we can change and we can diversify. So in this case, it will be construed that we are acquiring a group of assets and we are having a group of activities, and by combining these two, we are in a position to get some returns. So in this case, it will be regarded as business. Correct? So these are the type of questions, case studies actually, although these case studies have never been asked at your level, but just to make the point clear. Similarly, in this case, let us say there is company S Limited, and this is the last case study which we are going to do. If there are three more case study, if you want to do, you can do it of your own. Company S Limited is having operating segment and head office functions. And in this case, it is given that in this company, there is operating segment, there is head office, there are two segments, head of operating segment and another segment which carries out head office functions. And in order to have their payroll and accounting, that is managed by a separate department, that is cost system. So that means their payroll and accounting is done, or both these segment is done by a separate cost system. However, it is given that company A acquires all assets, liability and workforce of operating segment. So can in this case operating segment be treated as a business? Yes. As company is taking over all assets, liabilities and workforce of operating segment, that indirectly means company A is taking over all the resources and activities of operating segment that can be managed to produce the output. So thus operating segment meets the definition of the business. Is it clear to you or not? So 20.6 and then 20.7, if you want to do, you can do it of your own. 20.8 is just extension of 20.7. 3 more case studies if you want to do. So near about 24 sections, and to be precise, 23 sections we have done to thoroughly what we could cover this particular chapter. But